Welcome to our marathon session in English company law. In this long podcast, I explain the majority of the subject as it relates to SQE1 FLK1 business law. Listening till the end and making notes will be invaluable in assisting your preparation for the SQE and for anyone sitting a company law or business law exam at undergraduate or postgraduate level. We are starting right now.
You guys are lucky because you are taught company law by nobody other than myself, who is a company director. Because I thought I've been talking about these things for so long, I gotta try it out. So all the things that we do together, I did for myself, and I realized there are actually easier ways to do them than the ways in which I'm telling you in the lectures. Yes, so there is some updating to this information, at least from a practical perspective. I set up my own company and I went through the entire process thinking, what is it that I'm setting up for? What is the potential client that I could have? What is the best way to set up the business, to choose a name, to position it against other businesses that might be in the area? And what am I trying to achieve? And what is the client potentially trying to achieve? And what they expect to see? And how to get all this done? And then all the practicalities of it. How do you go through the process of thinking about this, devising a strategy, first of all, which is not a legal issue. The strategy is not legal, is practically focused. Why am I trying to do this? If I'm an entrepreneur and I've got a plan for running a business, what is this plan and how should I operationalize it? And then the legal parts. What does it mean to actually register a business? What type of business do I want to register and how do I go about this? So parts of exactly what a company is and what is it supposed to be for and why would you need to do your business or to run your business through this form of supposedly a company as opposed to just doing it. Now, by the way, question for the audience. Are you allowed to just engage in business by yourself? This country is great for promoting people's activity. And most of the concerns in running your own business come from potentially tax implications and things like this. They're not an issue of authorizations and licenses. So if I want to offer consultancy, as I've been doing for a very long time, I can just do it as myself. I don't need to get the license from anybody. Of course, there might be restrictions that come with other engagements that you have. If your employer, for instance, does not allow you to have side jobs or do something else, if there is that type of restriction, then it's a contractual problem that either you need to find a workaround or you need to negotiate with your employer to get some sort of release. That's absolutely fine. So that could be a legal restriction into the kind of business that you can pursue, but it's not a legal restriction from the state or a regulator. It's a legal restriction from activities that you yourself have engaged in. So if the university said, we don't allow you to write for a publisher. We don't allow you to be an external examiner. We don't allow you to kind of help other people set up their programs or whatever it is without our permission. I would be under a contractual obligation to go through that. But in the absence of this, I don't require a license. If I'm talking to somebody and I say, this is what I do, or, I make videos or whatever, and they tell me, well, would you like to we would like to explain a concept to our employees. We're having these workshops. Everybody falls asleep. Would you like to make a video about it? We'll pay you like £500. And I say, sure, I'll do it. It's fine, it's not a problem. I don't need a state authority to allow me to do it. Now, how do I get taxed for it? Happy enough, HMRC says, if you engage in activity as a sole trader, you don't have to tell us so long as your revenues do not exceed £1,000. So the revenue itself will tell you if you're making minor profits out of minor jobs. We don't need to know. It's pointless to go through the paperwork for us to collect tax on the first £1,000. Only if your turnover becomes significant enough that it generates tax liability beyond this £1,000, then you need to register for self-assessment, which means that you make your own tax statement in this country, right? And you tell them how much you made, and then if there's some tax to be paid, then this arranges for the tax to be paid. This can be if your self-employment activity is your sole income, or it could be if it is something in addition to you being an employee for somebody else. Message for you guys, If you want to do something on the side, it's perfectly fine. And so long as your income doesn't exceed the £1,000, you don't even have to tell anybody, and you're 100% legal and compliant. You're selling stuff on eBay, right? You could do crochet. Did you know that crochet swimwear is a thing? And people make a lot of money out of crocheting swimsuits that then they sell on eBay, on Vinted and stuff like that. It's a legit business, perfectly fine. You could be an influencer. You can have like a massive Instagram account and you make money out of ads, or you get sponsorships and whatever. The money that you make out of this, you're allowed to in your own personal capacity, and that is perfectly fine. If you would like to do some of the stuff that falls into specific categories, then you need to think about permissions. You cannot offer legal advice, because if you want to offer legal advice, and you will need to check this if you want to join the profession, there are certain things that are controlled. You cannot just offer legal advice to the public if you are not officially a lawyer. So in our purposes, a solicitor or a barrister, and within particular contexts as well. So if you are a self-employed solicitor, meaning you don't work for a firm, but you just work by yourself, again, there is for certain types of advice, you need to register with the SRA with a particular way, so then you have professional indemnity insurance or that stuff. Now, if you are in a professional capacity that has add-ons, that you might need professional indemnity insurance, that you might need the authorization of a regulator, you cannot be a doctor on your own just because you decided to, or a nurse, okay? These things are controlled. Or you cannot deal with substances that might be prohibited. You cannot be like, I make my own gunpowder and sell it on eBay, okay? Or I make my own fireworks, because these things require authorization. But again, these are restrictions that have to do with other parts of the law. They don't have to do with the part of the law that is geared towards business and entrepreneurship. So you could, all of you could start doing business right now and earning money. And you can just do it in your own name. How do you make the leap from that? Your ability as a person to engage in business, make money out of it, deal with the tax implications and stuff later on. How do you go from that to the idea that you need to have a structured business behind you? Why would you adopt a business organization form where you can do this stuff already? Why would anybody go for business as opposed to just doing all the stuff that we described by themselves? So the money issue and separating business finances. So let's go, it's business regardless of form. Whether you're working as self-employed or you're working through some corporate structure, it's still business, right? The difference between business in your name and in business through some sort of organizational form is the separation of the money. The very big danger of you doing business in your own name is that everything you have is exposed to the business in the same way that you have freedom to deal with the business money for yourself. If I make a video for that guy who said do a little training video and I'll give you £500. If I do this, then he sends me the £500 in my own personal bank account. I can spend it like immediately. I can go get myself with £500. I could probably get an older version of a used iPhone. I don't have to ask anybody for permission. I don't have to keep any paperwork. I don't have to do anything at all. The only thing that's going to register officially is the fact that there's £500 income coming, but what I do with that income is my business, in exactly the same way that what I do with the salary from the university is my business. But what's this? I make a video, the guy thinks it's fine, showed it to the people in the business. One of the people of the business likes it, takes a screenshot, puts it on Twitter. The people from Adobe look at it. They realize that the screenshot is an image from Adobe stock. They're thinking, that's fine. That's one of our images used for commercial purposes. Let's check if the guy who made this has a license. They look it up. They realize that I don't, because I just Googled the image and I stuck it in there. And then they sue me for copyright infringement, which can totally happen. Now, I'm thinking, I'm dancing wrong. That's what I do all day long, right? We can download pictures of Google and we put them in our slides. But what I forgot is that this was a commercial engagement with that guy, it was not in the context of teaching. But if you do something commercial, or if I take the video I made for the guy, and I put it on YouTube to share with others, I will get a copyright strike immediately the moment somebody notices that the music I'm using or the images I'm using belong to somebody else. And then they will sue me. And you're thinking, oh, like a one image, what would be the big deal? How much is that? Filipinos, you don't know what it is. Yeah? Because if you remember your contract law classes, they're going to claim for loss of profits, variety of other things. So depending on what the violation is, there could be significant cost. There could be a cost that exceeds the £500 that I got paid. How am I going to cover that liability? By my own money. So the way to avoid this, or one way of dealing with this, could be some sort of insurance, but of course insurance doesn't cover you for your own intentional faults. So you cannot get professional indemnity insurance and then buy yourself the license to be negligent in the way you carry out your work. That's not how it works. But you can use specific corporate forms to diversify which part of the business activity, which part of the money is you as a person, and which part of it is the business by itself. For example, the company I set up has its own money. It has its own bank account. I've got a bank card that is in my name because I'm the company director, but the bank card and the account belongs to the company. Meaning that if I do business, the money that people pay me for the work that I do, it comes in the company account. The money that I pay out needs to be linked to the company, and it comes out of that account using that card. If I was using a corporate structure to carry out my business, and if something went wrong, the business has its own capital. It consists of the initial money that people pay in when they purchase a share of that company. That is usually very little. My company was set up with £1. So the initial capital was £1. It might contain other money where people have made contributions along to the company to allow it to operate. For instance, my company needed a loan to start paying for stuff. Why? Because it had expenses from the word go. So the company was set up, capital was £1. However, I needed to pay for an office address, I needed to pay for a website, I needed to pay for a domain name. Where's all that money going to come from? The company didn't have any income yet. I would have either set up the shares at a much higher level, which is a very bad idea for reasons that I won't explain in other classes, or I would need to make a loan to the company, which is what I did. And once the company started running and generating revenue, and it's got its own money, then it pays back the loan, that's fine, and then it keeps its own money. I cannot, if I want a new iPhone, I cannot use the company's money. Actually, I can use it once, because HMRC will accept as tax-deductible expenses a phone line, internet line, phone. I could buy 5 if I had 5 employees. But if I'm on my own, because otherwise, anybody who has a company would just buy everything for their friends and then pass it as company expense. Now, what is the benefit of this? If something is an expense, it gets deducted from your incomes, therefore you don't pay any tax on it. Anything I earn as an individual, if I'm working as a sole trader and goes into my normal self-assessment, it gets taxed at the normal rate of tax. So in my case, anything I make extra would be taxed at 40%. What my business makes, if it's all spent, then there is zero tax liability. So if somebody pays me £1,000 to do something for them, and then I use this £1,000 to buy an iPhone for the company, the money has been turned from cash into an asset, but because it's been spent, it's got zero tax liability. So I basically got my iPhone with a 40% discount, which is terrific. But you need to be careful how you do these things. Now, the corollary is separate business money, separate Ioannis money. If the company goes bust because it meets a liability that it doesn't have enough money in to take care of, so if after all these businesses that I've done, the company has got, say, £10,000 in its bank account, and I'm hit with a liability of £100,000, what happens then? If the company cannot pay, what happens to a business when they run out of money? They shut down. I make my video. I post it. Somebody notices a copyright violation, sues me for a great deal of money. The company is kaput from the word go because I wouldn't even have enough capital in the company to hire the lawyer to defend the claim. So I could just acknowledge the claim and go bust and not pay. I'm a wealthy individual because, I've got a lot of money, I've got bank accounts, I've got jobs and whatever, and I'm running like a small business that is separately incorporated on the side. If that small business is undercapitalized because it's a small business, it doesn't need a great deal of money, but out of bad luck something happens, like somebody sues me for something I didn't see coming, then it doesn't matter how wealthy I personally am. The business is a separate entity and it's only the business that people are engaging in. Now, in reality though, guys, if you are you're a small business and you approach somebody to do something with you, they're not just gonna do it if they don't trust you. So you cannot go to a bank and say, hello, I'm the director of my new business, Scabby Scams Limited, and I would like a £100,000 loan, please. The bank's gonna say no. Or if you wanted a £10,000 loan, they're probably going to say yes, but they're going to say, we want you to give a personal guarantee on the side. So if there are contractual mechanisms to make yourself co-responsible because nobody trusts a business that is undercapitalized. So in reality, it's not really that easy to hide behind a corporate form to do big things. Small business is to start things go. Yeah. And then how big the business is or how reliable the business is reflects all the type of client you've got, the expectations of the client, and how everything sells. But to come back to the topic that we're discussing today, why do people form a company? One of the key reasons is the separation of the money. And an associated reason could be clarity as to who does what. And what are the responsibilities and obligations of the people who are engaged in that business. Our scenario is that one person is like a sole member company, they do everything by themselves. But that's not usually the case. Usually there are more people around. If you're working with a colleague to get something done, then things become complicated if you don't have a specific organizational form to support your business. How often do you get into arguments with your friends about things you're trying to organize? I mean, most people are unable to organize a birthday party, never mind a business. If you go to a restaurant and try and pay with your friends, it's mayhem, right? So it's like, why am I going to pay for this? Why are we splitting equal ways? You have a Coke, I didn't have a Coke. Who got the garlic bread? Imagine this now if you're actually running a business that becomes significant or a business that you're making a living out of. There are ways that you can organize officially with other people so you don't get into that sort of trouble. A partnership is a business form that the law recognizes. So there are specific rights and obligations that comes out of being in a partnership with somebody. So obviously you cannot be in partnership with yourself, you need to be in partnership with somebody else. The partnership is also a matter of fact. You don't need to take any steps to set up a partnership. It happens because it's already there. The law recognizes the arrangement you already have. So yes, once you get into the type of business that involves other people, things might become more official by default. But even in that case, there are a lot of people who prefer to take the steps to set up a company to operate through that as opposed to a partnership. If we're talking about your traditional company that offers this separation, this is a significant motivation into having a company. The partnership will not automatically give you this. So the partnership offers you like the legal structures and the law that has developed around it. They're mostly to help the other world, people outside, to understand who they're dealing with if they're dealing with one of the partners and the extent to which each of the partners represents the partnership for business deals and so on. And also to set up rights and expectations between the partners themselves. However, there is no strict distinction between the partner's personal life and personal assets and those of the partnership. So people are exposed not only because they're responsible for what the other partners are doing, because it's a common thing. It's as if you're renting a flat with somebody and your rental agreement says jointly and severally liable. That means that if one of your friends runs off and doesn't pay the rent, you still have to pay it. So you cannot say we were splitting 3 ways, one of them left, so we're only giving you 2/3 of the rent. The landlord expects 100% of the rent from whomever's left. So the partnership works like this. There can be multiple partners, that each single partner is responsible for the totality of what's going on. And also a standard partnership, because there are other types, but the standard partnership does not give you this built-in distinction between business and personal finance. So not only you might find yourself liable for what the others are doing, you might actually go into your own personal money when the partnership does not have enough money to meet a liability. But in terms of organizational structures, you can work on your own as a sole trader, no problem, and super easy in this country. You can set up a company if you want to do things formally, or if you're dealing with other people, you could be in a partnership. These are the 3 key avenues to running a business. You got the limited liability partnerships. Have you noticed if you go to a law office that most of the time the sign says blah, blah, LLP? So this is the limited liability partnership. Is a new form, relatively new form of business that combines some of the elements of partnership and some of the elements of company. So it offers some limitation of liability, not as complete as the limitation of liability you can have for a private limited company, because some stuff you're still responsible for. But it also offers some of the tax advantages of having a company as opposed to having a partnership. So it's good for professional type businesses, lawyers, accountants, consultants. When lawyers are part of an LLP, they make a contribution to the business in order to become partners. For instance, when you become a partner in a law firm, you need to make a financial contribution. You effectively buy a stake in the business. But if it's an LLP, then that is the totality of your exposure. So if the business goes bust for some reason, they will not come after your personal wealth. So it creates this separation between the money you have contributed or participated in the business and the money that is personal. But it's not fully a corporate form. Because it's believed that a full corporate form might not be suitable for professional services. It requires a great deal of disclosure that they might not want to make. Just kind of in between house to cater for particular types of professions that needed something that offers an element of limitation of liability and some of the tax advantages, as you have in companies, but they didn't want to go the cold hog and register a company. Now, don't get me wrong, it's possible to have a private limited company that offers legal services. Because legal services in this country have been liberalized a few years ago. So now it's possible for something that is registered as a profit-making business, as a limited liability company, to offer legal services. We have the key distinction then between what happens if somebody does stuff by themselves, what happens if they do it through the form of a company, and what happens if they do this through the form of a partnership. Now, there are, of course, different types of companies. The 2 key types are the private limited company, which comes to the LTD that you see very often, right? Most of the things are LTD. My company is an LTD. And you have the public ones. Now, a public limited company, a PLC, is something that has slightly different organizational features. The key is how open it is to investment from people outside the company. If you set up a private limited company, the initial set of people joining in are probably going to be the permanent people in it. And if you want to bring other investors in the form of shareholders, you need to go through rather burdensome processes to incorporate more people into the business. If you have a public limited company, public being the operative word, it is easier for people to come in and out of the company. They can unilaterally, without involving the company, sell shares to other people. So there's a fluctuating base of shareholders, while for a private limited company, the shareholding is fixed. Not all public companies are in the stock market, but they have the ability, if they want, to list in a stock market. That gives the opportunity to everybody very easily to discover when there are shares available to buy and the prices at which these shares are available. But remember this, you can be a public limited company without being in the stock market. And you don't have to be in, if you choose to be in a stock market, you don't have to be in a specific stock market. So not all British companies are in the London Stock Exchange. They can be in different stock markets. It depends on the rules of each particular exchange, on the type of business that they will accept. In the US, in New York, you've got a lot of Chinese companies that are in the stock market. Key objective is to use this as a form of business. However, company organizational forms are not always to make money. You could use one just to organize stuff. For instance, if you run a university, right? It could be a non-profit company, but it could still be a company that is the organizational basis of an educational institution. If you have a block of flats and the tenants need to organize themselves, somebody needs to be a representative, somebody needs to deal with contractors, the maintenance of the building. Usually there will be a company that deals with the management of the building. The aim of the company is not to make a profit. It is to organize how to run a particular task. You can have what we call community interest companies that are created to take care of a particular project within a community setting. We're not talking about charities just yet, because charities have got a completely different regulation and a different type of registration and all that. But we do cover companies that are with a profit incentive and those that do not have a profit incentive. And because I mentioned shareholders, perhaps it's worth saying that usually when a company is set up, it is divided into shares, the ownership of that company, and whoever purchases the shares becomes a shareholder. But it's also possible to organize a company not divided by shares, but when the people participating in it give a guarantee that they will pay a specific amount if it goes bust. If you have a profit intention, it is a better idea to have it divided in shares, because then you can use the shares to calculate payments and benefits back to the shareholders in the form of dividends. If it's a company registered by guarantee, then it probably does not intend to return money back to the shareholders. The guarantee just says, I signed a commitment of £100. So if this business goes bust, the creditors can come after me up to the level of £100. So that way you don't have to put any money up front, which might be attractive, but of course it's got consequences in the way that the business is set up and the purposes that it serves. Today we have the opportunity to go through advantages and disadvantages of incorporation in a little bit more detail. Because of course, it might sound attractive that you can run your business through a corporate structure, and there are various advantages that one can easily come across, like some tax advantages, some organizational advantages, defining your responsibilities and obligations with other people who might be involved in that business. All that stuff is good. But there are some costs involved, and there's a great deal of bureaucracy. So you need to have a way to balance the costs and the bureaucracy and the paperwork and potential consequences with the benefits that you might have had running a business through that function. Of course, all this assumes, ladies and gentlemen, that you have a business. And if you don't have a business, maybe there's no point. Sometimes people get confused by this. You might be thinking that if I start this off as a corporate form that makes me look official, then this is the beginning of my business. Not really, because if you don't know what you're doing, you don't know what you're making or who you're trying to sell it to, you have no leads for potential clients and no idea how to generate a revenue or kind of have some income in any event, then you're not going to get very far. So the fact that you've registered the company doesn't mean that in and of itself makes a business. So the business plan and the idea as to what you're doing in terms of goods and services and customers needs to be there already. The business form is what helps operationalize this in the most efficient manner, so then you get the maximum benefit out of what you're trying to do. So if anybody here is thinking, well, I would like to become an entrepreneur or a business person, I will start off by setting myself up as a company, maybe this isn't a great idea. It could be that what you actually want to do for what you actually want to do, the company form is not the most appropriate form for you. Have we talked about our friend Salomon? Salomon, back in the day, and we're talking sort of Victorian era level of business, was running a shop. And he was running this quite successfully. So no problems there. Parliament passed legislation which enabled the creation of corporate forms. Salomon thought, oh, this looks interesting. They're doing this. They must have a reason behind it. It probably looks like a good idea. Discussed it with a few people and thought, okay, how about we take advantage of this and use this newly created corporate form as the vehicle through which to run our business. At the time, the law didn't allow somebody on their own to set up a company like we have today, but you needed to get a bunch of people together. It was supposed to be a sort of collaborative exercise to bring together groups of people who were engaged in business. Obviously, Salomon didn't have a group of people because this was his own personal business. His family was involved in it. So he actually got his family members and kids to sign on as co-creators of this company. No problem there. The law required that you have a number of people. Since he had a number of people involved that wanted to do it and signed on the paperwork, this was perfectly fine. So he tries to go through the steps of incorporating the business as a company. Gets the number of people required, goes through the paperwork, gets the permissions that the law said that you need to obtain before you start trading. At that point, he thought, all right, now I've set this thing up. And the whole point behind this new legislation was that the company created is actually a different creature in the eyes of the law than the people who make it. That's why we come back to notions like separate corporate personality and so on very frequently when we discuss about business organization. By going through the paperwork and getting the permissions and getting the certificates and so on, this new legal person has been created. Distinct from Salomon, distinct from all the people who were working with him. But that new person in law doesn't have any money. So would Salomon simply gift the business that he was running to the company? That might not be a great idea because this was his livelihood. If he just gifted it to the company, then it would belong to the company and he would be left with nothing of value for himself. So this wasn't an appropriate way to do this. But the company is usually set up, and at the time it was set up with some minimum financial contribution, but this wasn't significant enough to purchase the business. So for the business to transfer from Salomon to this new entity, the money needed to come from somewhere. So Salomon made a loan to the company. And the company then used the money from that loan to purchase the business. Now, this sounds a bit strange. So Salomon is the boss already. He sets up this company that is in law distinct, but in fact, there aren't any different people involved, it's still him. He takes money out of one pocket, calling it a loan, sticks it into the other pocket, because that's the loan that's supposed to come back from that's the purchase money in the transaction. And not only money goes from one pocket to the next, like the loan comes out and then it comes as purchase money back in, Salomon still has entitlements because as the creator of the company, he is the shareholder. So he owns now this business and this business has acquired a valuable asset. It is a bit of a difficult thing to digest. But the end reality in terms of the law is that the business no longer belongs to Salomon, it belongs to the company. And Salomon is now a shareholder, he's got a stake in that company, but he's no longer the business owner. The company did not totally repay the loan immediately. So he used the money from Salomon to purchase the business, but not all the money came back immediately. For whatever was left, Salomon had some security features in the paperwork to make sure that he recoups the rest of his investment when it comes to it. I'm not talking about the shareholding part of the investment, because when you participate as a shareholder, you make an initial contribution, You buy a piece of the company, and that's it. If the company goes bust, then you lost that piece. But if you make a loan to the company, you can include terms and conditions in that loan that gives you some element of protection. If you get a mortgage from the bank will secure itself by having a claim over the house. So if you don't actually repay the mortgage, they're going to come and take the house away. So the bank is not investing in you and your family life. The bank is giving you a loan, and to elevate their chances of having that loan repaid, they've got a stake over the property. It's perfectly normal stuff. If you get a consumer loan, again, it works in the same way. If you borrow money on your credit card, it works in the same way. It could be that the bank then has a stake on the thing that you purchase, and so on. This is all very normal. So Solomon gives a loan to the company. The company uses that money to purchase the business. The business goes away from Solomon and it becomes the company's. Solomon still has money to receive. This money is protected in the paperwork because the paperwork sort of elevated him in the first place. If something goes wrong, he would be the first person to be paid amongst a variety of other creditors that might be there. It doesn't guarantee that you get your money back, but it means that if you're first in line, you've got higher chances of getting some money back than if you were last. Equally, when the bank has a claim over your house, if you don't pay the mortgage, when they try to sell the house, if the prices have dropped, the bank might not recover the full value of the loan. But that's a risk that everybody takes when making these types of transactions. Externally, life continues as if nothing has happened. Because the people who were doing business with Solomon, his employees, his customers, his suppliers, probably noticed nothing different. The shop's in the same location. They do business with the same people. They meet the same people when they go there. The nature of the business, the type of goods, the payments, nothing really has changed in any way. Perhaps some detail in the paperwork is different, but the reality of doing business has not changed. Up until the point where something went wrong. And it did go wrong, not intentionally, but the business started performing poorly, and at some point, he couldn't repay the loans. He couldn't pay invoices and bills. He couldn't satisfy the customers. He couldn't satisfy suppliers and so on. It happens when a business runs into trouble. When people came to ask for their money back, they came to Solomon. And they said, we haven't been paid. Now you owe us money, so it's time to cough up. Solomon went, well, it's not me as a person that you're dealing with anymore. It is the company, because we had set up the company and so on. If the company is not able to pay you, then it's a problem between you and the company, not a problem with me. Solomon could be a shareholder. It's not a problem for him. He could be a company director. Yes, he's still the person representing the company, but again, it's not his own money that's going to pay the company's debts. But the people who were losing their money didn't see this the same way, and they were not particularly pleased. So far as they were concerned, they were still doing business with the same person, and they felt they were getting scammed. So they went to court, and they said, look, this isn't right. It's the same person here. The business has always been the same. We were dealing with this gentleman. Suddenly he tells us it's not him and it's some kind of phantom virtual entity that doesn't have enough money to repay us. Not only this, he got his money back. So whatever this phantom entity owed him, he was the first one in line. He got repaid. We didn't. So, what is this? So their argument that the court was that this is some sort of a scam, and surely the intention of the legislator could not have been this, to create a legal fiction that then allows people to get away with running their business poorly. The court had a look at this and they said, well, actually, weird as it may seem, this is what the law said, so the consequence is this. Why is this important for us? Because this was nailing down the notion that a company is a distinct entity and its money is distinct from the money of the shareholders, the money of the directors, or whoever is involved in it. So the court had the opportunity to challenge this legislation, this new form of business that came in, and to interpret this legislation. And what they came up with was that yep, this might look odd, but this in fact was the intention of the legislator. So if you have a problem with it, talk to your MP. So it's a matter of changing the law, but it's not a matter of Solomon having done something wrong. He didn't do anything wrong. Now, of course, you need to remember that he didn't sink the business intention. If this was a scheme to defraud the creditors by shifting the company when he knew that the company was in trouble, then the outcome would have been completely different. But there was no evidence that Solomon was complicit in any problem, that he was running the business poorly or anything like this. It was his bad luck. And it is logical that the people who were at the losing end, they would try to test this in court to see what happens. But also it is logical that the court found in favor of Solomon because he did what the legislation allowed him to do. The value of the company is determined by the assets that it's got at its disposal. If the company seemingly has got some stuff that are valuable, maybe it's got some stock, maybe it owns the building, maybe they've got some vehicles or whatever it is. These days they might have IT equipment or whatever. But if you try and sell all this and generate an amount of money, if the money that you owe is way in excess, then you cannot satisfy everybody. So inevitably some people are going to lose out. Now the method by which you determine who gets what in what proportion and how do you put people in an order to figure out who gets paid first and who gets paid second, this is something that we deal with later on. Because there's a developed system to allow you to do this. It's not like at random somebody decides who gets the money. But when a business goes bust, it goes bust because the money it owes is in excess of the assets that it's got at its disposal. It is as simple as that. Separate corporate personality is now nailed down. We know that this exists. We know that the company is a separate creature in the law. It's as if another person has been born. But it hasn't been born by somebody giving birth to somebody. It's been born by a legal act. And we also know that limited liability, that could be one of the added functions of a corporation, is in fact real and it is respected. Not everybody, not all countries in the world have the same understanding of limited liability, but it is a very popular concept. So the majority of private limited companies around the world will operate with the same logic. So it has become an essential component of capitalist market organization. It is very difficult to run effectively a market economy without corporations that benefit from separate personality and limited liability. It could be done, right? And it's been done in the past because civilization existed before the Victorian era where all these things came on, but it would make the economy look very, very different. Now let's take a step back and think about what goes in the inside bits of a corporation. Every company has a constitutional document in the same way that every state has a constitutional document. Why you have a parliament, what the parliament does, why you have a government and what they do, what the judiciary does, how these elements link with each other in order to govern the place, right? Everybody has this. Now in this country, because we're so chill, we thought it's funny not to have these things written down. In other countries where people have a more healthy appreciation of their relationship with the government and they don't trust them, they've got it written down in a document. Now, what everybody does and how they do it. Corporations usually involve more than one person. It is never a good idea to do any sort of business without having things expressed in writing. You will remember that it's not a requirement in English law that contracts are in writing. It's possible to have a contract that is oral, fine. Possible it may be, but it's not a good idea. Because once you start arguing about who's doing what, then A, you have difficulty proving it if it's not in writing, but even if you can prove it because you're recording everything, for instance, where everything was by WhatsApp messages, it might lead to ambiguity and confusion and trouble and dispute. So having things expressed in writing is a great idea. In order to create a company, this is not a nice thing to have, it's an obligatory thing. You need to have things in writing. Therefore, every company has what we call a constitution, which contains a series of documents. One of it is very mundane, is the Memorandum of Association, which is just a kind of pro forma thing that says, hey, we're happy to set up a company. It doesn't really say anything of value. I mean, not these days. Historically, it used to tell you a little bit about what the company is supposed to do. But now the memorandum is a simple statement that says, yes, we assent to set up a company as the initial subscribers, which means the initial set of shareholders. What the company is supposed to be about, you can include in that, but also the government asks you to pick a designation. It's like a keyword, a specific code that says if you're engaged in this type of business, use this code. You know, number 1 means this, number 2 means that, number 3 means that. You can pick one just to give people an impression of what your business is about, but it's not the end of the world. I picked the wrong one. So when I was going through the list for my company, I thought, I'm doing educational consultancy. It's not really featured anywhere. I picked one for consultancy. Wrong one. The one I picked was for kind of geothermal surveys and kind of digging up the ground and taking samples at times. Do I do any of this? No, I don't. Is it a problem? No, it's not, because nobody really cares. It's got no legal consequences, just for classification of the company's house information. So the memorandum that used to ask, what is it that you do? It doesn't really matter. You can put whatever you want. The other one is more important. The other document are the Articles of Association. So if you try to think it in relation to what is the government's constitution, so how is a state run, if you had a written constitution, in our context for companies, these are the Articles of Association. These say very clearly who does what and how they do it. So it's going to tell you what are the shareholders supposed to do? How are they supposed to make decisions? How often do they meet? How do these meetings take place? The board of directors, who are the executive body of the corporation, there's information in there that says, how do you become a director? How do you stop being a director? What is a director supposed to do? How does the board come together? How do they make decisions? What happens if there are disagreements between them? How do they communicate with the shareholders? What authority do they have in relation to the outside world? Lots and lots and lots and lots of information, which is obligatory to have and very important. Now you must be thinking here, hang on a second. If I'm starting in business, I've got a business plan, I've got perhaps a product, I've got an idea for some clients, maybe I've been doing it on my own for a little bit as a sole trader, and now I want to scale up by setting a business. I'm focused on the substance of my business. I don't really know anything about that stuff. So what am I supposed to do? Am I supposed to just kind of sit down and think, okay, Articles of Association, Article 1. I don't know, somebody makes decisions. Article 2. I don't know, we ask each other how to make those decisions. It's not a document that one can just write. I'm guessing you could ask ChatGPT, give me a sample set of Articles of Association for a corporation in this country, and it would do a fantastic job. But you don't have to actually do this, because the legislation provides you with a pro forma. We have what we call model Articles of Association. For the type of corporation that you're after, you have model articles for a private limited company, for a public company, for a variety of different forms that you got between those. So you can actually pick, this come in a statutory instrument that is attached to the legislation. You can pick the appropriate thing and just copy paste it, and it's fine. If you're doing this online, when you're setting up your company, you will auto-fill in the information of your company at the top and in places where it needs to be, and that's it. You just said, I adopt the model. You're done. So you satisfy the requirements of the legislation by having your constitution written down, but you didn't have to come up with all the details for yourself. Well, you know. Now, if you're thinking, how am I sure that this is appropriate for me? This stuff is super generic. So there isn't, unless you are trying to do something out of the ordinary, and you would know if you're trying to do something out of the ordinary, there is absolutely no problem picking the model Articles of Association. When I set up my company, I just clicked, dang, done. I didn't even click the thing to open it because I knew what it said. So there's absolutely nothing to personalize unless you already have a purpose that you know needs to be expressly written there. Yeah, so you don't need to change the model that they give you. It's perfect. Now, if there was something about your company that you know makes it distinct and needs to be written down, then you can go and amend. You want to impose limits on the decision-making power of the director. It could be that you're a small company, but there are quite a few people involved. Let's say 5 or 6 of you are setting up something. All of you are going to be shareholders, but only 3 of you are going to be in the board of directors. Now, as a group, the 6 of you, you're a little worried that the directors might go off the rails and start doing stuff by themselves. So you can put in the Articles of Association something that says, any purchase decision with a supplier or any contract negotiation that goes above a certain value requires approval or requires shareholder meeting approval or something like this. This is not by default in the model articles because most companies do not need this. I don't need this because I'm the sole shareholder and the sole decision maker. So I'm the director, I'm also the shareholder, I'm everything by myself. I'm not going to argue with myself, am I? Maybe I am. But I should be able to resolve it with myself without having a process in the Articles of Association to force me to do it. But if you know already that there is something like this you want to take care of, you can have it expressed right there and then by amending the model Articles of Association. And that you're allowed to. If you are trying to get information about an existing company, you can extract their Articles of Association because these are public documents. So the constitutional documents of the company are public-facing documents. If we are doing this in the context of study, and I tell you, this company, you're dealing with this company, was established in 1984 or whatever, just be mindful that if I tell you that it was built on the model Articles of Association, you need to pick the model as it existed at the time that the corporation was set up. Because the model changes, they upgrade it every few years. So what is the modern one right now might not necessarily be the same as the one that they had in 1984. So you might need to look at the historical version of the model Articles of Association to see exactly how that company was built. If you don't have if it's not a real company and you don't have the exact information. If it's a real company, you can go look it up and get the actual Articles of Association. In terms of the legal environment that informs how businesses are run and how they operate, there is, of course, the law outside, but the most important documents are the documents that the company has produced for itself. So the constitutional documents of the company, primarily the Articles of Association, are the most important source of information about a company. So you should always start there. Now, what happens if they amended the articles and they put something in there that is not allowed by law? Well, this is not applicable. It's not going to work. It doesn't negate their entire Articles of Association. It just means that if you come across something in the articles that the law actually prohibits, then nobody can rely on that provision to achieve a particular outcome. Do people argue about the Articles of Association? Normally not at the beginning, because setting them up is usually not a controversial process. What happens is when they attempt to change, and we're going to see later on what is the process for changing the Articles of Association if you want to change something or include a new provision later on. Since the company is a legal fiction, it cannot operate by itself. Now, of course, these days, you can get something that is not human to communicate with you just fine, because you could feed your Articles of Association, the company's objectives, all the company's literature into ChatGPT, and then you can role play with ChatGPT. So you can feed all that information in there and then tell the AI that you are the company director and I will be a supplier, let's negotiate a contract and see what happens. So in that sense, now, even though it's a legal fiction, it can talk to you and it can negotiate with you. But from a legal point of view, it may be a separate person in the eyes of the law, but it's not a real person that can actually interact with the world outside. In order to interact with the world outside, it needs to do this through a human agent. Maybe they're going to change the law in the future to say that it's no longer a legal fiction in the sense that it requires a person. It can actually run itself. So the company is technically a legal fiction, and still is, but it requires a human agent. Who is the human agent that does stuff on behalf of the company? It will be the company's directors. The directors can operate as a unit, as a board, because when all the directors are there, it's called the board of directors. This is the decision-making body of the company. But the directors can also act independently. If you're dealing with a company, how do you know who is responsible for making decisions? If somebody comes with the title of director, you know they're the boss and you can talk to them and you can get stuff done. Anybody who has the title director is technically authorized to represent the company and enter into the deals on their behalf. People who are they're not directors, but they're part of the management structure in a bigger corporation, they will usually represent themselves to the public as having the opportunity to contract on behalf of the company. If you're trying to do a business with Amazon, I don't think you're going to talk to Jeff Bezos, but you don't have to talk to the big boss. You don't have to talk to the CEO. You talk to somebody within the management chain that has authority to conduct deals on the thing that you're trying to talk about. And they will be upfront about this. But do not assume that anybody who works for a corporation is authorized to speak on behalf of the corporation. Can I enter into contracts on behalf of the university? I might be able to if the circumstances allow for it. The head of school during a meeting tells me, here's the company credit card. We ran out of juice. Run down to Tesco and get us some juice. If I go and purchase at Tesco some juice and I pay for it with a university card, we might be able to assume that, of course, I wasn't buying for myself, but this is a retail setting. Since I use the card of the university, an assumption has been created that I'm an authorized representative for this transaction. So if I came back to the school carrying raspberry juice, bring it back, and then we got into an argument with Tesco as to whether I was authorized to carry out the transaction already and who is responsible for paying for it. It might get a little bit tricky, but I don't think it will be a real issue. I cannot, however, ring up HP and say, I would like new laptops for everybody. Why would I? I know I work here, and you can Google me and you find that I work at the place. But why would a random employee have the authority to carry out significant purchases, things that should be part of a procurement process in a bigger corporation? If something like this happens and they go for it, it should have been obvious that I'm not an authorized representative, therefore it's their fault. So the contract created will be a contract, but it will be a contract personally with me that I put in the order, not the university. So if HP invoices the university for £100,000 for new IT equipment, the university is going to say, we don't know what you're talking about, and we're not going to pay that. And they will be able to come after me, who's the person that concluded the contract, but I won't be able to pass it on to the university because I did something random. If somebody who's in the board of trustees of the university, that would be the equivalent of a board of directors, calls HP and says, our vice chancellor has too much to drink, and then rings up the Apple store and says, new iPhones for all the kids, then the university would be bound because as he's the boss of the whole place, there's an assumption that he's authorized to do this. If he made a mistake, and if he violated some restriction that is within the internal documents, within the constitution of the company, then that becomes an internal issue. So people internally can go after him for what he did that was wrong, but they cannot negate the contract with the Apple shop. So I hope you understand the difference, that there is a difference between people who are understood to be authorized representatives because they have an official title, or people who are within a management chain that creates an expectation to the outside world that they're allowed to do this, and kind of random people who are somehow associated. But the company needs the authorized representatives to be able to interact with the outside world, because otherwise it may be a real person in the eyes of the law, but it's got zero capacity to interact with its environment. And you will notice that if you see any document signed with a corporation, or you see a contract done with a corporation, it will say signed on behalf of the corporation. So when I sign a contract with a customer of mine for my company, I will not sign as Yannis, I will sign as Yannis representing the company. So they know for sure, and it's nailed down in the documentation, that I'm not, in this instance, I'm not acting in my personal capacity, but I'm acting on behalf of the corporate entity. Now, this stuff is normally not very difficult, but it does generate disputes when somebody has done something wrong. And it generates a great deal of internal disputes when people within the company have figured out that the bosses have actually made some mistake or violated some restriction that was in place because, people were worried about this. But you will need to be able to distinguish between mistakes that are internal problems and are resolved within the confines of the company and mistakes that actually have external consequences, and you can ring up the supplier and say, this wasn't us, so don't send us the laptops or whatever it is. Agency is the mechanism in the law that allows you to represent somebody else. Perhaps it's worth just to say that you can be an agent of somebody because you're directly authorized and you market yourself as such. You say, I'm here, like you go see an estate agent. This is a direct, overt relationship of agency. The agent will take you and show you a house on behalf of the landlord. That's the whole point. Or you're an actor and you have an agent to represent you and get you into deals. Again, they will be upfront about that relationship. Sometimes you have such an overt expression of the agency. Sometimes it's implied by circumstances, as for instance, you being a company director. You don't have to tell people you're there to represent the company. The fact that you went as a company director is enough to convey that message. Sometimes you got agencies that are not disclosed, which gets a little bit trickier, because then you think you're dealing with one person, but in fact you're dealing with somebody behind them. Most of the time when you're dealing with corporate entities, it's not a problem because you know that you are trying to deal with a corporate and not with an individual. When you go into the Apple shop and you try to buy an iPhone, you're not buying the iPhone from Mohammed who works there, okay? You're buying the iPhone from the Apple shop. If you wanted to buy from Mohammed himself, then you would buy on eBay. So if it's a private seller on eBay, then you're buying from that person. If you're buying from a sales representative in a shop, you're not buying from the person, you're buying from the shop. The important information about corporate capacity is that any restrictions in the ability of the company to carry out actions do not have consequences on external parties unless the external parties have been told explicitly. If I go and negotiate a deal with somebody and I say, in order for us to sign this needs to go through the Board of Governors, get approved, and as soon as I get that approval, then we will be able to proceed, the third party is aware of what's going on. Therefore, if I call them the next day, let's say, yes, I want the deal done, and they ask me, did you get the approval? And I tell them, whatever, it's going to come anyway, don't worry about it. Then they're in the know that a process has not been followed. So then this does not result in a valid contract if, in fact, there's been some internal violation. But they are under no obligation to ask. And that's important because in previous versions of the law, because the company's constitutional documents are public-facing, there was the assumption that the public had constructive notice. It means that you are assumed to know something because it is in the public domain and you have the opportunity to figure it out. So the old versions of the law put the burden on people dealing with companies to look them up and figure out for themselves whether they're allowed to do stuff or not. This isn't a great idea because first of all, nobody actually does this. And secondly, it puts an inappropriate burden on people when they're trying to conduct business. So the modern version of the law does not put any burden on a third party. And the third party only participates in whatever trouble he's got if they're actively complicit or they've been told about it. Sometimes they're complicit because it's a little bit of a scam going on. But otherwise, any third party that deals with a company is dealing in good faith, and any contract that is concluded by an authorized representative will not be invalidated by any internal irregularity. So even if the Articles of Association say the board is not allowed to purchase anything that costs above £50,000 without obtaining the approval of the shareholders in writing, and one of the directors goes and buys a van for the company, which is in clear violation of this, the contract with the car dealer is still valid. It is a clear violation of internal rules, but it has got no consequence on the car dealership. It is an internal problem, and then the company can go after the director for not having respected the rules in ways that we're going to see in the future. The reason for this is Section 40 of the Companies Act, where it says that third parties do not have to care about internal violations. We're following on from the discussion that we had in the previous presentation about limited liability. Everybody remember Solomon? We tried to introduce the idea of limited liability. In order to do this, we talked about the case of Solomon versus Solomon, which is a case back from the Victorian era, where the courts had the opportunity for the first time to discuss and nail down what are the consequences of separate corporate personality and limited liability. What happened with Solomon is that he took his business and transformed it into a company running the business. And he went through all the steps that he needed to do this, arrange the financial arrangements in a way that the company acquired the business and then was running it. When eventually the business got into trouble and it failed, a lot of people got upset with Solomon, because so far as the outside world was concerned, they always did business with the same person. If you're renting from an association and your landlord is a corporate entity, and you've always dealt with the same people, the same phone numbers, the same email addresses, the same contact, you do not care who's in the background. So if you are at the receiving end of a service, you don't really care. Well, you should, but in practice, you don't really care who's the entity behind. So if who is running the association keeps changing hands and goes to different corporate entities, it will not necessarily have an impact on the experience of the people who are renting this accommodation. So in a similar way, the employees, the suppliers, the creditors, everybody who was doing business with Solomon did not experience any difference when the legal situation changed and the business shifted from being owned by an individual to a business owned by a corporation. And we discussed how the court, when this was challenged, had the opportunity to say, yep, this looks weird, but the intention of the legislator was to create a new creature in the law that has its own rights and responsibilities, and the legislator gave that creature the opportunity to benefit from limited liability. The end consequence of all of this is that if the creature dies, you cannot, if you have a claim against them, you're a supplier that didn't get paid, you're an employee that didn't get wages, you're a pension fund that didn't get funded, whatever it is, you can only access whatever assets are owned by that creature. You cannot go after people who are associated with it. You cannot go after the people who run it in their capacity as, say, company directors. You cannot go after the people who own it in their capacity as shareholders. And there's an element of injustice in there, because usually the people who are hurt by a corporate insolvency are the people less able to defend themselves against the consequences of that insolvency. Why am I telling you this? Because the people that make loans to a corporate entity, they will usually be putting provisions in the paperwork that puts them first in line if something goes wrong to collect the money. So the big creditors, the big suppliers, the big banks, the big investors will be first in line to pick whatever's left when the company has failed. The people who were supplying the toner for the printer and the printing paper and the toilet paper and the sandwiches, usually didn't have anything in the terms and conditions of their invoices to elevate them in this order of people getting paid. So they're left there at the end. And if a business has failed, it's failed because it ran out of money. So whatever assets are remaining in terms of kind of physical assets that need to be sold in order to generate some money, they're unlikely to be very many to satisfy everybody. So the people at the end of the line end up losing out. So this feels unfair. And certainly if you are in that position, it feels unfair. Say that I do some work for a corporate entity, like a publisher hires me to do a promo video for them, right? We have a contract, it says I'll do the work, they'll pay me when I invoice them. I do the work, they tell me they're happy with it, I send them my invoice. A few weeks down the line, I haven't been paid. I try to kind of email them to see what happens. I get back an out of office that says, unfortunately, we've gone out of business. Is my invoice going to get paid? No, it's not going to be paid by them. They've gone bust. Is somebody else going to pay that invoice? No. Now, Barclays Bank down the line, who may have given them £100,000 loan and had some security over the physical assets that the business owned, will probably recoup a great deal of that loan. Then they're going to pay my invoice. I'm last in line. So unfair, it may be, and it seems to be, but this is what the legislator intended. This is what the court says. The court doesn't say it's fair or unfair. The court says, is this according to the law or isn't it? It is according to the law. That was the intention of the legislator. The outcomes are happy for some people and happy for other people. As with every other law, if you have a problem with it, go to your MP and argue to change the law. There are a lot of laws that we are unhappy with. What do we do about it? We try to influence the decision makers in Parliament to change them in a different direction. You guys are aware of the work of the Law Commission, for instance? That's what they do for a living. I mean, there's an entire body of legal experts whose job is to review the law and recommend changes to make it work better. Or if they discover unfair outcomes out of the operation of the law, is to recommend ways in which it can be fixed. So it's the normal process of legislative creation. What do you get in return of having that risk? You get information. So everybody knows now that if you deal with a corporate entity that is protected by limited liability, if it goes bust, you start to lose out. This is less of a problem if you know about it in advance. What does the bank do to protect themselves? They will take a security measure in the contract that puts them first in line. And we're going to see in later presentations how this can be achieved. So the bank has ways to do it. Big creditors, investors have ways to do it. How can I protect myself if I'm a small supplier? It could be you get somebody else to guarantee the transaction. If at some point one has to rent private accommodation and you're students, meaning you don't have an income that can demonstrate an independent capacity to meet the rental obligation, very often the landlord or the estate agent is going to ask for somebody else to act as a guarantor. Meaning you get your parents usually to sign on to say that if you're unable to meet that obligation yourself, then they become primarily responsible for meeting that obligation. Why does the landlord ask for this? Because they want to protect themselves against the possibility of not being paid. You can use the same technique if you're dealing with a corporate entity. It could be that the people you're dealing with are wealthy, but you don't know whether the corporate entity itself is as wealthy, or you don't actually know the details of their finances. If you're worried about it, you could ask somebody to provide a guarantee. In the corporate environment, who could that somebody be? Well, most usually the people running the company. If we're talking about small outfits, it's likely that the shareholders are also going to be the directors or the decision makers. If you tell them, I would like to do business with you, but I'm worried about the consequences of limited liability on me if you cannot pay my invoices, would you, as a company director in your personal capacity, offer a guarantee that if the company cannot meet its obligations, then you will pay? If you're willing to do this, then I'm willing to do business with you. Everybody wins. So this happens very often. Why do people ask for this? Because they know the consequences of dealing with somebody who's protected by limited liability. What else could you do? There are some simple things that you can do of a commercial nature. You could be asked to be paid in advance. So if I sign a contract to do some work with somebody and they knew like I don't know them, I don't know how big they are, or I don't actually want to spend a lot of time kind of figuring out what the finance position is, I could ask them to split the payment. So they pay me 50% in advance, so I know that my expenses have been covered. If I need to spend, say, 3 days working on something, if they pay me 50%, that covers my expenses. If then they cannot pay me the rest, well, I won't give them the product of the work, so they didn't actually get something for free, but I've been compensated for my time. If I give them the final thing, so if they want to proceed and they approve everything, and then I wait to be paid the rest of it, if they go bust in the meantime, and at least it's not a total loss for me. So I may not have been able to retrieve I may have lost my profit margin, but at least I got something. And you could negotiate something in between. You could say, I want to be paid 2/3 in advance and then 1/3 on delivery or something, or on approval, right? The people who are on the other side, the corporation, they will know that people will be worried about the effects of limited liability on doing business with them. So they might actually be willing to pay up front. Why do you pay up front for your flights? If you do like a booking, very often they will ask you to pay up front. It's because they don't trust you to have the money between now and the time it comes. And maybe they will also like to collect the money in advance so they can invest it somewhere. But knowing the risks involved coming out of the nature of the person that you're doing business with gives you then mechanisms and opportunities to address this. So what you get in return for the protections that the company gets out of limited liability is information. You can go up to company's house and you can figure out who is this, where is this company, what's its address, how do you contact them, who are the people behind it. You get the names and addresses of the directors so you can contact them. You can find information on their constitutional documents. You can download their articles of association. You can get basic information about their financial position because you can download, even for private limited companies, an abbreviated version of their accounts. So you can tell how much money they're turning over. So if my personal company turns over 3,000, 4,000, 5,000 pounds a year, and I'm doing a deal with somebody, the value is a couple of £1,000, then there's no reason to worry because this is consistent with what I've done in the past, and this is the nature of this company. If my company has been turning over 4,000 or 5,000 and suddenly I'm negotiating a deal that's worth 100,000, somebody looking at my financial statements should worry about this. They should be thinking, how can a small company fund such a big project? And are they going to be able to deliver on this? Or are they being kind of unrealistic about their capacity to deliver? Therefore, maybe I should be a little bit careful before contracting with them. If they fail, they're taking on such a big project. If they fail halfway through and I've already made some payments, I'm going to lose those payments. Right? So again, what you get in return for the protections of limited liability and separate corporate personality is information. Now, if you choose not to look at this information and not to take this seriously, then that's on you. And you've made perhaps a business mistake, and there might be consequences coming out of this. We've also discussed in previous presentations how companies perform actions. The consequence of having a virtual entity is that it cannot actually do anything in the physical domain in the real world without being helped by somebody. So we've seen how companies operate through agents. Most usually the authorized agents are the company's directors. So it's normal that, especially for a smaller company, when you're dealing with the company, you're dealing with somebody who's in a position of a company director. But there's a side to this. We discussed already issues of corporate capacity, like who is entitled to represent the company and in which ways, what would be the consequence of various errors on third parties, what happens if there's an internal violation, and how does this affect a contract done with a third party. What we said is normally third parties don't care about internal violations. So anything that goes wrong internally will not necessarily alter anything for the outside world. But there's another side to this that we need to explore, and we're going to do this right now. There has to be some line of responsibility when something goes wrong. So there has to be some way that we can attribute liability for nasty stuff. Companies don't only do good things, and they don't only do things intentionally. right? What is the difference between intentional obligations and unintentional obligations? You walk in here, you're expecting a class. Instead of delivering a class, I explain to you guys how to make the best grilled cheese. You're sitting in here, you're thinking, okay, we got dinner sorted. However, we're paying for this, and we were paying to be taught company law in some fashion or other. Why is this guy talking to us about the recipes? Your expectations are not met. You could argue that this is a contractual fraud. If this was a one-off that you had signed on for one workshop on business formation, and you got a one workshop on grilled cheese making, you wouldn't be happy. You would ask for your money back. The reason for this would be inadequate performance, that you got something radically different from what you were expecting. This is a breach of contract. So we would need to refund you for not giving you what it is that you signed on for. If you walk into this classroom, not because you're a student, but you're a sibling of a student, and you asked if you can bring your brother in to have a look what how boring university is. And as your brother is sitting there, the lights become detached and whack him on the head and ends up with a serious head injury. The university has an obligation towards that person. Why? Not because they were contractually obligated not to kill them, but because this is negligence on the person who controls the space that has caused an accident. Therefore, on the basis of the law of tort, the university will have an obligation to compensate the person for the consequences of this injury. So one set of obligations are intentional, one set of obligations are not intentional, and they come from tort. That's terrific, but it works very well when you're dealing with people and you can attribute liability because somebody has done something specific. If the landlord is like a named individual, you know who you're dealing with. If the person that you contracted with to deliver the class is a person, again, you know who you're dealing with. What you do, though, if it's a corporate entity, so we need to have a way and a mechanism to attribute liability for things that the virtual entity does and to have real-life consequences. This comes through the liability for corporate acts, comes through the doctrine of what we call vicarious liability. This means that we basically make somebody else responsible for the actions of other people. Why? Because the other people were acting on behalf of this third party. I'm delivering this workshop because you contracted with my consultancy company. I am not here in my personal capacity. I'm here representing a university, representing a corporate entity, representing somebody else, not myself. And because I am here on behalf and representing somebody else, whatever I do wrong, either in a contractual or a tortious fashion, is not my personal issue. It burdens whoever put me up to this. Might be my employer, it could be my contractor, but I was here on behalf of somebody else. That somebody else becomes responsible. So we have the link between a virtual entity, a corporate entity in the legal domain, actually affecting things in real life through the actions of other people. A corporate entity will be responsible for the actions of their agents so long as the actions of their agents are related. If you contracted with my consultancy company to come in here for this workshop and there's something wrong with the delivery of the workshop, then the company will be responsible. If while I am carrying out this workshop, I demonstrate a relaxing technique specifically designed for students of company law, and I break your neck while I'm demonstrating this technique, again, the employer will be responsible. If after the workshop has finished, I take you out for a drink and I get you drunk, and then I drive you to a dark alley, dress you up funny, put pictures on Instagram, and disgrace you amongst your family and friends, then the employer is not responsible because that part of harmful action was not related to what was contracted. So long as the actions of the agent are linked to what they're meant to be carrying out for their superior, for their principal, then that principal becomes responsible. If the actions are unrelated, then of course, no. But you cannot get away with it by saying whatever went wrong is because the agent did not perform his tasks correctly, right? So, of course, if I'm a contractor, if I'm an engineer and I come in here to attach those lights and this IT equipment, and I do it badly, the instruction for my employer was not do a terrible job installing a projector, right? So the employer cannot get out of it by saying, we instructed this person to install the projector correctly, they installed it incorrectly, therefore they were acting outside the scope of their employment, therefore when the projector falls on our new colleague here and kills him, the corporate, maybe you want to move, maybe the corporate is not responsible. You cannot say this because the installation was done at the instigation of the company. If the installation is poor, it's an issue of negligence in carrying out the act. It's not unrelated to the work. But, if the worker then meets you down the street and knifes you, this has got nothing to do with the performance of installing IT. Criminal liability works in similar ways, but it gets a little bit more complicated. So you remember all this business about mens rea and actus reus and all. The problem here is, yes, we can have the performance of criminal acts by corporations in a variety of spectacular ways, right? I could hire you guys to go and beat up those guys, right? Which is, it would be a criminal when you actually contracting you to do it is conspiracy. So that's a crime in itself. You carrying it out would be, again, a crime. I would be involved in the conspiracy as well, but it's also a variety of other crimes in carrying out these acts. So that's the actus reus. But how can we attribute the mens rea to a company which is a virtual entity? There we have difficulties because criminal law has been built on the assumption that one person does something bad to another person that the law prohibits. The idea of a collective of persons doing something is covered perhaps by laws on conspiracy, but again, it involves individual decision makers. So it doesn't really work if you say that the company hired people to go beat somebody up, but there is no mens rea because there is no independent mind in the company itself. The only way that you could do this is if you manage to prove that one of the directors of the company actually ordered the attack. But this is very, very difficult to do. It's very difficult to do because companies don't actually operate in that way. Very often, companies will be held responsible for criminal action arising out of negligent activity. Disregard for health and safety is the number one example. Very often, you've got companies accused of criminal actions because by not paying attention to health and safety, they led to people being killed or injured. But there is nobody at the corporate level who's going to say, take out the seatbelts from the car. They will just create a culture of not paying attention to health and safety issues, not maintaining things, etc., to save money, which eventually results in some sort of accident that is the fault of the company and it comes out of negligence, but it's not the result of a deliberate act. It's not like, you know how much money we could save if we took out the signals from the train line? Let's do it. Right? And then you have a major rail accident. That's not how it happens. So, yes, you can attribute criminal liability to corporate entities, even though they are immaterial, if you manage to link a decision maker to the particular action. So then that satisfies the requirement of mens rea. And because they're acting on behalf of the corporation, then that mens rea infects the corporation itself. Since it doesn't really happen, the way to do it is not that. The way to attribute criminal liability for corporate acts comes through specific types of legislation. You guys remember the Grenfell Tower? It was interesting. I could see it burning from my house. And we were like, this doesn't look good. And in fact, it was a lot worse than what happened was a lot worse than what we thought was going on when we were looking at it. Right? Because a lot of people were trapped in the building that was not obvious till a lot later. Now, there was an issue very early on, when they discovered how many people had lost their lives in that building, of criminal liability for the corporations that were responsible for building, maintaining, accessorizing this building. The reason why this building burned in such a fashion so quickly is because it was built in a way that actually facilitated a fire risk rather than preventing a fire risk. So it caught fire very rapidly because of the things that they had put on the outside of the building to make it look nice. Very quickly, people said there's got to be criminal responsibility for either the council that owned the building or the company that was running it or had run the renovations. This type of criminal liability does not come through the traditional areas of attribution, because there they made a mistake in building materials. And it was to diffuse a situation to be able to point the finger at the specific decision maker that then links with the outcome. It wasn't possible to find an executive that said, I've looked at these panels have lower safety gradings, but they're cheaper, therefore we will buy those, not caring about how they're going to perform in case there's a fire. You cannot find this. So then you cannot use normal criminal law concepts in order to attribute criminal liability. What they tried to do instead is to test the idea of corporate manslaughter, the specific legislation for this, that criminalizes not particular actions, but criminalizes a deficient culture. Because this is what causes industrial accidents. It's like a deficient culture and disregard for health and safety that then creates the circumstances in which, mortal accidents can take place. It didn't work in that case. I've written an article about this. It was discussed a lot at the time, but it wasn't really suitable for what was going on over there. Then, of course, what happened is what always happens. When the government doesn't want to do anything, they set up a committee. The committee investigates for about 10 years and then comes up with some woolly recommendation that never gets implemented anyway. Criminal law was not going to help us because criminal law isn't quite equipped to deal with these types of problems. And company law cannot help us because the attribution we've got for corporate acts doesn't really work well for criminal. Are there any circumstances in which the courts have actually sided with the people that found themselves in the position of Solomon's creditors and said, this is scammy, this is wrong, this shouldn't work? Because we are now confident that separate corporate personality exists, we're confident that limited liability exists, we understood the consequences, we talked about how information about it can help ameliorate some of the more negative consequences. So, all that is cool. We talked about attribution for negative things and how it can link back to the company both in a civil and in a criminal sense. But surely there are people who try to abuse this. And surely there's going to be some mechanism in the system where the veil of incorporation can be lifted. Lifting the veil of incorporation, opening the curtains, that's probably not it. Say a kind of flasher in the park kind of way, yeah? Now, who is behind this curtain of incorporation? Most likely the shareholders. So you are on the front side of the theater because you're the creditors, you're the investors, you're the employees, you're everybody else. There is the curtain. Who's behind the curtain in the stage? The insiders. Who are the insiders? The company directors, the company shareholders. So we're looking for a way to lift this corporate veil so us, the audience, can see to the stage and have access to the wealth of the people that are sitting there behind the curtain. It can be done, but courts in Anglo-American jurisdictions don't like to do it. In the continent, there are way more opportunities to lift the corporate veil. There are also types of incorporation that don't give you full protection from limited liability. I mean, we got some here. If you had a limited liability partnership, you're not fully covered. For instance, you will not cover liability arising from negligence. That's why professional insurance is such a big deal. But in the continent, they've got a wider variety of corporate creatures some of which benefit from full limited liability, some of them don't. In some cases, you can go after the wealth of the shareholders. Sometimes the state intervenes and changes the law depending on the circumstances. But in the UK and the US, the courts are very committed to the idea of limited liability. An example of how committed they are is the case of Lee versus Lee's Air Farming. Lee, awesome dude, sets up a company, one person, because this is in the modern era. It's from the 1960s. So you could set up a sole member company. So Lee is a cross-dresser. Not in that sense, in that he wears a lot of different hats to carry out different roles. He is the sole shareholder, he is the sole director, and he's the sole employee of the company. And he flies a plane. He does crop dusting. You know what that is? You fly the plane over stuff and drop pesticides so that the stuff that you eat are not organic. Yeah? Consequence is they cost less and they're not eaten by bugs and all that. Yes. So you have to go out of your way to get lower quality products that are organic. Anyway, that's what Lee does for a living. Unfortunately, Lee crashed the plane and died. When his wife went to collect on insurance and stuff, the insurance company said, nah, we're not going to pay. Look at all this. This is all kind of messed up. It's like one man is a one-man band. What's happening here? He's the employee. He's the shareholder. He's the director. He's the everything. This is not right. Comes back from the New Zealand Court of Appeal, comes back to the Privy Council here. You guys know what the Privy Council is? It was the House of Lords, now the Supreme Court, when it's sitting on a case that has come from overseas. The court says, we don't care if he's the same guy. He occupied different roles. He was wearing different outfits. It's like the village people all rolled into one. However, there are cases where something inappropriate might be happening. The best example of this is the case of Adams versus Kate. And I would recommend that anybody who is interested in this field or hopes to survive an exam on this field has a look at the case of Adams versus Kate Industries from 1990. And there are a few kind of follow-on appeals to that case. Kate was a company that was mining asbestos overseas. You know what asbestos is? Asbestos is a nasty cancer-inducing chemical that they use for fireproofing. That's why all the old buildings, they had asbestos in these types of panelings that you've got on the ceiling. So in case it caught fire, this thing doesn't burn. You had asbestos lining in the ovens when you bake the bread and all sorts of things. Now, when it was discovered, it was a revolutionary ingredient that you could use for all these things, and it had a lot of very interesting industrial applications, but then they quickly figured out that it was carcinogenic. So it shouldn't be anywhere around. So a lot of buildings have been condemned, completely redone, and so on to remove asbestos. It's a terrible problem. Now, Kate was mining asbestos in South Africa and selling it worldwide. In the US, where he had operations, the workers that were dealing with the substance to produce the products that the company was selling, they got sick. Now, they sued the company, and their argument was that the company knew that this was a dangerous chemical, but they didn't tell us. So we didn't have the opportunity to take adequate precautions when dealing with these substances. Therefore, now we all got sick. And they wanted to sue not only the subsidiary of the company in the US, they wanted to sue the person that's got the money. And the person that has the money was a UK registered corporation. Now, this isn't surprising for multinational corporations. Normally, a multinational is structured in a way that the operations subsidiaries in various parts of the world are the ones that carry out the main part of the business, but they're not the ones that accumulate the majority of the profits. Why? Because usually they try to funnel the profits through the corporate chain to places that they've got the least tax burden, but it's also looking forward in issues of liability. If something goes wrong, it usually goes wrong at the place where they've got the actual operations, the factories, the mining facilities, and so on. It wouldn't be a clever idea to leave all the money there, because if something goes wrong and you've got a big industrial accident, then they're going to have to pay up. If the subsidiaries that are carrying out the dangerous tasks are undercapitalized and the money is with the parent company in a different country, if something goes wrong and they get sued, they're probably going to go bust and they won't have enough money to compensate everybody. Because each subsidiary is separately incorporated, then you cannot go from one to the other. Why? Because all the other subsidiaries or the parent of the group are sitting behind the corporate veil. So normal stuff that they have some subsidiaries with the work and of the money, and some subsidiaries that don't do much, but they've got all the money. Okay. There's no point suing. Okay, there is a point suing because they were working there, but there's no point staying with your legal actions against the American subsidiary because they didn't have much money. So they tried to bring their claim against the British parent, where all the money is sitting here in London. But they have to break through the corporate veil because there's different companies. The way you set up a group structure is that somebody is the owner of the other one, but they're not the same entity. So the British parent was the shareholder of the subsidiary, but they are not the same entity. You have to find a way to lift the corporate curtain to, for all the people in the audience who have suffered the loss, to be able to see on the stage of the theater and grab hold of the people with the money who are the shareholders. So when it came to the courts here, they tried a bunch of different arguments. And that's why this case is important for us, because the case for us represents a very nice breakdown of all the things you could try and say to breach the corporate veil. First of all, they're saying it's a sham. The whole thing was a total scam. That they set up the corporate group in order to evade liability. And they intentionally left the subsidiaries that were having the dangerous operations undercapitalized because they anticipated they're going to get sued. So if they got sued and they lost, they didn't want to have enough money in the bank to be able to satisfy those losses. That the argument is that the corporate group wasn't a genuine corporate group. It was a facade. It was fake. It was like smoke and mirrors to divert liability. Right? So that's one argument. They also said that the whole behavior was fraudulent. So this is a similar argument. You can say that either it's a sham, it's intended to divert, or it's directly fraudulent, like they know they've got liabilities already, they're trying to hide away from by rearranging the corporate structure. Then they said, in any event, there has to be an agency relationship. So even though they're separately incorporated entities, the entities in South Africa and the US were working on the directions of the British parent. So they were telling them what to do. They've got command. So if you've got command over the actions of another, the other then is considered an agent. So what happened to the American workers was not the fault of the agent, was the fault of the principal who sits back here in the UK. They also tried to argue that it is improper, that we have a huge injustice being done. It's a nasty corporation. It knows that people were being harmed by their activities. They chose to do nothing because they were hiding behind the corporate veil. And in the interests of justice, considering all the elements involved, the corporate veil should be lifted, and these people who suffered those consequences should be able to come after the parent here in the UK. Now, what presented with those arguments and considering the nasty situation that's being described, what would your position be? Do you think that the court should have lifted the corporate veil and allow the claimants there to access the money of the parent here in the UK? The court said we cannot actually find anything that breaches the law here. So the court said, if it's fraud, you have to prove fraud. And fraud has a different proof requirements, by the way. You need to, if you allege fraud, then you need to prove it beyond reasonable doubt. So you're treating it now like a criminal action. So you need to convince people that it's more, not that it's more likely than not, that it is said that they were running a scam. So they didn't have evidence to prove fraud. To say that it was a sham and it was a misdirection, they needed to prove enough of a connection in the command structures between the subsidiaries and the parent, in a similar way that they would need to prove agency. And they didn't manage to do this because the organizational structures were distinct enough to give, at least in law, the appearance of independent decision-making. So you are allowed to have coordination and business strategy in a corporate group. But so long as each subsidiary has a different independent board and a different set of objectives for itself, they might be aligned to the group objectives, but they have control as to how they meet those objectives, then you do have a distinct entity. So the claimants were not able to prove that the British parent was directly responsible for the decision-making of the subsidiaries in the other countries. We're not saying here that they didn't win in the US. They won in the US. But they didn't want to win in the US because the US government didn't have any money. But the argument here is not, was the US subsidiary responsible for giving these people cancer? It was. The argument is, can we lift the corporate veil so we go after the British parent on the argument that the British parent was directing the actions of the American case? That they did not manage to prove. And in the absence of fraud or impropriety that is, has evidence behind it, or an agency argument that succeeds, there's nothing you can do. So you cannot simply, in the interests of justice, in an ad hoc fashion, change the outcomes that the law is trying to give. The law creates the opportunity for separate corporate personality and limited liability. This is what was happening here. It was properly organized. They could not breach the corporate veil. Therefore, they failed. And there was a big deal about it at the time because everybody thought this is hugely unfair. These are people who have been screwed over by some nasty multinational. Everybody knows this. Yet the law is harsh and does not allow a remedy in that situation. And this isn't one of the situations where equity can intervene or something else. Because in other domains, sometimes when the effects of the common law were too harsh, then you had some sort of equitable principle that you could use in order to try and affect a different outcome. It's something that we see in contracts very often. This doesn't work here. For company law, it doesn't work. So you cannot have sort of equitable considerations that appear as a kind of roundabout way to breach the corporate veil by themselves. Because the courts, maybe Lord Denning was too old at that time to intervene and kind of change something with his random decision-making, but we don't have avenues around this in the interests of justice in the way that we find in other domains, such as promissory estoppel and this and that, right? Because in contract we do. In contract, very often we're like, this is the set of rules of how something happens, but in some kind of funky occasions where obviously the outcome is unfair, we can do something else, and we've got a line of case law that entitles us to do this or gives us some criteria that we can test against this thing. For company law, we don't have this stuff. Either some other pathway is written down in the law directly, or you cannot do it. So they failed in Cape. Does this mean that they will always fail to breach the veil? No, if you can prove it. In Guilford Motors versus Horn, which is a case from 1933, you had somebody who was subject to a post-employment restriction, the kind of stuff that says after you leave your job for a certain period of time, you cannot work for a direct competitor or a supplier or something like this. The person thought, well, I cannot do it, but how about I set up a company and then I do it as the company and then, they won't see me, so it'll be okay. When they went to the court and complained, the court said, nope, this is a direct attempt to evade a legal obligation, therefore you're not allowed to do this. So the person and the company were considered to be the same in that. So this is an example. This is not really lifting the corporate veil to go after the shareholders, but it's an example of the court disregarding the separate corporate personality because somebody is trying to do something inappropriate. Again, in Jones versus Lipman, which is a case from 1962, somebody had a degree of specific performance, which is an order from the court to do something. They tried to get away with it by shifting the assets that were subject to that order to a company and then say, no, I don't have this anymore. I cannot do it. The company has it. The court said, you and the company are the same and you're trying to evade. Again, coming back to the arguments that we came across in CAPE, there are ways to evade limited liability, but these are very narrow. Either you pick up something that exists in a statute that gives you a way around the problem, or you need to prove these mundane things like fraud or agency. You cannot win against limited liability on an argument that the outcome is unfair or it is against the interests of justice. Maybe this is the wrong conclusion. It is probably the wrong conclusion, but that's what the courts are committed to. And all the modern case law that we've got flowing from that are consistent with that outcome. And this is something that gets tested in the courts all the time. Every few years we've got another case where Adams comes up for re-examination. And the court is consistent in coming back and saying, no, we will not lift the corporate veil unless we've got specific evidence. Or you prove an agency relationship that somebody, some entity was acting on behalf of somebody else. Yeah? And then the somebody else becomes the primary responsible. Now, I did mention there are a couple of statutory ways around this. One of them is premature trading. What this means is somebody starts to represent themselves as a company before they've got their registration certificates. So this, by law, you're not allowed to do. So if I have the idea, okay, I'm going to run my business as a company now, and I start sending invoices with a company name to my existing clients before I've set up, then I will be personally responsible for things. Right? So the company could have been created subsequently, but anything that happened before the creation of the company and before I was issued my trading certificate is on me. So again, this isn't really kind of going after the shareholders in the CAPE sense, but it makes somebody else responsible for what seems to be a corporate action. Finally, and again, this doesn't go after the shareholders, but it goes after the directors, is the idea of wrongful trading. If you know that you're going to go bust and you're thinking, well, doesn't matter, let's get some iPhones, right? Because the company's going to go bust anyway. Well, I'm going to be able to pay the bills. Let's leave the lights on, order some new IT equipment. If nobody gets paid, nobody gets paid. There are specific provisions in the law and in the Companies Act and the Insolvency Act that say you are not allowed to throw people's money away if you know that you're not going to be able to repay it. And if you do this, you, the decision maker, becomes personally responsible. So if I think that my consultancy company is not doing well because I took on a big project and then I cannot actually carry this out and I spent money in trying to carry it out so that I cannot now pay back, my solution shouldn't be, okay, let's buy a motorbike so we can go out in style. No, the solution should be, if I know that I'm not going to be able to repay, I stop now and safeguard whatever assets I've got to be able to pay as much as possible for my existing creditor, not to throw away the money of the rest. A burden on the director who disregards the problem and just thinks, let's go spend some money, it doesn't matter anyway. I mean, the obvious intention of the legislator is to prevent people from wasting money. Let's assume that you decide to start a business through a corporate form. We've gone through some of that stuff already. Can anybody remember why you might choose to start your business through a corporate form? So if you don't set up a company to run your business, what do you run it as? If you are with somebody or a number of people, you can do it through a partnership, or you can choose to incorporate. Why you might want to go one way as opposed to the other depends on your intentions, the number of people involved, and what you are seeing for your business in the future. Take my example. I'm running a consultancy. I'm doing this, or I've been doing this for a long time as a sole trader. It means that if somebody wants me to do something, like design some asset, or do a video, or do a podcast, and they're willing to pay me for it, I don't really need to do anything complicated. We sign a contract. I sign the contract as myself. They sign a contract as their business. For example, one of the publishers wants me to make a video for them. So the contract will say Pearson on one end and Ioannis on the other end. We sign this contract. I will produce like a 5-minute video for you guys presenting a topic, and then they can put it on their website. And they're going to pay me, say, £100 for it. It's fine. I don't need permission from anybody to do this. Don't worry about restrictions in employment, whether my employer allows me to do this or not, or whether I'm committed with somebody else in some sort of exclusivity agreement. Employment law issues aside, or any contractual restrictions aside, there's nothing to stop me or you for doing this. Somebody could pay you to put some Instagram posts talking about their business, right? You can have a sponsorship agreement. This happens very easily. If you have like a sizable Instagram account, a business might approach you and say, look, you've been going to the shops talking about the various bags or the various clothes that people could buy. How about you go into Harrods and you talk about our bag that people can purchase from Harrods. Then we'll do a deal and we'll provide a link to the Harrods shop and we'll pay you some money for this. This is a very established business. It happens all the time. You don't need to ask anybody for permission to do this in the sense that the authorities do not need to be involved. You can do this perfectly fine in your own name as a sole trader. When it comes to declaring that income for tax purposes, as I have told you in other occasions, if the income is fairly low and in the year you're not going to make much out of this, you don't even have to tell HMRC. HMRC does not want to know unless the amount of money exceeds £1,000 a year. So you don't even have any tax paperwork. If you do this well and you generate more than £1,000, then you need to register for self-assessment, in which you're going to put your own personal income from whatever you want, but also in the field, in the self-assessment that says, as a sole trader, I've done this, then you fill in that information and it's all a seamless process. If there's some tax to be paid, then it calculates it at the end. It's all done electronically. It's fairly easy. And then it gives you a link. You can go pay with your credit card. No problem at all. So the effect of thinking about your business or your business activity and having it done actually requires a minimum of paperwork here, and it can be done very easily. We've talked about partnerships in the past as well. If there's a group of you engaging together in this, you can just do it by yourselves. You don't need to have any paperwork either with the outside world or even between yourselves, because the law, as we've seen in the Partnership Act, recognizes partnerships as an existing thing. It's a matter of fact. So it's not dependent on you doing paperwork in advance. A partnership is there because you operate as a partnership. So your arrangement will be recognized by the law even though you haven't expressly discussed it with each other or you've made any paperwork to that effect. Now, of course, there are slightly different implications of partnership in terms of tax liabilities, but that comes a little bit later. At the initial level, whether you're working as a sole trader or you're working as a partnership, the money aspect and the tax aspect passes through your personal capacity through the normal stuff that you would do anyway. So it does not fundamentally change your paperwork arrangement if you're working as a barista down in Starbucks or if you're doing some of that work as a sole trader. No problem. Yeah? But you may want to incorporate, and then things become a little bit different. The reason why you might want to incorporate is that you want this formal separation between your personal paperwork and your personal finances and your business finances. We've discussed in the past about the concept of separate corporate personality and limited liability. From the moment that you incorporate, whoever is doing those contracts is no longer you. And because of the protections that come with limited liability, if this new entity that now runs your business gets into trouble, you will lose out because inevitably you will be a shareholder in your own business. So your initial investment as a shareholder will be lost if the business fails. But whoever is doing business with you is limited to this different entity and the money that this different entity has. So if you cannot deliver on something, or if something goes wrong and you have to fulfill or to meet some liability, this liability will only be met by the money of the business. As I gave you this example before, if I'm working as a consultant for somebody or I create some resource for somebody, if I've done it for myself and I used stock footage that I found on the web without getting license for this, and I create a video and I send it to somebody and then they get sued. Can you imagine this? You make a video for the university and one of the Adobe stock or one of the other databases goes, hang on a second, this is our footage there. Why is the university using our footage? Are they a client? No, they're not. It's like, whoa, they're going to sue the uni and the uni is going to sue me because most likely in the terms and conditions of the contract that we had, I took on the contractual obligation to ensure that whatever I give them, I've got the rights to. So if I included something in my video that I don't have rights to, and the university gets sued and I had done something for them, the university then is going to sue me to try and recoup that loss. Is that normal? You're getting worried there because you're thinking my Instagram posts are full of other people's footage. You're not doing it for profit. You can still get in trouble. Now, before anybody freaks out, if you're posting stuff on social media and they contain pictures that are not your own, that you found on the web, do not worry about it. The worst thing that can happen, because you're not doing it for profit, is that they will ask you to take it down. If it is music that you have incorporated into your video, not through the app, because when you put music through TikTok, through Instagram Reels, through YouTube Shorts, then they give you the rights to that music, and the way you know is that the app gave you the music to upload while you were uploading your content. But if you had just put an MP3 file that you own on a video that you made at home and then uploaded, then you're going to get a copyright strike from the owner of that music. What's the worst thing that can happen? You will not be able to monetize that video because the copyright owner is going to say, you're using my stuff, therefore if you make any money out of this, then the money comes to me, it does not come to you. People get in trouble for this. Mr. Beast got in trouble for this. Did you know? Why? For an icon. So for about a fraction of a second, an icon appeared on his video like this. And they made a mistake. They didn't have rights to that icon. So the copyright holder made a complaint to YouTube, and YouTube said, you cannot monetize on that video. We're going to give all the money to the copyright holder because of this violation. And you know, Mr. Beast, the ad revenue on the videos could run into the millions, right? So the people who had that little clip there were probably like, oh. But what's going to happen to you is that A, you cannot monetize if they say you've used copyright from somebody else, or if you've done it a couple of times, then they might take your channel down. But they won't come after you for money. If you are doing it for money, then it's different, then they might come after you for money. So what could happen for me is that if I'm doing this as a business and somebody paid me to produce a resource for them, and that the resource contains a copyright violation, then the copyright holder can sue me for damages. Well, actually, he's going to sue whoever published the video, and then they're going to sue me because in my contract, I had a provision that said I will make them good for any loss that they're suffering as a result of what I've done. And this is very common. If I signed it by myself, and now they paid me £100 for that video, but there's a £1,000 liability arising from the costs of defending the copyright claim, then I'm going to have to pay for this out of my own pocket. If I'm doing it as a corporate, it's still going to be £1,000, but if my company has £200 in the bank account and it's got a £1,000 liability, the company is just going to shut down. And they won't be able to come after me for the rest of the money. Now, this isn't good for me because having set up a company to run my business and then the company goes bust will have negative consequences on a number of things, but at least it won't take the money that I've got to pay rent. So one of the primary reasons why you may want to create this artificial separation and this firewall between what you are as an individual and what your business is, in terms of its finances, its bank accounts, its tax obligations, is to protect you from this stuff happening. So we're talking about the situation where you're thinking, what is the best way to organize your business? And you are not doing anything wrong, and you don't plan to do anything wrong. So forward-looking risk management is okay. And establishing a business, a company that has these kind of protections and firewalls is what it's all about. In the same way that when you buy travel insurance, you don't anticipate and you don't plan to be mugged when you're on holiday, so then you miss your flight or you have to get new passports and stuff. But you're getting the travel insurance just in case something unanticipated happens. Or you don't plan to be stuck in the tube and miss your plane, but you've got the insurance just in case it happens. So forward-looking risk management is fine. What is not fine is thinking, because I'm protected by limited liability, I will do nasty things. If I get away with it, good, I get the money. If I don't get away with it, what's the worst thing that can happen? This company only has £100. If that's how you run your business, then they will come after you for your personal money because of a series of additional violations. You know you're doing something wrong, and you're thinking, how can I fiddle with the paperwork so when they catch up with me, I suffer the minimum amount of loss? But of course, you know, the law can see through these types of violations, right? So if I'm trying to set up my business through a company, I might be doing it because I want to have these separations and I want to have these mechanisms in place to allow me to look forward, take as much benefit as I can out of running the business, but also have some sort of stopover in case things go wrong. When I get to do this, I took the decision to do it, right? To set up a company and transfer my business to the company. What do I actually have to do? The first thing that you should think about is, how are you going to present yourself as a business to the outside world? Because now you're somebody new. So if you're setting up a business, you need to call it something. So step number one, and this is important for your marketing as well. Should you call it by your name? Choosing your own name might be a bad idea. First of all, your name might not be unique. So you might not be allowed to do this because this is there already. I cannot run my business with my name because my uncle he's a wine producer in Greece and they've got a very big winery. So the name is trademarked. So there would be no point in me having a company that's called Glinavos Consulting, because every time people Google it, they would go to my uncle's winery, right? It's not just about owning the domain name and what happens online. It's that technically, if you know that your name is already in use, then it's not going to work out. And you want the business to be a little bit distinct from your personality, because as the business grows, maybe you want to bring in more people. So if you attain partners or investors, maybe something that isn't just you as a person would make it easier for them to join. What happens if you sell it? I mean, for all the businesses that are name-based, you do have a problem when they decide to sell. So imagine Marc Jacobs, who Marc Jacobs by Marc Jacobs does Marc Jacobs. Have you noticed this? Have you ever looked at the label of a Marc Jacobs product that will say Marc Jacobs clothes by Marc Jacobs, made by Marc Jacobs? Like, this is kind of trademark gone mad, right? Anyhow, if he sells it and he's no longer Marc Jacobs, he's still Marc Jacobs himself, but he's no longer associated with a business that carries his name. That sounds like a bad idea. So you should pick something that is not in existence, so you have the choice to take it. You have to choose a name. choosing your own name, not a top-notch idea. But can you choose whatever so long as it's not your name? No, because it needs to be available. I cannot choose to call myself Apple Computers because there's already one out there. Yeah. Not only I cannot choose something that is in existence, I cannot pretend to be affiliated with somebody. So I cannot call myself His Majesty's lecturer, right? Because that implies an association with the state authority. I cannot call myself official Apple or, Samsung subsidiary limited, because that implies an association with somebody else. Now, guys, think, this is not domain name, because you may be familiar with domain name registrations. Domain names is a free-for-all. So long as it's not registered already, you can claim it. I could register Westminster University.io, no problem, right? And then when they come and say, well, you're not Westminster University, and say, I'm not, but I'm willing to sell you the domain name, yeah? A lot of people make money out of this. They register a whole bunch of domain names that sound like a business, and then they don't actually do anything with it. If you do something with it, then they could come after you because you're pretending to be somebody else. So there are rules in the law about passing off or violating trademarks and things like this that they can come after you. But if you register a domain name and you don't do anything to it, and somebody comes and asks for it, you can sell it to them. So they will allow you to register it. They will not allow you to register a company name, the purpose of which is to deceive. Perhaps deceive is a strong word here, but to give the impression that you're doing something inappropriate. Now, what would you choose if, I don't know, give me some ideas. If I am consultancy company, education, what I do is educational consultancy, primarily audiovisual, right? What should I call my company? So it's not really my name, so people don't think they're buying wine. It's very nice, by the way. How did you pick your Twitter, Instagram handles? Did you just pick the suggestion that it gives you on the basis of your name? Is this a good company name? It's Ioannis, but it's a 5 at the end instead of the S because it sounds like, you know what? So the moment you have to explain it, it's over. Now, what's my social media handle? My social media is that. Why? Because I'm not called Ioannis. Anybody who does this automatically fails. We sent this. Yes. Because I'm Ioannis. So it's in officially. And my surname is Glinavos. So all my social media handles are Glinavos. Like an iPhone, but from Greece. So perhaps it's not the best one, but I came up with that stuff before I started marketing. If I was trying to say my handle is that, I would need to spend ages. This is what the university email address looks like, right? I would need to spend ages explaining this. So it makes it difficult to market if you cannot communicate the name. So you should choose something that is easy to say. People can hear what you're saying, and if you have to spell it, it's easy, or if they see it, they will remember. Of course, it does not imply something that you're not allowed to have. It does not imply association with an existing business. It does not imply association with a governmental authority or some official institution. It does not imply something of an international nature or a location nature that is not real to what you're doing. Then you need to obtain permissions. So the name that I chose for my company, why? Because it's unique. Because it's the starting of my surname and the starting of my partner's surname. So nobody else has this. Right? So if you Google it, you're not going to find anything other than me. So you've got something that's easy to say, relatively easy to say, easy to spell, and is unique. So then you can register domain names and stuff like that that are easy to communicate. There's some law behind this. So we don't think about these things in the abstract. So there are various regulations as to what the law allows you to have and why you should have it, how you can pick a company name, and remember that you can trade as something else. So the name of the company is Glintis Limited, but it trades as Glintis Consulting, right? Because I think it sounds fancy if you say consultant. The word consulting does not need to be in the company name. That's why a lot of businesses trade with their domain name. Even though Wonga.com was registered, do you remember that? It was a payday lender. But anyway, Wonga.com was registered as Wonga.com Limited, but they could have been registered as something else, and then they trade as the domain name, especially if they're an online business. So there are no problems in this slight difference, but of course, okay, if you're trading as Apple, but you're, H&M something limited, then there might be an issue because you're using the trading name in order to deceive again. What's the takeaway from this discussion? Choosing a company name is important in terms of marketing, but also in terms of law. You cannot do whatever you want, you cannot do whichever way you want it, but at the same time, it's not something to stress out over. You decide to do it, you decide it's a good idea to set up a company for the reasons that we've described. You have a fair idea of what your business is about and what you're trying to achieve. Remember that, unfortunately, setting up the company does not come with a pre-made business plan. So you need to know what your business is before you set up the company. It's normally not a great idea to set up the company and think what you're going to do subsequently. So you've got an idea of what the business is about, you've got an idea about your business plan, and you know that you're better served by having a private limited company as your starting point. There are other options, but we're not really talking about the different options because our focus is a profit-making enterprise. You could set up a community interest company, you can set up charities, you can do all sorts of things, but what we're thinking here is sort of entrepreneurship, right? How are you actually going to do it now that you've got an idea of what you're doing and you select the name? It is so easy these days. This is not sponsored by anybody, but I'm going to tell you the name. I did this by using Tide. The normal way, well, there's not a normal way, but the traditional way in which you would set up your business would be to go to Companies House and follow the process to start a business already in Companies House. This happens these days through the gov.uk website. So the Government Gateway is a website that allows access to all the government services you can think of. It's actually very nicely done. And most countries in the world now are trying to do something similar where you got like an internet service point that represents government services that people can use for a variety of things. So you can go to the government website, you can navigate to the area that is controlled by Companies House, and there you have the option to set up a new company. This is a fairly streamlined process if you already have all your information. So you know who you are, right? You've got your name, you've got your address, you've got identification because you need to be able to identify yourselves through passport information. It becomes a little bit more complicated if you're not British, and it becomes a lot more complicated if you're not domiciled in the UK. If you are in the UK and you have a British passport, most of the verification checks are super easy. Otherwise, you have to go through some additional steps. You go through the verification steps, you tell them which name you've chosen for your company. It does a real-time check whether this is available or not. And then you go through a few additional screens. You pay the fee. You're already, because I Googled Companies House, right? So it took me there directly. So we're all here at Companies House. You go to the thing that says set up a company and check. You've got all these things here. Check whether you want to do it. It gives you some basic information to just be sure that this is what you want to do. You choose the name. You give the information of who are going to be the directors, and if you have a company secretary, which is not necessary for a private limited company. You also decide who are the shareholders or the guarantors. That's why I said you need your identification information, because if you're the director, you need to identify yourselves, be checked through, and to have address information. You need to have address information for your company as well, right? Because the company needs a physical location as its business address. And a few additional steps. Now, what is the cost? 10 quid. We're not talking a great deal of money here, right? Web incorporation actually 12. But you need to have this information first, and you do it. Now, what about the articles of association? We've talked about this previously. You need the constitutional documents of the company. You can just incorporate the model articles of association that are relevant to your type of business. Done. Now, why did I do it with Tide? And, I'm not trying to promote Tide here. You can have other online banks that offer you the same. If you do it with one of these facilitators, they will take care of the whole process as well as open your business bank account straight away. What is important about this is that if you don't have a business bank account, then you cannot operate. So if you go through the business of incorporation through the company house website, then the next day or in a couple of days, you're going to have your certificate of incorporation after they do the main checks and so on. It happens very quickly, right? But then you're going to have to take your certificate of incorporation and try to open a business bank account. It's not a big deal, okay? But you're going to have to select the bank that you want to go and then upload this information, and then the bank will have to check that this is okay before they open your business bank account. Yeah. Of course, your account will be operated by you. In this scenario here, this is a one-member company. So you register your company, you become the company director, and you're also the sole shareholder. How much money did you pay to purchase your shares? Usually you set it as £1 because there's no minimum capital requirements for private limited companies that set it at a higher level. So it's perfectly possible that the capital of the company is £1, this is one share, you're the 100% shareholder, you're also the director of the company. From this point onwards, everything that you do on behalf of the company, you do in your capacity as a company director. Therefore, you cannot operate the amounts of the company through your personal bank account. You cannot. You need a bank account. Now, what has happened recently is that you've got all these online banks that provide business banking that actually facilitate that process. And it is so easy. It blew my mind because I've been making these presentations for years, going down the traditional route. We started with paperwork, then we moved online. The costs kept dropping, right? Even we reached the point that now we're just at £12. It used to be 100. So it's becoming easier through the official route, but it sort of desegregates the stages. If you go through one of the modern banks like Tide, I started off by selecting a bank account. I said, I would like to open a business bank account. It says, do you have a company registered? I said, no. Say, would you like a company registered? I go, uh-huh. Says, what would you like the name of your company to be? I say, Glintes Limited. It checks, immediately says, this is available if you want it. Then, do you have a business address to register this company as? I say, no. It says, would you like a PO box, a virtual address? What happens here is that the company needs to have an address. It is probably not a great idea to register the company address in your house. Perhaps you do not have permission. I'm renting my accommodation. My lease agreement says I'm not allowed to register a company at this address. So this was not an option for me. If I owned the house, I can do whatever I want. Again, not a great idea because this is publicly available information. So you probably don't want some kind of pissed off creditor turning up at your home in the middle of the night, right? So generally, it's not a great idea to register your company at your home address. For that reason, you could take what they call a virtual office. So the app asks, would you like a virtual office? I go, yep, virtual. So now my company is registered at the central, close to St. Paul's, like a central London address, which sounds really fancy. Yeah. Now, of course, now we hit some charges, right? They said, because you're opening a bank account with us, we will cover the costs of the registration of the business. So you don't have to pay the £12 to company house. This is a gift. But you have to pay for the virtual office. what you do in that case, you say, I have a promo code, which you got by Googling promo code for Tide Bank. So I got a promo code that brought it's an annual fee of £120 or so, or 115. The promo code was worth £75 or £85, took that off the price, so it dropped down this initial cost of like 30 something. So we have the name, the bank account, the virtual office. It asked me for some additional information as to where to send the bank card, where it's setting everything up. The virtual office collects all physical post, scans it, and emails it to me. Isn't that great? Yeah. So I don't even have to worry about that stuff. And then it asked me, have you registered a domain name for your business? Now, I didn't do that step because I hadn't thought about this and I wanted to pick more carefully domain name, so I did that separately. But I could have clicked that. It recommended a series of different domain names. It even gave you like a discount on the price for registering. You would not pay for the domain name registration, but you would pay for having the website or something like this up. So they would even give you the domain name free. At least for the first year. That's how it works. So, guys, at pretty much zero cost, I paid for the virtual office, like £30 after all the discounts? At pretty much zero initial cost, I could have had the bank account, the business bank card, the company registration, the virtual office that takes care of everything, and the domain name, and all of that took 15 minutes. The moment I finished everything and clicked OK, I started receiving the emails. Here's the email from Companies House with your registration certificate. Done immediately, which means that from the moment I have this, I can start trading, meaning that within the same day that I set it up, I could have actually signed the contract as the company. The next day, I received in the post the new bank card. Then I started receiving scans because Companies House sent some paper documentation to the virtual office address. HMRC sent information about registering for corporation tax and all of that stuff. I received those emails as scanned. All of that done so easily and so effectively. Then you got an app, you can control the normal stuff for your traditional bank. So all of that these days is so easy. Compare this with what happens in other countries where you need, even though the registration process might be online, you have to wait forever to get the paperwork after you've submitted. And there is significant cost. If you wanted to set up a company in Greece, for instance, it would cost you thousands of pounds at the initial stages. And these are costs that they repeat every year. So here, there are some minimal costs in re-registering, keeping the registration alive every year. There is going to be like £100 cost for the virtual office and a little bit more for the website. But the running costs of the company here, all put together, everything is going to be less than £200 a year. In a European jurisdiction, it would cost you 4, 5, 10,000 euros a year just to keep the company alive, even with you having no turnover. So all my friends who are in Greece, they tell their clients, you only register a limited company if you already have significant activity so you can have tax deductible expenses. Otherwise, you're throwing 10 grand down the toilet annually just in keeping the company alive for no reason. That's why this country, for all its faults, continues to be one of the top places for doing business, because everything is seamless and the costs are very low. From the moment that you've registered your company at Companies House and you got your registration certificate, now everybody else can find out things about you. So you can go to the Companies House website, you can put the name of the company, and it will give you information about the articles of association, the nature of the company, some of the key financial information of the company, and the people involved, and addresses where you can communicate with everybody. Why is this essential because it seems quite intrusive. These days we're all very keen on privacy and all of that stuff, so we get worried about it. This is the counterbalance to limited liability. You cannot tell people on the one hand, do business with this nice company who's got £1 and then give them nothing. You need to give them some info. So we'll come back to it and check this in a moment. But one of the questions involved here is, there were some limited expenses at the beginning, and I needed to pay these things in the process of setting up everything. So if I had done it through the company's house, I would have paid them. Since I did it through Tide, I needed to pay Tide. So there was some money that changed hands. Obviously, that money came from me, from my personal account. Now, how do you work through this? This is a little tricky, because for the paperwork, once the company is set up, you need to account for company expenses that were in place before the company was around. And me, because I'm setting up a separate entity to run the business, I want all the business money to be business money and all my personal money to be personal money. So if I spend like £100 or something in setting this up, I would like that money back in my personal account. So the way this actually worked out, after the bank account was set up, I put on the paperwork this as a loan to the company. So I made a loan to the company before the company was even set up, in order to allow the setup process. Then the company repaid that loan back to me, sent it back to my personal account once the business account was set up. And it started having some, because obviously it didn't have any money when it was set up, it was just £1, but it needed to have some activity. Once the company attained some activity and had some money in the bank account, it paid back that loan. This is called the promoter's law, because the person who sets up the company is called a promoter. You need an actual person to go through the steps of creating the company. It will not grow by itself. But the promoter is in this bizarre position that they're external to the company. You cannot contract with an entity that doesn't exist yet. But they would like to be compensated for their expenses or perhaps paid by their services once the company is set up. The reason why this is problematic is because it contains a great opportunity for abuse when you are setting the company on behalf of other people, or when you are trying to extract some perhaps inappropriate benefit through the process of creation. Think about this. Me as a promoter, I'm setting everything up. I'm making an initial loan to the company so the company can pay for the promotion expenses. But what if within the promotion expenses, I include other things? It's not simply cost of the virtual office, cost of the domain name, or whatever it is. What if I also sell equipment to the company? So this company is being set up, and at the initial stages, it purchases the laptop that I was using to run this consultancy, the phone I was using. What if I put in the paperwork that the company purchased that laptop for £1,000 and that phone for £500? Since there's nobody else involved, who is there to say that this is an appropriate price? Am I, in a way, tweaking the system? Or if I've got other shareholders, scamming the other shareholders by extracting an inappropriate benefit out of these initial transactions? So that is a serious problem. If I had been hired by other people to promote this company, and then I built up these kind of phantom expenses that they repay me for, then effectively I'm scamming the company. On the other side, if I did these things at the beginning in order to set stuff up, and when the company is set up with other people as the board of directors and shareholders, and I say, can I now have my £100 back? And they kind of go, I don't know what you're talking about, because when you spend that £100, the company was not in existence, therefore it's not our problem. Then I am exposed to this loss. No, we have a problem with this. And it has come up in the courts time and time again when the courts are trying to find the solution. There is no good solution, and the solution here cannot be contractual, because when you're promoting the company is not yet in existence, therefore you cannot contract with an entity that does not exist. If once the company comes into existence, it agrees to repay everything, it assumes that liability, then it's fine and you've got nothing to worry about. But equally, if you were trying to scam the company through expenses at the very beginning, and the company is not other people, then it's a very difficult thing to deal with. So the promoters are under a general duty, right, to do these things properly. But if there's nobody to complain on the other side, then you have difficulty enforcing that duty. So it is something that will come across. So remember the idea of the promoter and potential problems that can happen during the promotion of a company, both the promoter losing out or the promoter taking advantage of the company, because that is going to be a real issue. Now, in my case, what I was trying to do was not scam myself. What I was trying to do is to work out the way in which I can supply the initial capital that the company needs in order to be set up. And all this was, I tried to document it somehow, so it creates, by sending emails to the company account and things like this, to create a paper trail that then I can demonstrate to whoever asks for it what I was doing during the process of promotion. And then once the company started working and got some money in, it repaid that loan, and it created paperwork that says this is the repayment of the loan that we got for promotion. So I'm hoping that this is the best that one can do, since there is nobody else to make disclosure. Because most of the time, these things are disclosed. So the whole point about the promoter doing their job properly can be fixed by disclosure of whatever happened to a group of people that are independent from the promoter. This could be all the shareholders, or this could be the directors of the new business. But this assumes that there are different people holding these roles. If we're talking about a one-member company, that the promoter is the same person, the shareholder is the same person, the director is the same person, the employee is the same person, there's nobody else, then the best you can do is generate paperwork, so then you can demonstrate either to Companies House or to HMRC or to any potential investors in the future, what were you doing with the money at these very initial stages. And keeping the paperwork is important, because otherwise you can get in trouble. Not only in the sense that people might not trust you to have done these things properly, that they might actually accuse you of some sort of violation, trying to steal something or trying to hide something and so on. So this isn't, I'm not telling you this to make the process stressful. It's just that once you get to your head the idea that you're dealing with a separate entity, then you need to treat it as a separate entity. And in the same way that anything you do with a third party, you would need to document. If you order something, you would like a receipt. If you're doing something for your employer, you would like it written down. To nail down in writing the rights and obligations that might arise out of a relationship. This reduces the opportunity for misunderstandings and conflict in the future. It's only natural. So if you're running a single-member company, you need to remember to do this, even though when you're sending an email to yourself, it does sound silly, but it does create a record that then you can use it to remind yourself what happened, but you can also demonstrate to people outside. Now, from the moment that you have set up the company and you've received your registration certificate and your trading, it's called the trading certificate as well, from that point onwards, you are allowed to do business, then everything is fine. What happens if you made a mistake? It's possible to make a mistake. I made a mistake by choosing the wrong industry identification code. It's not a big deal. It doesn't have consequences. I just need to remember to fix it when I re-register for the second year. If you make a mistake about something fundamental, then you need to write to Companies House. Now, if you really messed things up properly, probably you would have gotten stuck somewhere in the process. Right? So if you were missing something, like your address is not in the UK or something like this, you would have hit a snag at some point that would request additional information. Equally, if you're opening a bank account at the same time, it does a credit check on you. So if you fail the credit check, then obviously you will get stuck if you were using a facilitator to set up your company. It just wouldn't proceed. If you make a more serious mistake, but it's not noticed, or company's house makes a mistake, then what is the right way to address this? The standard way to address problems of incorporation is not to undo the act of incorporation, because the act of incorporation creates a new person. So it's not really a great idea to undo the creation of a person, because from the moment that you've sent people the certificate, they might have started trading already, which creates rights and obligations in relation to third parties. So what's going to happen to these third parties if you tell them, well, the entity you were dealing with has been undone, therefore it never existed? So who do these people have a contract with then? What's going to happen with their money? So the correct way to undo problems at the incorporation level is to then shut down the company. So the Secretary of State takes that initiative. Something went wrong. We have to stop this. So we're shutting down this company, which means that the company existed for a short period of time, but then has been wound down. Undoing the act of incorporation is difficult, and it does not happen very often. One of the few examples we've got was the case R versus a register of companies, that they registered a pornographic business. And then they realized this was a kind of moral issue and they shouldn't have done this. So it's one of the few examples where the businesses, the act of incorporation itself is undone, because they kind of missed the fact that the business was trying to do something that was considered illegal at the time. But most of the time, the problem with incorporation is undone, as we said, by winding down the company, which means that for the time that the company was in existence and operated, the rights and responsibilities towards other parties are not affected. The topic of this presentation is shares and how shareholders do things and make money out of using their shares, which I think is a fun part of discussing company law, because it has a direct implication on how investors manage to get their money out of being engaged with companies. We have approached things so far from the perspective of the person who's trying to set up a company because they're trying to run their business through a company. So of course, the incentive of somebody who wants to do this is to benefit from the various things that this vehicle gives you in order to carry out your business effectively. Running it on your own as a sole trader, as opposed to running it through a corporate, then running it as a sole trader has less bureaucracy, because you actually don't have to do anything at all, right? So that if what worries you is the paperwork, then just don't do anything and you're fine. Protecting your assets through limited liability is a key motivator to starting a company. And also from an administrative point of view, separating your personal finances, your personal life and money from that of your business is also why people will choose a private limited company, so they can split the two. So these walls that you construct between who you are as an individual and who you are as a business person can come in handy. When it comes to making the money, if your business does generate money, the company structure gives you an opportunity to take that money out of the business and give them to you as a personal benefit, so then you can actually spend it. Because one of the things that it's important to remember is that if you have taken this step to set up a separate company to run your business, and the accounts are separate and the structure is separate, you cannot actually use the company's money for your own personal expenses. So every time you're spending something that comes from the corporate account, you really need to have an explanation as to why this has come from the corporate account. Let's say that I took the tube to come in here today, and then I bought a coffee because I didn't have my card, so I cannot get into my office to make one. Could I have paid this with my company bank card? Well, I don't need, the problem is not so much from a permissions point of view, because the company is just me, there's nobody else. So I don't really need to generate paperwork to authorize myself to take the train. But from a tax compliance point of view, I need to be able to demonstrate that this expense is linked to the business. Because obviously, you as a person have multiple roles. You are, who you are as an individual. You got your private business and your private expenses. So you could have taken the tube to go see a theater play. Or you could have taken the tube in another capacity as an employee of a different business to go to that business. Or you could have done it as part of carrying out the work that is related to your actual private limited company. So for me, taking the tube, taking a coffee or, my lunch would have been fine if I was doing it in my capacity of carrying out business for my company. But if I took the tube to come and teach you guys, this I'm doing in my capacity as a university employee, which is not linked to the company. So this is not a company expense. If I'm paying, can I pay my phone bill out of the company bank account? Well, am I using that number for company business? Because the company is entitled to have equipment, it's entitled to have assets, it's entitled to purchase services. But if it's my private mobile that I use for life in general, then that's not company business. A percentage of it, from a tax compliance perspective, a percentage of the use of a private phone for business is allowed, but then if I needed to claim part of my phone bill through the company, then that would come as a business benefit. So I would need to pay tax on it for receiving that benefit. As an individual, it would be a taxable benefit that I receive from the company. If I want the totality of the phone bill to be paid by the company, then the totality of that phone line needs to be used for the company. So I can have a personal phone number. I would need a separate phone number that then I can say, that's the phone number that belongs to the business. This is how the business can be contacted. Yes, this phone has a monthly bill because it's a kind of pay monthly mobile contract, and that's fine. So you need to think every time, because it might be one individual that carries out all of these things, but you need to think every time, what role is the individual occupying where carrying out those actions? So again, the benefit or the incentive of running through a company is to help you structure all of these things. So you can have these categories clear in your mind, and you can apportion behavior, expenditure, income, depending on how it comes, whether it belongs in the personal side, it belongs on your employee side, if you're working for somebody else, or whether it belongs in the corporate side, in the various capacities that you've got in there. Well, money laundering is a set of provisions in the law that are trying to prevent money that has not been declared, how it's been earned, is not obvious to the authorities, from making its way through the system. One of the ways in which you could get in trouble for compliance from the money laundering regulation would be if you're not very clear as to how payments are distributed between the various accounts you've got, and whether your account, the private accounts and the business accounts, are not kept distinct. For instance, an easy example as to how you can get in trouble. Say that I do work for somebody that is overseas, and they want to pay me in euros because they're over there, right? But my business is a UK business. It has a sterling bank account. It doesn't have a euro bank account. I could, if I wasn't familiar with how these things work, for instance, if I hadn't taken this class, I might think, well, I've got a euro account. Right? What's the problem with this? I'll ask them to pay in my euro account, and then I'll transfer the money from the euro account to the business account, so it makes its way there in sterling. I'll do the transfer myself from one currency to the other. Or I just keep it in the euro account, and then I send from my sterling account to the business the sterling amount, so I don't lose money by trying to change through the bank or something from one currency to the other. Well, the problem here is there's no legal explanation of why I received that money in my personal account, because I haven't done anything for them. The company carried out some work, and the company should have been paid. So why did this money come into that bank account? And then when I send from my personal account into the company account, again, there's a question, why am I making this payment? What is the purpose behind this? So if challenged, you need to be able to demonstrate for every incoming or outgoing payment, what is the purpose of that payment? And if it relates to business activity, to have an invoice that is related, or a contract that is related to that business activity. That's how you can defend it to the authorities. Otherwise, you're going to get in trouble. And the money laundering trouble is you breaching the law separately to any tax compliance issues. Also, an additional problem from a company perspective, if we made these payments in this way, is that it would incur personal tax liability twice. Because if I get money as an individual and I declare it to HMRC, I'm going to be taxed on it as personal income. If I then send that money over to the company is going to be taxed on it again as personal income. And when the company tries to send me back that money, perhaps with dividends as we're going to see or something else, I'm going to be taxed again. So it would be a really totally inefficient way to transfer money from a tax point of view. So you need to be aware of this. But also, because there are no invoices for work done to justify these payments at every single stage, I might get in trouble with the money laundering stuff. That's why if you come from home with your pockets full of cash and you go to the bank to deposit it, after a certain amount, they might ask you, where did you get that money from? So if you withdraw this money from another account, here or overseas, and you can show a receipt or in a kind of booklet that the bank gives you what the transaction has done, where it came from, it's fine, they're happy. But if you say, I had my birthday and all the uncles came and they all shoved a bunch of 50s in my pocket, they might say, no, we cannot accept that money into your bank account because you cannot tell us, give us all your uncle's details that we know where that money came from. You're allowed to receive gifts up to a certain amount. It's tax-free. That's fine. But they will ask you for compliance with the money laundering regulations where that money came from. If you cannot demonstrate where it came from, they will not accept it. If you send it via a bank, they won't ask you any questions because they know where it's coming from. Then it becomes a tax compliance issue as opposed to a money laundering issue. The key problem with the money laundering is cash. Something that is not already present in the banking system. Because normally it's the entry into the bank that needs the proof that it's been controlled and we know where it's coming from. Now, how this works with crypto, it's probably fine in the sense that a crypto transaction will generate a receipt when you redeem the money back into sterling, so you will be able to demonstrate that this is earnings from crypto. If you won it in a casino or through online gambling, that again is going to generate a receipt, so that's fine. What they really don't like is not being able to trace back where the money is coming from. But step one in compliance for any of these controls is for you to be able to distinguish personal from business. If you've taken that step to create that barrier through the establishment of a private company, you then need to be mindful of how this money makes these transfers. If your company runs out of money, you can make a loan to the company, but then again, this will generate a paper trail and you can defend where that money is coming from into the company and for what reason. In kind of previous presentations, we have gone through some of this content, so that should sound familiar. But we haven't talked so much about other people that might be involved in the company that are not you, because there might be other investors involved in the company. Could be that somebody else wants to contribute in what you're doing, or a bunch of people come together in order to do something. Which brings us to a discussion about shares and the way that the shares work and how they operate. Now, we have said already that when you're setting up a private limited company, if you're doing it for profit-making reasons, the most obvious way to do it is to divide ownership of that company in shares. It doesn't need to be many shares, it could just be a single share. Now, my company is set up with one share, which the nominal value of this share is £1. What does it mean to say nominal value? A nominal value of the share is what is specified by the company as the value of the share when it's made available for somebody to purchase. We would say it's written on it, but since they're all immaterial now, it's not technically written on it as in a piece of paper. Back in the day, you used to get a share certificate that would have like £1 written on it. These days, it's all done electronically. But the nominal value, the official value, so far as the company is concerned, of the share will be set at the point of incorporation. So my company had one share, value £1. This doesn't mean that when you buy the share, you will pay £1. You could pay more. For instance, I paid £2 to purchase that £1 share. This has implications that I'm going to explain later on, but it's common. If you are attracting investors, it could be that they pay a lot more money to purchase that typically £1 share, because there's a difference between the nominal value, what's written on it, and the transactional value. If this company has run for a few years and it has got regular turnover and is generating money, obviously, if it had been set up with 10 shares of £1 each, the company is worth a lot more than £10 in total. So if I wanted to sell some of those shares, if I had all of them and I wanted to sell some of them to somebody else, then I would sell them for more than £1. It doesn't mean that the nominal value of the share has changed, but it means that the transactional value of the share now is a lot higher. But when it's transacting, the money doesn't come back to the company, it comes back to the shareholder who's selling them to somebody else. So then it might be that one share is listed as £1 nominal value, but it has sold for £20 to somebody else who really wants to participate in the company. But question number one, in any discussion that has to do with shares and issues of valuation and understanding how shares work, is to figure out whether shares are property rights or are something else. This has caused a degree of confusion both for the general public and the courts. There is a difference in perceiving something as a property right, perceiving something as a contractual right, or perceiving it as something else, as something that generates obligations that come from different fields. Property rights are important because within the boundaries of the law, of course, you can do whatever you want with your property. So when somebody is selling something that they own, they can determine the price for their own benefit when they're selling. If you're listing something on eBay, you decide what's the starting price. Or if you have the buy now option, you determine what's the price that you want if somebody wants to buy it. It's your thing. You don't have to think about the interests of the buyer. You don't have to think about the interests of eBay. You don't have to think about any other thing other than your own personal interest when you're trying to dispose of your own property. You owe no consideration to other people. If, however, you were in another position, you were managing something in the form of a trust, for instance, or something where equitable considerations might come in mind, you might have obligations to consider interests of others when you are making decisions. So there's a difference between the shareholders exercising their rights to participate in company management when they vote at the general meeting and selling their shares. Because when they're acting as shareholders in a decision-making capacity, they have an underlying obligation to think about the interests of the company. So yes, they have to be mindful of what the impact of any decision is going to be for themselves, but there is a sort of baseline expectation that when the general meeting is making decisions, they do it with the interests of the company in mind. That's why they are often challenged when they're into a fight with somebody and their intention is to harm the person with which they're in a fight with, as opposed to whether what they're trying to decide is promoting the interests of the company or not, right? So there's a legal constraint in how they make decisions. But when it comes to selling their shares, if we consider the shares to be property rights, they can do whatever they want. So on the selling part, they're free to determine value for themselves. And they don't have to think about the interests of the other shareholders. They don't have to think about the interests of the company more broadly. So this is the consequence of perceiving shares as property rights. Now, this is very complicated because we said at the beginning of a discussion on how you set up a company that the basis of company law are contractual. The shareholders get together in forming a company by structuring the Articles of Association. The Articles of Association work as a contract between each individual shareholder and the company together. So there are contractual elements, there are property law elements, and there are other duties that come in behavior that has to do with the company. Cases like Short and Treasury Commissioners, which is the case from 1948, have tried to kind of navigate this, and they came up with the answer that says, yes, these are property rights. But there are still issues to consider. If you recognize that shares are property rights, what does this actually mean if the company shuts down? They are property rights, but what do they represent in terms of the value of the company? If a company is broken down into 100 shares, does this mean that if we have this company shut down today, if we're winding it up, each shareholder has a 1% claim over the totality of the assets? Is that how it works? The answer is no. So even though the shares are property rights, and you have freedom to determine what you want to do with them and what value represents to you when you're trying to sell those shares, when the company shuts down, it isn't as simple as saying, we take whatever assets are in this company and we divide them by the number of shares, and then each shareholder is entitled exactly that percentage of the company assets. And Short is one of the cases where they had to figure this out because the company was shutting down and they got into a fight with the revenue as to what were the taxes that should be paid and what is the value represented by the company and what does this mean for each individual shareholder. So the answer of the court was, yes, they're property rights, but you do not have an exact correspondence. Each share does not automatically give you an equivalent percentage over the totality of the assets that the company has. That it's a more complicated arrangement. So you have to fight at court issues of value, even though it is recognized that the shares themselves are property rights and you've got rights over them in similar ways as you would have over anything else that is your own personal property. Now, I started off by saying that what is technically written on the share in terms of the value is not the real amount that people are transacting with. And I told you that this has consequences. Now we're going to explain what these consequences are. How does the company get money to begin with? A private limited company starts and it doesn't really have anything before the shareholders purchase the bits of the company as they're acquiring those shares. But if the shares are set at a low nominal value, then the company doesn't really attain a great deal of money. So my company was set up with £1, actually 2 because I paid 2. Now, why did I pay 2? Because there's a difference between the nominal value and the transaction value. Both of these elements will come together and form what is called the company's capital. So the company's capital is the value that the investors are putting in, and it contains the nominal value of the share and what we call the share premium. The share premium is whatever you have on top of the initial nominal value. Why do people pay the share premium? Because it could be that they want to participate. There's actual competition for getting those shares. So they're happy to purchase shares above the nominal value because they think they're participating in something valuable. Now, why did I put £2 instead of the £1? The reason was practical, is because as I was setting up the company, I was actually purchasing a lot of services. One of them needed to pay immediately. So to pay for the website that I was putting together with the company was above £1. So I wanted to have at least £2 in there initially, just in case it tried to take the money from the bank account very quickly before I had the chance to put any more money in. So I thought, let's put £2 just to be on the safe side, right? In fact, the initial contribution, this is money that the company takes for itself. The initial contribution, you cannot actually spend. So the amount written on the share, which is the nominal value, and the share premium, whatever people paid in excess to purchase that share, at this initial transaction that the shareholders give the money to the company, stays with the company, and that is protected. This forms what we call the legal capital. So this legal capital is the minimum that needs to stay in the company account at all times. Why? Because supposedly this provides some assurance to creditors that there will always be a little bit of money in the company. Now, what assurance a couple of pounds are going to give you, in fact, is not much. But should you deal with this by putting in more money? So I could have dealt with the initial stages of the formation of my company by putting a lot more in the share premium, so I would be able to pay the website, the email addresses, the virtual office, any initial expenses if I set up like a direct debit for a phone number immediately. Why didn't I pay £1 as the nominal value and then £200 as the premium, so the company would start off with a more significant amount, so you would actually have the money to pay all of this? I could have done it, but this would have been a bad idea, because this would set my legal capital at, say, £201. So the company then would need to retain this at all times. So I would be locking these £200 into this company forever. And in order for the company to be able to give back money, if it trades successfully, it can only give back money in excess of this legal capital. So I would never be able to retrieve my money from this. That's why everybody starts off with the nominal value of the share being as little as possible, usually £1, and the share premium is also relatively modest. So some people use it as a way to have an influx of money initially into the company to set it up, but it's never put at very high levels, because then it disadvantages any repayments if the company wants to give money back, because that money is then locked into the company forever. So that's why I locked £2 into the company. It initially gave me the assurance that if there was any sort of credit check, or if the bank needed to check if it can make the payment, it wouldn't bounce back and it wouldn't create any issues. But I wanted to leave it at that. How did the company get money then to pay all of the stuff? Initially, I made a loan to the company to meet these initial expenses. So the people who do set up a public company need to actually cough up 50,000 when they're putting it in. And they will, because they sell the shares to the public, normally they will have a higher amount of shares. They will not just issue 5 shares. And they will adjust the nominal value and what they expect as a share premium at this initial sale when they're launching in the stock market at a level that meets these initial contributions, and that gives them a bit of breathing space as well. But for a public company, the amounts are going to be a lot larger, and the contribution for the general public is going to be a lot larger. Remember, however, that we're just talking about this initial sale of the shares. Now, I could sell my one share to somebody else for £1,000. But that would be money coming back into my pocket. It would not be going to the company. So it will not change anything for the company's legal capital, no matter what. I could be selling for less, really, okay? I could sell this share for 50p to somebody. It doesn't really, I lose money, but it doesn't really make any difference to the company. The company's legal capital is set by this initial nominal value and share premium at this first transaction. So what you need to remember is, when the company is setting up for the first time and is selling its shares to the shareholders for the first time, it needs to think about what the nominal value is going to be and whether they expect any share premium or not. And then that contribution of that package is called the legal capital, and the company will need to retain this for as long as it's operating. How are shareholders rewarded for participating in the company after they became shareholders? Because clearly you paid some money into it, you expect to get something out of it. One way in which you could make money would be to sell the share at a higher value to somebody else who wants to purchase it. This is possible for a private limited company, but it requires the participation of the company in the transaction. If you were in a public company, whether it is listed in a stock market or not, it is easier to just transfer your shares to somebody else who wants to buy it. And the value of that is determined by the market. You will find the person who's willing to give you the highest amount of money and you will sell it to them. And then, what they do thereafter, you don't care. But for the majority of private limited companies, the shareholding is fixed. It doesn't really change. So how do shareholders in a private limited company actually make money if they never sell the shares? This is done through the payment of dividends. Companies have got the ability once or twice a year to make payments of excess money that they've got to the shareholders to reward them for their participation. How do I get money out of my company? I could hire myself as an employee and pay myself a salary. Right? That could be one way. But I would actually need to do this. I cannot get a salary for being a company director. They can compensate my expenses. We started talking about getting a coffee, getting the train ticket, getting a meal during a day in which I'm carrying out company business. So expenses for directors you can refund, but directors don't get a salary. Being a director of a company is a function, it is not a job. So if I wanted a regular payment, the company would need to hire me as an employee and then run payee, so register with HMRC to run payroll and then pay me through payee. So that's one way of doing it, but this would be rewarding somebody who is actually actively engaged with the company, is already a director or wants to be hired and work for that company. Shareholders normally are the owners of the company. They don't necessarily have to be involved, and usually they might not be involved if you got a company that contains a larger number of people. The majority of them are likely to be shareholders. They seek to profit. They made an initial contribution, but they don't actually want to be there and do anything. So the way in which you can regularly reward those is by making these dividends payments. So when the company has traded successfully and has made money, then it can choose what it does with this money. How do we know if it has traded successfully? You take out what is the legal capital. So you cannot go below in the company's bank accounts from the initial contributions of the nominal value of the shares and the share premium. This stays always. From that point onwards, you have to look in the company's balance sheet, which is something that we'll talk in a different presentation. But a company's balance sheet will have, on the one side, the liabilities, and on the other side, the assets. If you have a positive outcome, this is not just looking at the bank account and whether the bank account has got money, because the balance sheet is dynamic. It's got money that you've got in cash, but it also has invoices that are waiting to be paid. it also has bills that you need to pay. And all of these things could be either short-term liabilities, things that will happen by the end of the month. We need to pay rent, we need to pay energy bills, we need to pay phone bills and all of that stuff. But we're also receiving payments from various invoices for jobs that we've done. But it has also long-term liabilities. It could be that there's repayments on a loan. It could be that there are longer-term financing deals that need to be serviced. Or it could be that we have something that, we get regularly, but we pay every 6 months. So you have a look at this balance sheet. If the overall result is positive, it means that the company has traded successfully. Out of that positive asset base, you've got assets that are liquid, meaning cash in a bank account, that are immediately available. From that liquid part of the assets that is immediately available, the company can then choose whether they give some of that or all of that back to the shareholders. They cannot give money back to the shareholders if it brings them in the negative. So they cannot be giving, they cannot go as low as the legal capital, that they cannot touch. They also cannot go as low as leaving them in the red after they made the distribution. So from available money, you can choose to distribute back to the shareholders. How do you do this? The directors make a recommendation. The general meeting of the shareholders can approve that recommendation for the dividends payment. If it's within those legal boundaries, then this payment can be made. What are the tax implications of these payments? This comes after you have accounted for profits and things. So it means that if the company has traded successfully and it has to pay taxes, right? Taxes are paid on profits. So you will deduct the expenditure and so on. After all this is cleaned up, what you've got, you can make dividend payments after this. But you cannot reduce your tax liability by making dividends payments, right? Otherwise, no company would ever pay any taxes because they would give all the money to the shareholders immediately and say, we didn't make any money, right? But it does generate a tax liability for the person receiving it. If you're receiving dividends payments, some part of it is tax-free. It used to be £1,000 a year. Now it's dropping down to £500 a year for this tax year. Dividends income above that level will be taxed, but it is not taxed at the normal rates. It's taxed at lower rates. So the threshold that we've got, 20% for basic tax rate payers, 40% for higher rate payers, and then I think it's 50% for a higher band above a certain level. It's lower than this for income that is received through dividends. So you get some benefit. There's some incentive there. Now, why is that? Why is there such an incentive? I've got no idea. It's because the rich people in government, because they make a lot of their money through dividends payments, they decided that you're more worthy if you're making money through doing nothing than if you're doing money through working. So if you're actually working for your money, you pay higher taxes than if you're receiving them as dividends sitting in the back doing absolutely nothing. But dividends payments can be very significant, and they are a very significant source of income for quite a lot of people. I've got an example here that has billions in dividends payments. And you can see that if you look at the financial press on a daily basis and see which companies have announced dividends payments, they can be quite significant. Listed corporations will issue this information in the press and they will say, British Telecom or something has made a payment on its shares and its share is worth, say, £8-10. Its share earns 15p, 18p as interest. But since they've got thousands of shares in circulation, if you hold thousands of shares, that can actually make very significant amounts. For a very long time, these investments have outperformed bank interest rates. So you actually get a better return on your investment by having your money invested in stock, and even if you don't sell them, and you're just relying on dividends payments, you will do better than having your money in a standard deposit account in a bank. Of course, nowadays with interest rates having gone up, income from investments in banking products is getting a lot better. So that's something to think about. But I think all of us are fortunate enough not to have any excess money, so we don't have to worry about where to invest it. Yes. So this headache is only for the rich people. We are fine. But to come back to my main point, the main way in which people make money out of being shareholders is through their dividends payments in private limited companies. In publicly listed companies, they usually make money by transacting and selling them to somebody else. Okay, let's see this through the form of an example. So if we've got these people, Yorgos and George, and they've set up their company, if the company had 200 shares valued at £1 each, that would be the nominal value. This was initially issued at £1.50, right? So £1 was the nominal value, 50p was the share premium. This will make the company's share capital as having 200 and an extra 100 in this share premium account. So the legal capital now becomes 300. Yeah? This is the amount of money that the company cannot leave. It always needs to stay with the company. If they wanted to make a dividends payment of £10 per share, because they've been trading successfully, how much money do they need to have in available assets before they make that dividends payment? They do need to have 320, okay? Because why is it 320? Because the 300 they cannot touch. So if they want to give back 10p for every share that they've got available and they've got 200 shares, then they need to have an additional £20 before they make that distribution. So if you had set up your company with a very high price as the nominal price of the share, or you had a very significant share premium when you issued them, then you would need to have a lot of money available before you're able to make distributions to your shareholders. So it would actually put you at disadvantage. You can change it, yes, we're going to see that shortly, but it's a process that you need to go through, which means it's a bad idea. But if you don't know this, if you're going through the steps to set up a process, if you use the sort of facilitator electronically like I did, and it says how much money would you like your shares to be, or if it's one share, how much money would you like the share to be, it could be that you think, well, let's put it at £1,000, because that way I give £1,000 to the company, and with these £1,000, they can actually cover all their initial expenses for the first year that I'm running it. But actually, this would be a mistake, because you would have put £1,000 in the non-distributable reserve, so they wouldn't be able to do much with these £1,000. And certainly, you would have locked £1,000 into this business forever. From the money that they've got available, right, after you kind of cleared out all the liabilities, the leftover money in the bank account needs to be at least 20 before they can make that distribution. Actually, it needs to be 320 because the 300 they cannot spend. So it needs to be a 20 on top of that to be able to give it back. You cannot fiddle with this legal capital. This comes under the label of capital maintenance. So you're going to find in your textbooks areas that they talk about capital maintenance. This is where they attempt to explain all these rules as to how do you get money in to the company, and then once you get it in, what does this mean in terms of getting things in and out? It isn't very complicated. It just means that you need to be organized. So from an operational point of view, the only thing you need to do is have a spreadsheet when you kind of write everything. This is all the money that came in and the dates that it came in, and have an explanation of what it is. And then this is all the money that's come out and when it came out and why it's coming out. And it is as simple as that. Your problem might come from lack of record keeping. Because when you come to do your tax accounts at the end of the year, and you need to add all these things up, if you don't know where anything is, and you have to figure it out just by going through the bank statement, you might get stuck. It could be that some stuff didn't pass through the bank statement. For instance, promotion expenses, amounts of money that you needed to pay before the company was even set up, say for a virtual office or something like this, will not feature in the bank account because it was money that got spent before you set up the bank account. So you need to have an external spreadsheet where you keep a record of all this information, so then you can actually use it to produce your tax documents, or if challenged by somebody, you can actually demonstrate what's going on. If there is anything that is lacking an explanation, you will get in trouble, and in practical terms, what will get you in trouble is your bank. So HMRC or, the regulators or whatever, or, the Metropolitan Police doesn't really have the time or the inclination to look at minor businesses and minor transactions. Now, okay, clearly if, some uncle of yours gets excited that you set up a company and sends you £60,000, then that might ring an alarm bell somewhere. But trouble is not going to come from the revenue. These guys don't even care when you try and tell them stuff. It's like you try and tell them, I owe you money and I don't understand, like you asked me to pay less than what I owe you, what am I going to do with the rest? And they're like, don't worry about it. Somebody at some point is going to send you an email, and then they send a letter saying, it's like from 3 years ago, from that self-assessment, you still owe us money. We would like you to pay it. It's like, yes, I would like to pay it 3 years ago. What took you so long? Because they don't care. And clearly the police doesn't care about anything unless it's kind of major criminality. But the bank will care. And what the bank will do, because they're so worried about getting in trouble, because obviously their interaction with the authorities is very different, if there's anything that looks unexplainable into your accounts, they will say, we think there's something here, we will investigate to see what's going on. And they might take forever, or while they're investigating, if they ask you for information and you have difficulty producing this documentation, like your uncle sent you £6,000, and you cannot actually tell them why, then they might freeze your account. And if they do this while they're investigating, you cannot use your account, you cannot use your bank card. Effectively, they've cut you out of your business. We had this discussion with somebody recently. This exact thing happened to them, and it's very unpleasant. Right? And I'm not suggesting anybody has done anything wrong, but that's how weaknesses in your record keeping can become a problem. A legitimate question could be, what happens if somebody got it wrong? What happens if at that initial stage you didn't know about all this and you set it too high? Yes, you can change stuff. For instance, if the people that we were using as an example, Yorgos and George, initially raised £1 million by a share issue. If they haven't done very well, and now the assets that they've got available on top of the liabilities are only 500,000, it means they cannot actually pay any dividends. Because if their legal capital is set at $1 million, they need to exceed that $1 million in available money before they can return any profits to the shareholders. If they've been consistently operating not according to their expectation, they're never going to be able to make a return to shareholders. There are companies that have been operating at a loss forever. Ocado, for instance, the supermarket, was famous for being loss-making for ages. I think it's only when we hit the pandemic that they managed to, shortly before the pandemic, that they attained a profit, and then they did quite well for obvious reasons. It's not necessarily a problem to operate at a loss, because you could make up the money by borrowing if people are willing to give you money, or you bring more investors in to cover the losses. But if the legal capital prevents you from making distributions to the shareholders, then you cannot reward the people who've stayed with you up until some indeterminate future point that you actually managed to do better. So what you can do is reduce the company's capital, which means that you can bring it lower to a more realistic level, which releases available money that then, if you trade successfully above that level, you can return it to the shareholders. So the way this is done is that you need a special resolution of the general meeting, and then if you obtain that resolution that is asking for the reduction in capital, then you need to apply to the court to get this approved. The reason why you need to go through the court and you cannot do this yourself is because this obviously affects creditors' interests. As we said, the legal capital is the minimum that needs to be there to gonna satisfy people if the company goes bust. Now, in my case, the £2 are not gonna help anybody, but in this case, it would be significant if they've got a million as their legal capital. So the court needs to be involved in any decision to reduce that. If a special resolution, by the way, means that it is 3/4 of the members that want to do something, right? You don't need a majority. You don't need a simple majority, which be more than half. You don't need 100% agreement, but you need 3/4 of the shareholders being in agreement to do something. Okay, right. So if you do this and the court accepts, you can reduce the capital, and then you'll be able to make distributions a little bit more easily. It would have been easier on everybody if you had thought about this at the beginning and you hadn't actually issued the shares at that significant value. Can you, if you want to bring more people in, you want to bring more shareholders in, can the company give people a loan to purchase shares in order to entice more people to come in? It sounds like a dodgy idea. It is possible for private limited companies, because if the company has got excess funds, it can decide to do a bunch of things with these excess funds. It could return them to the shareholders, it can reinvest them, or it can invest them in other things external to the company. Making a loan to somebody is a way of investing that money. Now, if that somebody uses the loan to purchase shares in the company further, then, that could be part of a scheme to bring in additional shareholders. It shouldn't be perceived as inappropriate. But if in a private limited company, a decision is made to give a loan, then it needs to go through the proper channels and have the proper authorizations. And if the person receiving the loan is already a shareholder or even worse, a director, then there are some very careful checks and balances to make sure that this is done on commercial terms and for the proper purposes, and is not just a kind of sideways gift to somebody. There is, however, a prohibition in providing financial assistance to purchase shares to public companies, because it would be considered that it would mess up with people's incentives in investing in public companies if a public company was actually subsidizing the purchase of its own shares. If the shares are listed in the stock market, their value is determined by people buying and selling. If some of the people buying are getting the assistance of the company to be able to do this, then it will affect the valuation in the stock market. That's why this is not allowed for public companies. And when we're saying about giving financial assistance, the company, for public companies, the company cannot give it directly, but it can also cannot give it to other people to pass on to other people. So the example that we've got here is that if we had a public company, so if Yorgos and George set up their company as public, and a bank is giving a loan to somebody who intends to purchase shares in that company, and the company itself tries to guarantee that loan, it will be caught by the rules of providing financial assistance. So the company itself cannot give the money to somebody to purchase its own shares. If it's a parent subsidiary structure, another subsidiary in the group cannot give the money because it's part of the same group, so it's caught by the same prohibition. And nobody can provide a guarantee to cover that liability if it involves the same people. So some kind of clever scheme, let's put somebody else's name on it to achieve the same effect, is not going to work. But remember, these are prohibitions that have to do with public companies because it messes up valuations for the shares of public companies, whether in the stock market or not, but usually in the stock market. If it's private companies, then the rules are a little bit more loose. And then what you need to worry about are permissions that you're doing this appropriately and you're not giving some sort of inappropriate benefit to somebody who's already connected and all of that stuff. Today we have the opportunity to talk about the bosses, right? Because we've been talking about different aspects of getting engaged in a business. We've talked about how one would have an idea to run a business and whether it would be a good idea to run this through a corporate entity, the types of corporate entities you can have. We went through the process that one needs to go through in order to set up the company. We talked about what is your position if you're an owner as a shareholder in a private limited company, and to an extent public ones as well, and what that means. But today we're going to focus on what the bosses actually do. So the company is run by the board of directors. It sounds fancy. Does it sound fancy? I think it sounds very fancy. I'm a company director. Isn't that very impressive? So hi, I'm Ioannis. I'm a company director. Oh, wow. You're a company. Is it a big company? Oh, yeah, it's huge. So one share of £1. So we get to see what the board is actually doing. Somebody has to run the business because the business is, as we said, a legal fiction. So it's a wonderful thing to say that it benefits from separate corporate personality and it's got all these characteristics. But as we came across in previous presentations, something technically having this capacity doesn't mean that it can exercise it and can carry out actions in the real world. Maybe in the future, maybe AI reaches the point of automation that the companies can genuinely run themselves on the basis of a set of predetermined criteria. There was this story in the press that there is a company that has created an AI bot that can actually engage in contractual negotiations, that it can discuss with the other party, be it human or another bot, reach common ground, and then draft the terms of the contract, and then agree everything, and it can all do all this by itself. So if you had given your bot that is supposed to represent the company enough information about what the objectives are, then theoretically, at some point sooner or later, the bot will be able to take actions and run the company by itself. So then we're getting to a point that not only we have a virtual entity that is a legal person, but perhaps this legal virtual entity can interact by itself without needing human agency. We are not there yet, and remember that the law really trails very significantly technological development. So even if technically the bot could now negotiate and contract and do all of these things, the law still requires a human agent to be the representative of the company. So the reality of what is technically possible and the legal acceptance of that in this domain is going to take a while to come. So what we do know, and what is still the case in the law, regardless of the evolution of AI, is that you need a human agent to carry actions on behalf of the corporation. Since you have a bunch of people involved in a corporation, who is it that actually gets to make those decisions? Of course, we're assuming here that more than one person is involved. Because in my case, if I am the sole shareholder and I am the director and the sole employee, then I am carrying out all these roles simultaneously. So perhaps it's an artificial legal point to discuss when I made a decision about purchasing something or taking on some work, was I doing this in my capacity as director, in my capacity as shareholder, or my capacity as manager, as a paid employee? In effect, it does not really matter. It might matter when I come to extract value out of the company and pay myself, why and how I'm extracting that payment. But in terms of the actual decision making, if it's a one-person company, these distinctions slightly are in the background. But if there are more people involved, say that we've got a major investor that is the majority shareholder, and I am the director of the company and also the sort of primary agent for that company. I do most of the work. I've got 10% of the shares. I collect a salary, but 90% of the shares are held by a friend of mine who is my key investor. When a decision has to be made, the company needs to purchase a piece of equipment, or we have a proposal for some project and we're thinking about how do we do this? Should we take on this project or not? If me and my colleagues sit down to discuss, it is not immediately obvious who is the key decision maker, from a practical point of view, in the law is fairly clear, but from a practical point of view, it might not be obvious to the people themselves who should be the key decision maker. Should it be the director or the employee who's going to carry out the task, or should it be the majority shareholder? If the other guy owns 90% of the shares, then you might think that his opinion is actually quite significant. The more people you have involved in a business and the more spread out this is, and the more distinct the ownership from the management, the higher the possibility that you might get into some sort of disagreement as to who does what. And shareholders are there to make money out of their investment. Shareholders in a big public company in the stock market, they've got a few shares. They don't really care about the management if they seek to make money out of selling these shares for a higher price than the price that they bought it. But in smaller companies, when the shareholding is pretty much fixed, somebody who's a majority shareholder might actually want to be involved. So they might get into a disagreement with the people at the board of directors as to what should be happening. Now, in law, who is the authorized representative? This came to the courts time and time again. So now it's got expression both in the Companies Act, but also in this kind of long series of cases where the court needed to come up with an explanation or an interpretation of the rules and tell these distinct groups of people within the company who is the primary decision maker. The answer is the directors are the primary decision makers. And it is their capacity as directors that gives them that power. And it doesn't even matter if they've got shares or not, because it's not obligatory for somebody who's a company director to also be a shareholder. The law says that since the company is an artificial entity and it requires the intervention of a human agent to do things, this human agent is the board of directors. So today we're talking about the sort of lines of responsibility and how management is structured, but what we're going to see in the coming presentations is how the law implies a long series of obligations on the people who carry out that stuff. Now, in practice, you will be consulting, if you are a director or you're in the board of directors, you will be consulting with the shareholders. Because if you've got people with significant shareholding, their views obviously matter and it is their company. So it makes sense that you have them on board when you're trying to get these things done. But the way that the law is structured that says the board of directors is responsible for running the business, it means that you can ignore interference. So if they want to disrupt what you're doing, or they want to have influence on day-to-day operations outside the boundaries set by law, then the board of directors does not have to listen to the shareholders. But it is always a fine balance between deciding what's going on. The articles of association are the primary tool to inform everybody within the company as to what are these lines of responsibility and what people are supposed to do. So if you look at the model articles, as we said, the model articles are the ones that the law gives you as a template, that if you're setting up a company, you can adopt them either in their entirety or you can have some amendments if you wish. But the model articles is a sort of baseline of the constitutional information for the company. If you look at what it says about directors' general authority in the model articles, it does say that the board of directors is responsible for running the show. And the shareholders do have some power, but they have, first of all, the background power. So if the board of directors is unavailable or is unable to reach a decision because they're not there to meet, because they're sick, because they're incapacitated in some way, or they're so deadlocked that they're really fighting with each other within the board and they cannot make a decision, this decision can then fall back to the general meeting. So if there's an absence of government for the company, then the general meeting can assume that role while that problem is in place. But other than this, the general meeting has the ability to intervene for certain decisions And to be fair, certain things are so important that you need to consult the general meeting before you go ahead. There's a list of them I'm going to show you in a moment. But if you wanted to kind of shut down the company, purely this is not a decision that the board can make by itself. But the shareholders have this residual power, and they get to decide crucial issues already predetermined in the law, but they don't get to intervene whenever they feel like it for whatever reason they feel it. Now, having said that, the board of directors is able to delegate to professional managers. The more complex the company gets, the more you need the assistance of other people. So if I'm by myself, if it's a one-person company, this is not an issue. I'm by myself, I'm carrying out all these roles simultaneously. If there are a few of us together involved in this company, some of us are in the board of directors, some of us are shareholders, maybe the directors are also shareholders, but there is a small community. There is a sort of expectation that pretty much everybody is involved in some capacity. And if we're talking about a few directors in a small company, they're probably all actively involved, and they probably don't have the money to hire a lot of additional people for help. It's not like you set up a company and the fact that you set it up immediately generates money and you think, okay, I'm going to hire somebody to do this and I'm going to go sit by the beach somewhere, right? That's not how it works. But if you have a bigger company, you begin to have more complex organizational structures. Not everybody who works in management is going to be in the board of directors. The university, for instance, has a very complex management structure. The people who sit on the board of governance are like a handful of people. So that would be the equivalent of the board of directors. There are a few people that are there to carry out these functions determined by law. But the day-to-day management falls down to various people that have specific appointed roles. It falls down to the faculties that have got their deans and then a set of roles. Other management tasks fall down to the schools and so on and so forth. So there's like a complex organizational structure where everybody does something. Not everybody who has management capabilities will be a director. And this is present in the model articles of association, that they say it is perfectly possible that the board of directors delegates some of its authority to professional managers they will be employees and they're hired to do this job specifically. Now, having said that, the directors themselves are not necessarily employees of the company. So being a director is holding an office, is an official function. It doesn't mean that you also have to be an employee. Now, very often, the people who are directors in more complex structures, they will also have an employment contract. That's why you hear about somebody leaving, resigning their position from the board, and then leaving with a significant payment because also their contract of employment has been terminated, and then there are provisions in that and they get some money on the way out. No, and you cannot actually put employment provisions in the Articles of Association. The Articles of Association will tell you, we have a management structure, we have directors, and the directors have then the capacity to delegate their authority to professional managers. But then what happens in the appointment and the remuneration of these professional managers is something that comes further down the line, and it will have to do with people's individual employment contracts. Is it a good idea to be an employee of the company if you're also a director? This is, I think, a significant question. The baseline position is that it is if the engagement with this company is a significant part of your livelihood or the main way in which you make a living, it is effectively your job, then it is a good idea to have an employment contract in addition to you having a position as a director. Now, when I set up my own company, this was one of the initial questions that I had. Am I allowed? I know that I'm allowed to represent the company because this is in the model articles of association that I've adopted. It's in the law all over the place that I know that I am the director. I am the board of directors because there's nobody else. Therefore, I am, the way in which the company interacts with the outside world. But when it comes to carrying out substantive work, somebody hires my company to deliver a particular service. Am I allowed as the director to actually do this, being the company directly, or am I obligated to hire myself as an employee or with some sort of contract for services, right, so I can deliver that work? Now, interestingly, this question is not obvious from the documentation, even though it appears like a fairly legit question, I would imagine. It's not, the answer is not obvious in the documentation. ChatGPT says you don't have to. All the information from HMRC is only about how do you extract money out and what happens when you try to get paid. Business support offices, there are various things that the government has set up, hotlines and so on to help with entrepreneurship. They didn't even understand the question when I called them. Now, the conclusion is that if you are a director, you can work directly for the company. So you don't need to kind of separate yourself at that moment to say, I'm a distinct employee that has been said to you to carry out some work. For that contract, for the delivery of the contract, the delivery of the service, you are the company when you turn up at the face. So that part is fine. So a director is entitled, as a representative of the company, to actually carry out work on behalf of the company. It might be a good idea to have a contract of employment if this is your livelihood, because it will help you extract money out of the company, because everybody is obsessed about this. If you go and look at in discussion forums, what people are talking about in relation to company formation and company operation, it's filled with contractors, you know, from kind of people that offer professional services like accountants or whatever, or, you know, the plumber, the electrician. They're all obsessed with how do they handle the money and the payments and how do they actually extract the money out of the company for themselves so they can pay their rent. On that level, you cannot just, as we've said multiple times in the past, you cannot just pick up the company's money and go pay your bills. So you need to somehow extract the money from the company. And there are two ways to do this. Either you get dividend payments, but this only can happen once or twice a year. Or if you want regular income, then you need to hire yourself as an employee. There's no other option. Because if the company is paying you expenses, it could pay you expenses as a contractor, but expenses are only expenses in carrying out your work. Expenses are not your rent, like your Netflix or, you know, your school fees or whatever, right? It can only be money that you spent to go deliver the work or, you know, equipment that you needed to buy or whatever. So relying on expenses isn't a great idea. Everybody gets expenses. So if you're a director, even though you're not an employee, if you have expenditure in carrying out your director's duties, then you can submit the receipts and you'll be reimbursed by the company. Fine. And that's kind of tax-free for you because it's expenses. But if you want to have a regular income or you want to be able to get money out frequently, then you really have to hire yourself as an employee. And as we've seen when we were talking about the consequences of limited liability, if something goes wrong somehow, then you probably need to have the distinct employment contract. It might have to do with issues of liability, it might have to do with insurance coverage and all of that stuff. So the best practice advice is that if you're regularly working for the company, this is your main activity, and you want to regularly extract money out of this for your life, to be able to live, then you should hire yourself as an employee. Can you do repeat contracts for services, meaning that you're not an employee long-term, but you do like one-off contracts when you need to carry out some work on behalf of the company? HMRC advises against this because they think this is an attempt to avoid paying national insurance contributions. Because if you're an employee and you're on payee, which is, you know, pay-as-you-go employment that's set up by your employer, then you pay national insurance contributions and your employer pays national insurance contributions, and they're obligated to enroll you in a pension fund above a certain level of pay. If you're doing things as a contractor on a contract for services, none of this applies. But effectively, you're cheating HMRC out of national insurance contributions, and you're cheating yourself out of a post for pensions entitlement, right? So HMRC says, don't do it this way. And in any event, if you were doing this regularly and you were having kind of repeat contracts for services where you have to carry out the work, then you've breached the rules on contractors, which is the IR 35 and some of the other stuff, so you can get in trouble for effectively tax evasion. Now, the result of this question is, if you are a director, what is your money relationship with the business? Well, you don't have to be an employee. But if you seek to extract money for doing work, then you need to be an employee. If you're a director and also a shareholder, then you can get some benefit in terms of dividend payments once or twice a year. But if it's your regular job, if it's your regular engagement, then you should be hired as an employee. So to come back to the point where I started, why do we have all these people that are kind of senior board members and then they say they're leaving and then you read in the press that they get like a £10 million payout? It's not because they're directors and they're entitled to money. It's because in addition to being directors, they were employed to be senior managers, and in the contract of employment, there are terms and conditions that say, if we terminate your contract of employment, then this compensation is built in. Now, not everybody's contract has compensation provisions for termination. Any of you have jobs, part-time jobs or anything like this? I don't think your contract has any compensation provisions. You will only gonna get statutory redundancy pay, which kicks in only if you've been in employment for more than 3 years, I think. So it definitely doesn't work if you're there for a year or less. And statutory redundancy pay is peanuts. I think you get like a week's pay for every year that you've been there. There's like nothing. It's not like the movies where you're getting, I got fired and I can live for a few months. In the continent, redundancy pay is actually quite generous. So they're supposed to give you like a good percentage of the salary you were actually making for like a prolonged period of time. When they fire, and I'm not saying firing you for cause, so like you did something wrong. If they decide, well, we don't need you anymore, off you go, there are provisions for redundancy pay to allow you to live because they kicked you out and you didn't expect to be kicked out and you need to be able to live and you find another job, right? Now, in this country, we don't really care about people surviving, so there's very little in terms of redundancy pay. Unless it is built into your contract. Did you guys hear the story about Nigel Farage and the argument that he had with the bank and all that? What happened with this guy is that he was a customer of Coutts, which is the kind of rich people bank owned by NatWest. For some bizarre reason, this doesn't happen very often, but they said they kicked him out as a client. So this is a known person. I mean, he's a celebrity. In any case, it's a known person, and there's a perception that he's got money. So that's why he was in that private banking institution. So they say they kick him out because they object to his attitude, his beliefs that they don't correspond to the values of the bank and so on. Which is fair enough, by the way. You are not obligated to do business with everybody. You can choose who you do business with. In the same way that if, somebody comes around and says, Ioannis, would you like to make a video for us? And I'm like, no, because I don't like you guys because you suck. That's my right. Now, what you're not allowed to do is discriminate on the basis of protected characteristics. So if I tell somebody, no, I'm not going to contract with you because you're a woman, or because you're a person of color, or something like this, or, because you're gay or whatever. These are protected characteristics. So making decisions as to who you do business with in all the basis of protected characteristics is unlawful discrimination. It works in employment, it works in contracting, it works in the variety of stuff. But outside this, it is freedom of contract. Nobody obliges you to do business with people you don't like. So you could kick somebody out of your store if they're not behaving properly, or you object to them and you don't want to do business with them, then it's perfectly fine. So when the bank said, we're no longer going to offer an account to this guy because we object to him and his views and his behavior is not in accordance with our standards, that's fine. What is not fine is that the CEO of NatWest went and apparently talked about his business affairs with the journalists. And the highlight obligation that the bank has to the customer is confidentiality. So the bank, anybody, by law, has two core duties. One is to respect your instructions as to how the account is run. And secondly, to keep everything confidential. So the bank is not allowed to say, well, you set up a direct debit for a new mobile phone plan so you could get the new iPhone. Maybe you don't need the new iPhone. So, you're a student and so on. Maybe you should eat rather than paying for the new iPhone. So we're not going to honor this. They're not entitled to do this. They're obligated by law to respect your instructions. If you got the money in the bank, it's none of their business what you spend it on. And equally, they're not allowed to call your mom and go, you know what she got now? Guess what she got? She got the new iPhone. So that is a highlight breach of their obligations. So when the lady that was top of the parent company, which is in this case NatWest, revealed information about this guy's accounts, I'm thinking, I think she said something like, we don't like him, but also, this guy doesn't have enough money to belong in that bank, right? She breached the law. He complained about it immediately. Of course you would, because this guy lives out of controversy. So anything that is kind of remotely interesting about him, he would make a big hoo-ha, which proves that even people in high positions that are paid a lot of money do stupid things. This was a very stupid thing to do. And it was predictable that we're going to get in trouble. Anyway, the lady says, okay, fine, this wasn't cool. It became very controversial in the press. The board says, we got to pretend to do something about this, so we're going to have to let you go. And she goes, okay, fine, I'm fired. Boo, 10 million, which was the provision in the contract. So that's why you've got somebody who is in a board position, in a senior management position, that leaves and then gets a big payout out of the company because it's not a function of company law, it is part of the terms and conditions of the company. Now, of course, what happened subsequently is that they said when that became controversial, the rest of the board said, hang on, we're firing you for cause, because you broke the law. We're not firing you because we don't like you. So if we're firing you for cause, we don't have to pay you the 10 million because this was, if we fire you without you having done something wrong, right? But if we're firing you for cause, then you don't get the exit bonus. Yeah. So whether you qualify for the criteria of an account, that's an objective issue. That's not a problem. For instance, I've got an account. It says I need to deposit an X amount of money every month. It needs to pass through the account. And then I need to have a minimum of 2 direct debits paying out every month, because this is meant to be my main current account. So the way they define main account is X amount of money circulated and 2 direct debits going out. Now, this is very tricky these days because anything you sign on as a regular payment, you pay by PayPal, right? So nobody has direct debits in. But anyway, if I don't have any direct debits, then they're going to say, you don't meet the criteria for this account anymore. So either we're going to charge you to keep it open, or you just don't qualify for this, I'm sorry, and we're going to move you to something else. When you guys graduate, you no longer qualify for a student account. So they will automatically transfer you to what they call the graduate, right? It's fine. But this is between you and them. So the problem isn't, does he qualify, does he deserve to be in that banking product? The problem is they breach the law by talking about it. And then he would have gone and complained. He would have like, they're kicking me out of the bank for political reasons. But the job is to keep it shut. The job is to say, we've done what we've done according to the rules. If he has a problem, he can sue us about it. And then if it's in court, then the information can become part of the court submission as evidence. But yeah, remember this. If your mom ever says, they called me from the bank because they thought you were doing something suspicious, you got them because they're not allowed to talk to your mom about it. Yeah. And now because of data protection and privacy regulation more broadly, we cannot talk about anything to anybody unless we have the express permission of the student. That's why we cannot actually call your parents when you guys are in trouble. So we need express. So if, say, you're experiencing some difficulty, and I'm thinking, oh, this person came here, they're stressed to death, then if we talk to their mom, it would probably help. I'm not allowed to do it. That's why I can suggest the super efficient counseling services here at the uni, that are going to send you long forms to fill in, but I cannot actually call your parents and say this kid's in trouble. Yeah. And there are people who actually complained about this because there are people who attempted suicide and all of these things, and the parents then said the university knew, we never knew, the family. If somebody had called us, we would have intervened, and then we would have stopped this. But the legal requirement is that you're not allowed to talk to anybody. So the overall conclusion for the directors is they are the bosses. They are responsible for day-to-day decision making. The fact that you're a director is enough. You do not need to have an additional capacity. You don't need to be a shareholder on top. You don't need to be an employee. You don't need to be something else. The fact that you're a director is an official capacity. You should not accept to be in the boards of directors anywhere without having full appreciation of what this means, because it is something more burdensome than just a funky title. Because then you need to do stuff in relation to the authorities and the regulatory requirements, and if you don't fulfill those roles correctly, you can get in trouble. So this isn't when they frequently advertise positions, would you like to be a non-executive member, a non-executive board member, which means you don't actually carry out anything day to day, but you have an overseeing capacity, and people are going, oh, this would look great on the CV, and I get to go there for 3 meetings a year, and they compensate these meetings by £500 every time, so it's a little bit of money and it looks good. No, it doesn't. Because then if they do something stupid and they get in trouble, you're on the hook as well because you're also direct. It is possible that the board has failed to carry out its functions effectively, therefore collectively they're in breach, but most of the time it's individuals who have done something wrong. For instance, if they fail to do their annual returns to company house, so the company hasn't actually filled out the obligatory paperwork, they're all collectively in trouble. But if a director takes some money out of the till and goes and spends it on a holiday, then it's the person who has done it that gets in trouble because that's the person engaging in the violation. So when we talk about directors' duties and what this means in practice, we're going to have some examples of that. So they're the bosses, they run the show, they do the day-to-day stuff. We said that the general meeting does have a background role to step in when the board is unavailable or just got into such a fight that they cannot decide about anything. But there are some areas where the general meeting will always have to be consulted. For instance, you cannot change the Articles of Association by the board making a decision to change the Articles of Association. This is one of the areas that are reserved for the general meeting. And we said that if you want to change the articles, you need an enhanced majority. So, more than half is not enough. You need 3/4 of the vote. Then you can put something new in the Articles of Association. Also, if you want to change the type of incorporation, the directors cannot choose to take a company that is private and make it public, and then they are floated in the stock market. They cannot do this by themselves. They need to have the consent of the general meeting, and equally, they cannot shut it down. The directors cannot take the decision, well, this company is not working very well anymore, we will fill in the paperwork to wind it up, which is how you close it down, and not ask the owners of the business. You cannot issue additional shares without having the existing shareholders okay this. You cannot reduce the number of shares again. So, and also you cannot change the rights attached to those shares. I mean, of course, all of these things would require a change in the Articles of Association, so you kind of get the idea that the general meeting needs to be consulted. But these are highlight areas, general issues that have to do with the governance of a corporation that you need to have the okay of the general meeting. There are some additional things that have to do with corporate governance. Now, corporate governance is this kind of blanket terms that covers everything about how corporations are run, and there's a lot of literature about how to run corporations effectively. So when we're talking about corporate governance, we're usually talking about good corporate governance, kind of best practice requirements, how to do things well. So if the company is of a certain size and above that, you need to have auditors appointed to look at your accounts every year, then the general meeting is involved in the appointments of auditors. Of course, it is involved in approving certain things that the directors might do. So if there's something that represents a conflict of interest, the director is somehow involved with the company. The director makes a loan to the company, or is receiving a loan from the company, or is selling some of their property to the company, or the other way around, is purchasing something from the company. All of these raise a conflict of interest concern, so the general meeting needs to say that this is okay before the transaction goes through. Or if the transaction has already happened, then the general meeting needs to approve a transaction that has already happened for it to be okay. And sometimes if we're talking about public corporations where somebody tries to take over, like they try to purchase shares and not take over the management of the business, certain things that the company can do to resist this, they need general meeting approval. Clearly, if you want to join the stock market or if you want to do certain operations in the stock market, you also need to have the approval of the general meeting. It's a fixed set of areas where the general meeting gets to intervene. Is the message from this that you can piss off the shareholders at no cost when you want to do stuff that don't fall within these defined categories? It's never a good idea to piss off the majority of your shareholders. And the reason why it's not is that the shareholders will always have the ability to do nasty stuff to you because they have an ultimate, immense power, which is to fire you. The shareholders can, on an ordinary resolution, which means a simple majority, so long as half of them want to do it, then it's fine. On an ordinary majority, they will always have the capacity to remove a director from office. So you need to remember this because it's something that comes up quite regularly. This is in Section 168 of the Companies Act. Section 168 says that a company may, by ordinary resolution at a meeting, remove a director before the expiration of their period of office. So it doesn't matter how long ago they got appointed. If the general meeting loses confidence in a director, they can get rid of it. You cannot change this. There are certain provisions in the Companies Act that are default, which means this is what happens unless the members wanted something different. There are some provisions that are mandatory. The mandatory provisions you cannot change. It is done in a certain way because the law requires it, regardless of what the members want to do. Section 168 is one of these provisions that are mandatory. So you cannot actually change the Articles of Association to say it is not possible to dismiss a director, or we want to have a director for life, or whatever, right? It is set by law at the ordinary resolution meeting, and that's the end of it. Now, that is the reason why pissing off the majority of the shareholders will never work well. Because once they are sufficiently angry at you, they're just going to dismiss you. Now, if they want to exercise the right they've got in Section 168, what can you do if you're a director? You are allowed to make representations to the general meeting to explain your behavior or explain your business plan or explain what you wanted to do. And you're entitled to kind of put this forward, but you cannot resist a vote to dismiss you. Even though you have an opportunity to speak and to explain, they don't have to change their minds. If they still come back and say, we just don't like you anymore, there's nothing you can do about it. Remember that this isn't employment. This is your position as a director. So the reason why they want to dismiss you, it doesn't matter. Even if they say, we don't like you because of something that would be a protected characteristic in terms of employment, right? This is not going to save you from your position as a director. If they wish to terminate your employment contracts, and then they do it in something that is protected, then that might constitute unlawful discrimination, and you might take them to an employment tribunal. But try and keep in your head the two things differently. Right? Your position as a director is entirely dependent on the general meeting wanting to keep you on. Your position as an employee is protected by general employment legislation. So then there's an external constraint in what they are and what they're not allowed to do. And if there are sort of terms and conditions in your employment contract that give you a sort of payment if they want a dismissal before the end of your terms, then you will be entitled to this from a contractual point of view. So you're not going to win anything by pissing off the majority of your shareholders. Interestingly, there are a lot of people whose job is to agitate the shareholders to get rid of this board. But normally your entitlements as a shareholder are not affected by your participation in the company in other capacities. But it could be that there's a provision in the terms and conditions of your employment contract that require you to liquidate any shares that you have when you leave it. And look, it depends, because if we're thinking about major companies, public listed corporations, if we're talking about kind of executive suite people, so the top people in the business, they usually have a very significant numbers of shares because a significant part of their compensation is in shares. If you had the requirement that they divest when they're selling, this could dump a large number of shares into the market, so it might decrease the value of the shares. So so that's probably not a great idea. So maybe in smaller corporations, if it's not listed, it doesn't matter. For listed corporations, maybe there is some sort of plan to divest the shares, or you would want to do this if we leave the corporation. But if we're talking about big chunks, it will affect the value of the share and the perception of the company. So it would really be counterproductive to tell people you need to sell everything the moment you're out. Now, a lot of people make it their business to identify companies that are not managed effectively and to then obtain enough shares to entitle them to speak at the general meeting. And then at the general meeting, they propose a change of the board of directors. And they say, we have identified a bunch of problems. We think that the current management team is not doing a good job. We propose a new management team. These are our people. So if you vote to dismiss these guys and then you appoint our team, this is going to be better for the corporation. And very often this is successful. Of course, this happens in environments where the company is quite distressed already. And the people make money out of this because when the company does better, obviously their shares increase. So then they can sell the shareholding that they attained at a higher price, so then everybody pays. And usually they do it in association with other people. The people who become the executive team also benefit. So these usually are called activist investors, not in the sense that, they're they're pursuing a cause that is external to the profit making of the company, but there are people who are actually going to agitate the general meeting in order to both make money for themselves, but also to kind of accelerate the evolution of the company and kind of change course in the company so the company becomes more successful in itself. So there are quite a few people that have made entire careers doing precisely this, identifying companies in trouble, getting a foothold, getting in, changing the management, and taking it in a different direction from the top. It's a good business. It's usually funded very well because there are a lot of money that goes into these things, because if this is done properly, it can become quite successful. So we talked about contracts of employment, and we talked about somebody having done a bad job as a director, or at least displeasing the general meeting, right, and getting kicked off. And we talked about the employment law implications of this. What are the company law implications of having done a terrible job? Because, okay, they dismiss you from your position, that's one thing. You might lose your employment contract, especially if they fire you for cause, and you might not be getting any compensation for this. But is there anything from a company law point of view that might happen to you? Well, there is, because the Secretary of State has the capacity to disqualify people from becoming directors again in the future if they have done something terrible. So this is in the Directors Disqualification Act. It's one of the things that you need to know in relation to this. And the directors can be disqualified in 3 circumstances: if they've committed a very serious offense, usually contains some sort of dishonesty; if they've been engaged in fraudulent or wrongful trading. These have technical definitions that we're going to see when we talk about insolvency; and when they fail to comply with various formalities when the business is shutting down, because this has very negative consequences for the creditors and so on. So if you have done a terrible job, not only to the point that they kicked you off the board and, they terminated your employment, but you've actually done a terrible job that shows not only that you've been harmful to the company you were directing now, but you're also a potential danger to other companies in the future, then the Secretary of State might pursue this capacity to disqualify you. You don't get disqualified forever. You get disqualified for a certain period of years, depending on the gravity of how badly you've carried yourself. This will be part of your record, so it will show in Companies House next to your name that you've been disqualified. You will not be able to become a company director again for the period that you've been disqualified. So if you're doing business with somebody and you kind of Google them and you find this information and you discover that they've been disqualified for running a corporation, maybe you should think twice before doing business with them, because they have, in all likelihood, done something very, very, very seriously wrong. Now, clearly somebody who has done that poorly probably had to contribute some of their own funds to cover creditor demands when the company shut down. But we'll get to that when we talk about insolvency. Breach of commercial morality, recklessness and incompetence at a spectacular level, serious offenses, failure to report appropriately, they've been declared bankrupt on the personal level. So these are kind of highlight big time stuff. It's not simply doing a terrible job because they have perhaps behaved poorly, so they didn't manage to turn around a corporation that was getting in trouble. But to an extent, this is life. It could be that they did whatever they could, but the market conditions were such that, this business model doesn't work anymore. In the same way that, if look at this, if you've got a machine that creates tape recorders that use physical tape, no matter how good you are in making tape recorders, there's simply no market for this anymore. So you may shut down. It doesn't mean you've done anything wrong. So I don't know. I don't think these guys have done a terrific job, to be honest, but it doesn't mean that they should be disqualified from being directors in other companies in the future. Disqualification means that you've done things wrong in a very, very severe level within a closed category of things that are considered that severe. Now, Robert Maxwell was an example, because Maxwell was the owner of the Sun group of newspapers back in the 80s. the business wasn't doing terrifically well. He started taking money out of the pension fund to pay current liabilities of the business, and in the end bankrupted both the business and the pension fund. And this is used in the literature as an excellent example of horrible leadership and poor corporate governance, in the sense that the majority of what was going on in there was determined by a single person. So there were no checks and balances, there was no independent board, there was no adequate communication with the shareholders. Everything was managed by one person who were pursuing their own personal agenda. And it all fell apart. So he died. If he hadn't died, he would have ended up in prison and then disqualified for a long period of time, because he hit all these things that would lead you to do a disqualification. What are we doing today, ladies and gentlemen? So today we're going to discuss a little bit about the structure and composition of the corporate board and what the shareholders can do when they're making decisions, because this is quite important in the context of the things that we're discussing. In previous presentations, we've discussed about the corporate board. So we know that it's formed of the directors, and you can have one or you can have multiple directors. And we discussed to an extent how these directors make decisions and how the shareholders can have some power and some influence over what's going on, but cannot fully control what's happening in the corporation. Because who is the boss? The directors are the bosses of the company. On a day-to-day basis, they're the ones who make decisions, not the shareholders. Now, clearly, if you're in bad terms with the shareholders, or what the board of directors is doing does not align with the expectations of the shareholders, sooner or later there's going to be trouble. But what we're trying to understand is the degree to which a shareholder that disagrees with some action can actually knock on the door of the director and say, I would like you to do something else. Unless you fall within a certain category of topics that we've discussed previously, but I'm going to mention again today, unless you're within that band, the shareholders are actually not authorized to say, I want something else done right now. So the structure is that we have a separation of management from control. Now, would you argue that this is a good idea to actually separate the people who own from the people who manage? Let's say that it was done the other way around. And let's say that the shareholders did have an active, ongoing power to intervene, not only for major decision-making, but also for day-to-day decision-making. What would be so bad about, in theory, one would imagine that the directors are in a better position to manage a corporation. But this is because we hope that the shareholders have appointed people who are substantively competent. In terms of the legal requirement, the only legal requirement to be a company director is that you're at least 16 years of age. There are no positive attributes required. So you could appoint anybody that has finished secondary school. Actually, it doesn't even require that you finish school. It just requires that you're 16. You could appoint any 16-year-old to be a company director. It could be that they know absolutely nothing. So we hope that since the shareholders are the ones that appoint the directors, they actually choose people who are capable of doing something. It's possible, though, that the shareholders also know how to do stuff. And since it's their own property, the company effectively is their property, maybe they're in a better position to make decisions about this. Now, it has to be the majority of the shareholders. Because when we're talking about the shareholders, we're not talking about individual people who are shareholders. We're talking about somebody who commands a majority at general meeting, or a group of people who command majority. So every time I say that the shareholders go and ask for something, I'm assuming that this represents the majority of the shareholders. If it was somebody in a minority position in the general meeting, then the directors can clearly ignore them and they say, okay, maybe you want something, but since the rest of them are not interested, then we're not going to do anything. So why is it not an advantage to give the people who actually own the place the opportunity to intervene directly whenever they want, since this has to do with the way their property is managed. If they cannot be involved much and they don't want to, then they won't turn up. So the concern is mostly for excluding the people who do have an opinion and they do have the capacity and they do want to be involved. The law currently excludes them. It says that you can only be involved in specific settings. You cannot just ask the directors to do stuff all day long. If they don't feel that they could participate, then they don't have to. Nobody says they have to. But I'm just trying to investigate why is it that the law puts shareholders in this particular corner and we perceive it as a problem if they have more intense rights to participate. Okay, so one argument could be that if you have shareholders that have got strong opinions, but these strong opinions are not based on the facts, because they don't have access to the same information as the board of directors, then maybe they force the board of directors to do stuff that are actually not particularly clever. The problem is that shareholders are primarily interested about themselves. But we cannot, we can say that the directors are supposed to run the company in the interest of the shareholders. That is embedded in the law. But we should not equate that to mean existing shareholders, because the directors have an obligation to the company in and of itself. That includes the people who are currently shareholders, but it also includes the people who are going to be shareholders in the future. So if you allow the current shareholders to be disruptive, then they're likely to do things that improve their position right here and now, but these things might be detrimental for shareholders in the future. Like a typical example is, if you ask the shareholders how much would you like as dividend payments, they're going to say as much as possible. They're never going to say, well, don't give us all of it now, keep some to reinvest in the company. They're most likely to say, we would like as much return on our investment right now as is possible. But that might not be the best thing to do for the company. But this is it's a legitimate and live debate. And it keeps coming back. Theresa May, for instance, there was they change so often that it's pointless to give them numbers anymore. But she was Prime Minister of the UK, I think, for a spell of time, a little bit earlier. She made this a big deal. So she was very keen on company law reform in order to allow the shareholders to have more say in company decision-making. And she gave a large number of speeches where she was suggesting this and promoting this idea. We never got to the point of specificity that she would tell us exactly what that meant, because already the shareholders have a great deal of power that most of the time they choose not to exercise it. So giving them additional rights would mean what exactly? So I don't know. She never managed to tell us before they booted her out. And the current government is not tremendously interested in company law reform, so far as I get it. Even though the last King's speech had a great deal of legal reform on it, that's actually sensible measures that have been kind of pending for a very long time. I'm guessing they suggested them because they know that this parliament won't be around long enough to actually pass any of this legislation. So they just said, oh, we're going to do a whole bunch of nice things and actually do nothing. Having a debate as to how the shareholders should be involved and why they should be involved is legit. Now, the rest of the planet is happy with this distinction between management and ownership. If people with a short-term mind frame are in the majority, then they're going to push company to make decisions that just increase the share value right now or increase the dividends payments right now, which clearly might be detrimental to the future of the company. So the shareholders are not represented in the corporate board. They have some residual powers, but they don't really have a seat at the table beyond the statutory defined opportunities to be involved in decision-making. Now, the smaller the company is, And the closer the identity of the board to the shareholders, the less relevant these distinctions are. Because if we're talking about a private limited company where the same people, there's like 3 shareholders and the 3 people are also directors, then there's a total alignment of interests between what they do in their capacity as shareholders and what they do in their capacity as directors. But for bigger corporations, where the major shareholders are not themselves sitting in the board, then we need to be aware of what this distinction actually means in practice. So the shareholders are not part of the corporate board. But if you're thinking of the best way to organize a corporate board, maybe there should be other people that ought to be represented in the board. What about the employees, for instance? What about splitting the board in 2 sections? One section has an executive function, so they actually have specific tasks, operational tasks that have to do with the management of the company. And the other part has a supervisory role. Some people who don't actually do stuff day to day, negotiate and sign contracts and oversee operations, but they take a view on strategic direction, on, say, product development, but on a more kind of high level, thinking about how the company could evolve in the future to do best in its operations and so on. In this country, there is no direct legal provision as to how the board should be internally structured. It's possible that you have a few directors and they all have a defined executive role. It's possible that you've got other components of the business represented in the corporate board. It's also possible that you have some executives that don't have a direct operational function, but they're there to oversee. In other countries, it's very common to have employee representation in the corporate board. In Germany, for instance, they have a 2-tier board. One part is executive, one part is overseeing, and the employees get to have a seat on the table because their representatives are part of the supervisory part of the board. Now, do you think that would be a good idea to have the employees represented at the corporate, at the director's level? Isn't the corporation, in effect, the totality of its employees working towards a common goal? Because if you don't, like, what is this place without its employees? It's a brand name and, a bunch of ETI statements. What is like marketing in isolation, right? So if you don't perceive the business through the actions of its employees, you might not have much of a business. So if in this place, everybody who works here detests the place and everybody quits every 5 minutes, like the second they find another job, they're out of it. And when they are actually working in here, they just do the bare minimum to get by because they don't want to be here. They just collect their salary and then they kind of run home. This isn't really a strategy for success. And the assumption is that if you have the employees represented at corporate level where the decisions are made, it's more likely that the company is going to take decisions that lead to a healthier work environment, that the concerns of the employees are heard on a more direct level. Not that you don't have avenues. We've got our union here, it communicates with management and all the rest of it, but the union is still not part of the governance structure. So if you had the employees represented and sitting on the same table as the bosses, and they have a say when they're making decisions, then maybe that results in the concerns of the workforce being addressed, a happier workforce, and a happier workforce tends to be more productive because it puts more effort into it, because they stick there for longer and all the rest of it. I think this is the logic that motivates the sort of 2-tier board that you have in many European countries, because they realize that incorporating the concerns of the various stakeholders of the business and having them present at the corporate board level is a quicker way to address any issues than doing without this. Now, in this country, as I said, the law does not mandate a particular structure in the board. The company can decide for itself. It represents this in its articles of association, and they go with this. As if the shareholders would like to have a different structure in the board, then they can change the articles of association. So the articles of association mandate how the board is set up, what is its membership, how they make decisions. So if they would like somebody else, one of the stakeholders, to be represented in the board, then they can change the articles of association to that effect. And it's perfectly fine. Nobody's going to tell you no. So what I'm trying to say is that the law here does not make it obligatory as it does in other countries, but you still have the option to do it if the people within the company think it's a good idea. Where you get into a slightly more kind of forceful view as to how you should organize yourself is when we look at public corporations. Because for public corporations, there's an expectation, because they're bigger and there are more people involved and they're more financially important, and because they affect the wider public, because shares, if listed in the stock market, they're available to the wider public, there is an expectation that they follow best practice advice, and the best practice advice is that there are some people who have an operational function and some people who have a supervisory function. That's why you have all this debate about non-executive directors. Have you guys ever heard this notion of non-executive directors? Doesn't have a direct operational role, because one director might be in charge of marketing, the other director might be in charge of sales, the other one might be in charge of HR and employee relationships, right? One could be in charge of overseeing manufacturing activity or whatever. Non-executive directors do not have a specific task, but their job is to check what everybody else has done. So a sort of internal supervisory board. So a lot of people who are, who've been doing this for a while and they're quite senior in their careers, they get asked to serve as non-executive directors in other corporations this doesn't mean that they actually work for them, they don't do stuff on a day-to-day basis, but they can contribute their knowledge and experience in helping the other corporation succeed. Companies that are listed in the London Stock Exchange, they are supposed to comply with the UK Corporate Governance Code. Now, this is a code of best practice suggestions or rules. It's not law as such. So this doesn't come from the Companies Act. So it's not obligatory in that sense. But it is obligatory in the sense that if you voluntarily take the step to join the stock market, then the Corporate Governance Code forms part of the obligations that come with being in the stock market. And the Corporate Governance Code does mandate certain things about the structure of the board. One of these things is that you have a group of non-executive directors. Why did they think that this is kind of best practice advice, and where does all this come from? It comes from a long series of corporations doing poorly. And there have been successive investigations and reports as to why these corporations do poorly and what should be done about it. The outcome of many of these discussions has been to propose that non-executive directors are appointed and they've got specific functions. What happens in this country is that every time something goes wrong, even though everybody knows perfectly well why it went wrong, nobody has the balls to say it. Now, as a face-saving exercise and a kind of cover-your-ass exercise, every time something fails, they will set up a commission to investigate. Some old, white, rich dude is going to be appointed to chair the commission. They're going to spend money for 2 or 3 years appointing all their friends as consultants to help them with the commission. So a bunch of other rich white guys make a lot of money out of this. And eventually, they're going to tell you what you knew all along. But because there's been a commission that set up inquiries and did interviews and called people to speak and investigated all the evidence and gathered all the stuff to tell you that the bears usually shit in the woods, when the report comes out, everybody can pretend that this is at enough of a distance from what is actually going on not to have a great deal of personal impact. So this is a beautiful way to address issues because, as I said, you can always scapegoat somebody random. You can always diffuse responsibility. You can delay the outcome because when something big, bad happens now and you quickly address it, everybody knows that the big, bad thing happened. If you set up a committee and the response to the big, bad thing is 5 or 10 years down the line, nobody even remembers what you're talking about. Yeah, tried and tested technique that this country has perfected. Every time there was a big corporate failure, even though the reasons were blatantly obvious, the reasons usually are rich people doing stupid things because they just get ahead of themselves. Yeah. Then you need a committee, some senior judge to oversee, blah, 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 inquiries, interviews, consultants, millions wasted. Yeah. Again and again and again, there have been various reports. All the reports say exactly the same thing, that bad things happen when a small group of people become too incestuous and talk to themselves and convince themselves that doing stupid things is a good idea. And the way to prevent privileged people from doing stupid things is to get somebody else who's a little bit outside the group, check what they're doing, and tell them when they're coming off the rails. Simple, isn't it? Same thing works for everything. Could work for this place. When you only listen to the people who clap along and you're surrounded by a group of sycophants who tell you what you want to hear, when you start to make bad decisions, they will continue to clap along and tell you how great you are, till you actually make a significant mistake that then causes a significant amount of damage. If you had a group of external people, you give them the tools, you give them the data, you give them the opportunity to oversee what you're doing. And you then listen to their advice when they try to tell you that what you're doing is perhaps too risky, too dangerous, or the wrong thing. And then you act on that advice, then there's an expectation that this will minimize catastrophic things from happening, right? Or will reduce the chance that these things are happening. That's why in the corporate governance code, the 2-tier board is recommended. So you have an executive function and a non-executive function to do this checking process. It is a terrific idea. I mean, I don't think anybody disagrees with this, do you? You know how we're so keen on feedback? Yeah? In some circumstances, it's great to have a group of people that tell you, I don't like it. Assuming that it comes with, some specifics as to what it is that they don't like and what they think you should do in response. Yeah? Now, one might argue, if this has been around for donkey's years and all the public listed corporations in the London Stock Exchange on whom these rules are applicable do have non-executive directors, why do we come across the phenomenon that you have executive boards that are dominated by particular individuals who are domineering and obsessive and have agendas that are incompatible with the benefit of the company, and they do the wrong things and the companies end up failing? Either there's something wrong at design level, that having a non-executive part of the board isn't actually helping, or it is not utilized properly. Now, my personal view, which I think is kind of validated by the evidence, is that it is not working because you still have a closed group of people. That the sort of powerful individuals that are likely to be making the wrong decisions when they're in charge of corporations and not have in mind the interest of stakeholders or even their own shareholders and all the rest of it, they will appoint their friends at the non-executive board. And then they will be rewarded themselves by being appointed in non-executive positions on their friends' boards. So it becomes all kind of an enormous back-scratching exercise organized through private members clubs that, the elite here is so keen on, that everybody appoints their mates to supposedly oversee what they're doing. So if the executive part of the board is populated by incompetent sycophants, then there's a very high chance that the non-executive board is occupied by exactly the same people. It's just that you pay them less because you don't ask them to do as much. That's why the problem persists. So the problem is one of corporate culture and perhaps lack of diversity in the backgrounds and interests and profiles of the people who are at high executive positions. We keep coming back to the same issue. It's a great idea in terms of design, because if you don't have it and you just have the executive board, then you end up in kind of Robert Maxwell type situations, that there's some sort of powerful individual that bosses everybody else around and the catastrophic consequences come about. But the way that it's been set up now, even though the design advice is solid, the implementation is poor. But that cannot be fixed by legal measures. Maybe it can be fixed by the shareholders actually having a better look at the people they appoint in the board. Because the non-executive directors are also directors. They're also proper full directors. They just have a different thing to do. They are appointed by the shareholders. So maybe the shareholders should have more ownership of the process of appointment and actually look more carefully at the types of people that they appoint in corporate boards to carry out these roles effectively, and not appoint the mates of the existing directors whenever they're suggested. Now, and for that, guys, you don't need a change in the law. So I don't know what Theresa May was so excited about. All the tools to actually do this are already in place. It's just that shareholders do not take the opportunity to appropriately scrutinize corporate appointments, and they appoint the wrong people. We have mentioned in the past the potential of activist investors to have some influence on this. It happens, and this works actually, and it's quite helpful. What we say by activist investors are people who have enough of a foothold in the general meeting, they own enough shares to actually make recommendations, bring things to a vote and so on, and they come up with an explanation of the situation. They point out the deficiencies in the board, and they suggest that the shareholders replace the board with somebody else who's likely to do a better job. No, but it's a good illustration of the system working. If an activist investor comes in, demonstrates to the general meeting that they're doing a poor job, and the shareholders, by a simple majority, say, actually, you know what? Yeah. And they put new people, it's evidence that this is in fact working. These discussions are kind of more relevant for bigger corporations, and the shareholding is a little bit diverse. So it's unlikely that in a listed corporation you're going to have somebody who owns nearly half the shares. Normally people have got smaller levels of shareholding. Yeah. So it would be a group of shareholders that in their totality have got almost half the shares. Yeah. Since the corporate governance code is part of what the stock market requires of you to be there, if everybody agrees, if everybody who's in this business agrees that this is a sensible way to organize stuff, and you've got an entire code that says this is the best, this is what the whole debate about corporate governance is about. Like, we've been looking at this stuff for 100 years, and we came up with this set of rules that say this is the most efficient way to organize a corporate board. This is why we have distinct roles. This is what different people should do. And if you want to be part of the stock market, it's a requirement that you consider this. If the company's answer is that, nah, well, I don't care. We have a brilliant leader, and we don't need anybody else. They say, this is a best practice thing. If you don't want to do it, and your shareholders are happy with you not doing it, and it all goes wrong, then guess what? Your shareholders lose out. It's not the job of the regulator or the state, whomever, to chase after. In the same way, you shouldn't wash your colors with your whites. You ignore this advice at your peril, then everything is pig. So do not wash your new Grinch onesie with your whites, because everything will be green. Okay, fine. So it's their own money. They want to do stupid things and lose them. They're going to wash their clothes without paying attention. They're going to suffer the consequence. Okay. But you could say the same thing about a bunch of stuff, right? Why do we have restrictive legislation on other things? Why do we have explicit provisions in labor law about how you treat your employees? You could use the same argument there and say you're allowed to do whatever you want, and if you treat them shittily, they're all just going to quit and your business is going to fail. There are other people, because now we're thinking about the directors and the shareholders. They're supposedly on the driving seat of this, right? But there are other people that we call the stakeholders of the business that don't get to make any decisions, but they are affected. So if in this place management makes idiotic decisions and they shut it down, all of us are going to be without a job, which isn't going to be very pleasant. It's going to be liberating, but not pleasant. So you could argue that the bigger the corporation, and here we're talking about the big ones, because the tiny corporations are not in the stock market. Big corporations failing because they refuse to follow best practice advice does have negative social consequences. It might affect employment. It might affect a whole bunch of other people who do business with them. When Carillion, the big construction company, went bust a few years ago, it wiped out an immense range of suppliers, contractors. There were people who were supplying them with the materials because they were a big construction company. There were a lot of plumbers, electricians, builders who were working for them that either lost their contracts if they were separate companies, or they found themselves directly unemployed. So there are negative consequences for the rest of society, or perhaps consequences destabilizing from the economy that can come about if a company is poorly run. So I'm not 100% on the idea that the shareholders might do stupid things and then they suffer the consequences of their own stupid decisions. Because when you get on the bigger scale, these consequences fall on other people who really are not to blame. This is not debatable in the law. Currently, corporate governance structures are not enforced through regulation. The system is called comply or explain, meaning the obligation of the corporate board is to follow the corporate governance code. And if they choose not to do so, then they need to explain why they're not following it to their own shareholders. What are the shareholders going to do? If they don't care, they do nothing. If they do care, they dismiss the board and change them with somebody else. That's what you do as a shareholder if you're unhappy with decision making. You get rid of these people and you put in place different people who are going to do things in a different way. I think this is weak as an arrangement. I think this might explain why we have like 10 different reports over the last 30 years talking about the same stuff, and we're still here talking about the same stuff, and we still got humongous corporate failures. Where are the corporate governance mechanisms in significant corporations like the ones run by Elon Musk? Where are they? So Musk buys Twitter. Twitter is a listed company, right? He buys it, buys all the shares, takes it private, wrecks it. So where are the corporate governance mechanisms to protect an overbearing individual who might be nuts or have an agenda that is personal, that does not align with the interests of the company more broadly? Where are the checks and balances for stopping him doing this stuff? Because thousands of people work for that company. Because Twitter could be considered global communications infrastructure. So it's not like I take over EDF, who is the company that runs most of the power infrastructure, I mean, in France as well, but I mean, even in this country, because here the governments have their own companies. They run a good chunk of the power infrastructure, right? They run the nuclear power stations. They run all sorts of stuff. Now, an overbearing individual buys it, takes it private, wrecks it, the thing shuts down, and the power goes off in the entire country, right? This has consequences. Okay, Twitter isn't as essential to life as having the lights come on, clearly, but a lot of people consider, because it's got tremendous influence and is one of the key ways in which people communicate globally, that it is something that is important. And guys, there are other investors in there. He's not by himself. He got a bunch of money from the Qataris. How do you think, basically anything that happens in the world has gotten a bunch of money from the Qataris? But he didn't actually come up with all the capital himself. He raised the money in order to buy Twitter. Some of it is his own money. Some money comes from other investors. These investors are represented in the shareholding and corporate structure somewhere, but there are absolutely no checks and balances. So Elon Musk is like a modern version of Robert Maxwell minus the cigar. And the fact that this won't fit and doesn't smoke on screen doesn't mean that he's got a different attitude to corporate governance. So 30 years down the line, we're watching in real time the same sort of corporate dysfunction take place. Now, this isn't a British company, okay? So I'll give you that. So it's the rules of a foreign stock exchange in a foreign jurisdiction that determines how it's run. But we have examples of significant corporations significantly mismanaged by overbearing chief executive officers, right? Which comes back to my original point that the system is not very robust. Because you can say whatever you want about, ultimate best practice in organizing corporate governance, but it's still weak. When you come across somebody who wants to do bad stuff, systems are not resilient enough. At the same time, that's human nature. People get co-opted, you push out the people who complain and all this. Yeah. So he got in trouble. Now Twitter lost the remaining of their advertising revenue because the big media companies pulled out because Musk has the habit of liking people's tweets, and these tweets very often say stuff that are hugely controversial. There's a lot of information about these debates and the way that these things are run that I think this presentation offers you a little bit of context as to how we ended up with particular impressions of corporate governance and particular understandings of what constitutes best practice. And also it gives you some information as to, even though we do have a developed understanding of what best practice is, we still have a huge number of corporate failures left and right. Now, I'm not arguing against failure in itself. Failure is an essential component of capitalism. This is how resources get recycled. Companies do well, they make money. After a while, they don't do well. If they don't do well, they fail. Somebody else takes their assets and puts them into something productive. That's why capitalism is such a dynamic system, because you don't allow things that underperform to survive for very long. Luckily, this does not apply to universities, so we're going to be around for it until the government comes and shuts us down. Let's take a step back and think for a second about the ability of the general meeting to influence what the directors are doing. As we've seen in the past, there are some stuff that the directors cannot do by themselves. That's it. They cannot change the articles. Right? They need majority. The majority to change the articles is at 3/4. The majority to dismiss the directors is at half, right? It's just an ordinary one. So if you want to change the articles, you need the general meeting consent. If you want to fiddle with shares, buy them, sell them, and all of the rest of it, when you're the corporation doing the buying and the selling, you also need the consent of the general meeting. If you want to excuse the directors for doing certain things that the law tells you are dodgy, excuse conflicts of interest and all the rest of it, we're going to see this over the next few discussions, you still need the general meeting to be involved. But that's pretty much it There are some specific areas that have to do with reacting to takeovers or things that you might do in the stock market, but there isn't a great deal of obligatory involvement from the general meeting. Now, if we look at how the general meeting actually makes decisions for itself, when the shareholders get together to decide stuff, would you say that this approximates what happens in a democratic state? So when we're talking about the shareholders voting and selecting stuff, does it sound like a democracy to you? I mean, there are certain provisions to protect their rights and they're not taking advantage of, but if you have a minor shareholding, then, it's very little, you have very little influence. The main difference between a political process and, say, the voting in a democracy and what happens in corporations is that in a democracy, at least in theory, every vote is the same as everybody else's. Now, the impact of exercising the vote might be different, right? But all of you here, regardless of if you're British citizens, regardless of background, you have a vote. So your vote is the same as the vote of a rich guy who is the CEO of a corporation or a bum on the streets, right? If you're all citizens, you all have the same vote. Now, in practice, because here in this country, you vote for people split in constituencies, if the percentages are fairly close, and the person who goes first wins, right, in an election here. So within these smaller units, the person that comes first is the person that gets elected. So if the overwhelming majority of people in your area vote for one person, then it doesn't matter how committed you are to voting for the other person is never going to win. So if your constituency votes 75% Labour, then you could be voting for whomever else you want. Labour is always going to win. So in that sense, even though you have the same vote as somebody, say, across the river, your vote might not have any real impact in your constituency, while if they're across the river and over there is probably neck to neck, then each individual vote might actually make a difference. I mean, in Richmond, the Lib Dems won the vote by like 40, 50 votes or something, and then they lost in the last election, and then they came back because it was all so close that if you are in a marginal constituency, then each individual vote has a lot more impact. But in theory, each vote is as valuable as each other. In a general meeting, this is not the case at all. First of all, you have as many votes as you have shares. Some people have got more shares than others. So how many shareholders you have in the meeting doesn't really matter. It could be that you got one shareholder with 90 shares and then another 9 shareholders that have got a share each. So one of you gets to decide everything all the time because the other people just don't have enough shares. And that's not even counting the fact that not all shares are the same. So you could have shares with different voting rights. You could be in a special class of shares that has got higher voting power than everybody else, or lower. Right? So the rights attached to the shares can vary, and how many shares of each shareholder has can also vary. Which means that when they get to vote at general meeting, then the outcome is dependent on the nature and the voting power of the shares. This does not mean that it's the same for each shareholder. That's where the sort of democracy analogy of this fails. But a lot of people, because they hear voting, they kind of think about the political process. And when they hear about a sort of separation of powers that approximates a constitutional separation, they think about the political process as well. So it's similar, but it's not the same. Today's presentation is about the meatiest part of what we do in company law. You're in for a good show. Director's duties. Director's duties is the most important thing that one needs to know about, both from an exam perspective, that if you're taking an exam at the end of the year on company law or business law, you're very likely to come across a question on director's duties. And for practical purposes, that most of the trouble that comes in company law comes because the directors have done something wrong. And this is important to know both if you're a shareholder or an investor in a business and if you're a director yourself. So if you do attain the position of a company director, then you would like to know what are the sort of bounds and limitations of your obligations, what entitlements you've got, but crucially, what duties you have in relation to the company, to the shareholders and the outside world. And we have come across a number of debates already as to why this stuff is important. Primarily, we have information on what happens when things go wrong. So you remember all this debate about powerful CEOs that do stupid stuff that then tank their companies, right? We've talked in the past about Robert Maxwell and examples of corporate mismanagement that had led to a lot of people losing their jobs in the end. And we have a great deal of kind of current examples of mismanagement, or at least it looks that way from the outside, like what Mr. Musk is doing with Twitter and some of these other companies. There seems to be something off about people who attain a position of power and then exercise that power to dominate the way a corporation is run without any consultation with anybody else. So understanding some basics about corporate governance and what is required by law that the corporate board does, and also what is considered best practice in relation to running a company, can offer some framework to people who are becoming company directors in how they can actually operationalize their duties and figure out what to do. So the examples that I discussed are people not doing their job properly. It's both an issue with the individual, but it's also an issue with defective corporate governance mechanisms in the company. A company will most of the time involve a great deal of people. So there are people who stand to lose out when things get off the rails. So we need to think about what can be done to prevent this from happening. We've already discussed that English law is not very pushy. So in terms of corporate governance arrangements, English law is not a system that it tells corporations how they should organize themselves, how they should organize the corporate board, how they should communicate, and how the shareholders should make decisions and so on. Beyond a basic framework that is built into the Companies Act, then there's a great deal of leeway in how companies actually behave internally. So it's the articles of association that are going to determine how the board takes decisions, how the shareholders take decisions, how they communicate with each other. I hope everybody is by now familiar with the distinction between obligatory, like mandatory, and default versions in the Companies Act, right? That there are some stuff in the Companies Act that you cannot deviate from. It's the same for everybody. And there are some stuff that says, here's the default position unless the company wants to do something else. So all the flexibility comes from these default provisions of the Companies Act, where people are given the opportunity to choose to do something different. So if we come back to the idea that you have a corporate board, the corporate board is authorized by law to run the show, cannot really be amended by different provisions in the Articles of Association, because the law, both in the statute and in case law, does say that the directors are the bosses. So you can arrange for more consultative practices in your Articles of Association, but you cannot undo this basic arrangement that the board of directors will be the body that makes decisions. Within the board of directors, though, you cannot have one individual that makes all the decisions and everybody goes to bed, right? Still, it's supposed to be an organ of the company. It's a community coming together to do stuff. So if you have more than one director, there should be a way that the others have input, because it is, in fact, required by law. Even though English law is not terribly prescriptive about organization, there are some basics. Ultimately, we discussed that the shareholders, if they're sick of the bosses, they can do what? So using section 168, the shareholders can dismiss the board on an ordinary majority. That's important, because if you're thinking, what's the worst thing that can happen to me as a director? And the answer is, well, you can get fired, then that should help concentrate the mind. The weakness with this is that usually by the time the shareholders figure out that you've done a terrible job, you've done the terrible job already. So we want some stuff that are prospective as well as punitive. It's okay to say that if the shareholders figure that the board is doing a terrible job, they've got the option to remove them, and they will always have this option because this is a mandatory provision. It cannot be taken away. But wouldn't it be nicer if corporate boards actually did a good job so they don't cause harm to the company, so the shareholders don't find out and then decide to get rid of them. So a lot of the things that I'm going to talk about today are about kind of front-loading this and making sure that things are run properly at the beginning before people get into trouble. So let's talk about the duties of the directors. These are in Chapter 2 of the Companies Act of 2006. There's quite a few of them, and to be honest with you, they could lay it out in a clearer way. Because if you go through the sections there, it isn't immediately obvious what they're talking about. So it's worth spending a little bit of time to figure it out. But the first question is, to whom are these duties owed? So to say that the directors owe duties, do they owe duties to the shareholders? Do they owe duties to the company? And what does this actually mean? The duties are owed to the company. They're not owed to individuals directly. I think this has some important consequences. If you are to complain that the directors are doing something wrong, you need to frame your complaint in that they're doing something wrong in relation to the company. They're breaching the rules or they're making decisions for the wrong reasons, but the damage needs to be common. It is not really possible for an individual shareholder to say that the directors are in breach of duty because they're taking actions that affect one particular shareholder in a particular set of circumstances. There are other avenues that somebody in a minority position can complain that they've been treated unfairly, but this isn't it. So when we're talking about duties, we're talking about the board of directors as a body or an individual director that has actually done something wrong towards the company. Maybe the effect is not felt in the same way by all the shareholders, but the victim of whatever is being going wrong is the company or the shareholders as a community, not as an individual. Now, could we argue that they owe duties to people external to the company? So that part is horribly mislabeled. You have a provision in the Companies Act that says when they're taking, and we're going to see this in a moment, when they're taking decisions in the interests of the company, the directors need to consider also the interests of stakeholders. Do we have a definition of who is a stakeholder? It could be creditors, right? The people that have given you money and you're meant to repay. If I'm just interested in it, or, I'm interested in fashion, but I've never bought a Dior outfit, right? So that doesn't make me a stakeholder because I'm a little bit removed. A stakeholder is anybody who's affected by the behavior of the corporation and is not already an insider. Insiders are only the directors and the shareholders. These are the only groups of insiders. Everybody else who's affected might be a stakeholder. Employees are not, they work for the company, but they're not insiders in the sense of decision-making. So employees are directly affected about what happens, but they don't get a say in what's going on most of the time, so they're stakeholders. The customers, anybody who lends them money, it could be trade creditors, but anybody who's waiting to be paid effectively. And it could be a large number of suppliers, people who are associated with them, whose own existence is dependent on the health of the company, but again, they don't have a say in how the company is run. If you're a farmer around here, you probably sell all your produce to the big supermarkets. You're dependent on them buying your produce, otherwise you don't have a business. But you got no control as to how they decide to buy stuff, use stuff, what prices they're going to pay. So you're in a position of weakness, and there's nothing you can do about it. By that measure, you could argue that the town where a business is operating, especially if it's manufacturing, could be one of the stakeholders because there's an impact on local employment. There might be an impact on the local environment. So again, these are people who are affected by the behavior of the corporation, but they don't really participate in decision making. So these are the groups of stakeholders, but the duties of the directors are not owed to the stakeholders. The duties of the directors are owed to the shareholders. There might be mechanisms in the law that create certain obligations to outside groups or the state or authorities in certain circumstances, but the baseline rule is that the duties are directed towards the owners of the company who are the shareholders. Do you need to be officially a director to be subject to those duties. No. You need to be somebody who is in a position of authority within the company. So when we were talking about corporate governance, you might have figured out that there are various types of directors. It could be that somebody is officially appointed and externally projects as a director and manager of the company, but there could be other people who actually exercise influence and control over how the company is run that don't have officially that title. And there are various provisions in the law that cover people who operate like this. If you look at Section 250, 251 of the Companies Act, it talks about shadow directors, it talks about other people to whom the management of the company normally looks at for advice. The director's duties will cover anybody who is officially appointed as a director, but will also cover people who are in this kind of background position of control, even if they don't officially have the title. Now, what about people in the management chain? As we said before, being a company director is holding an office, is not being an employee. It could be that a director of the company is also employed to be the CEO. Or it could be that there is an organizational structure and a management chain where people are tasked with particular responsibilities. These people do not owe directors' duties if they're not officially directors or if they don't operate as shadow directors. But management always reflects the wishes of the board of directors. So even though somebody has been appointed as a manager, there will be a director behind them who's responsible for that particular operation. So the director will always be responsible, and even though they have delegated some of their duties to a professional manager who is simply an employee. So there's always a line of connection and authority that goes back to the corporate board. What is the answer to this? Why is this important? It's important because you cannot say, it's not my fault because some professional manager decided to do something wrong. Since the directors have a continuing obligation to monitor and control, they cannot get away with it simply by saying they had passed on operational responsibility to somebody down the management chain. And in terms of time frame, the duties can survive the termination of somebody's appointment. Again, it is not as easy to escape your obligations by saying, well, this is going wrong, I quit. So from now on, it isn't me. Because you will still be responsible as a director for whatever you did that was wrong while you were a director, and that liability will chase after you even after you left the company. So from the point that you officially resign, then you're not responsible for future actions of other directors, but if you've already done something in the past that's wrong, then they will chase after you, even though currently you're no longer a director. So what are the actual duties? Right? Because we said there are all these duties and obligations, but what is it actually that is required of people? One of the key duties is to exercise a reasonable care, skill, and diligence. Meaning what? Meaning that you cannot suck at the job. Now, this is interesting because you might get the impression that if there is a duty to exercise reasonable care, skill, and diligence, this actually makes being a director equivalent to a job with a particular job description. But we had said that there are no objective criteria that you need to fulfill in order to become a director. What's the minimum age to be a director? So that's the only criteria. So long as you're over 16 years old, then you can become a company director. So clearly, if you appoint a 16-year-old to lead a company, maybe they lack the skill, care, and diligence to carry out that role. So how do we understand this? Is this an objective standard, meaning that there's a kind of baseline expectation of behavior, or is it a subjective standard? We look at the person, and depending on what they're able to do, so long as they operate at the best of their ability for the level that they're at, then it's okay. Now, having a subjective standard can be a problem, though, because if you're a complete talentless idiot, then you could do your best in being a talentless idiot, and the results are still going to be bad. So if you get somebody who really has no capacity whatsoever, and their record demonstrates that everything they touch turns to dust. So if you appoint them as director of your company, they're probably going to ruin the place, but they have performed to the best of their ability. They just don't have any. Yeah? So that cannot really be a good idea. So if we're looking at the duty that's in section 174, duty to exercise reasonable care, skill, and diligence, we need something a little bit more, or some sort of combination between an objective criterion and a subjective. So I explained why you don't want subjective, because somebody who's completely clueless would actually not be breaching the duty by continuing to be clueless. On the other hand, you cannot have a purely objective criterion. Objective is that you have a set standard of expectations regardless of who the person is. If the criterion is subjective, you got no expectations. It depends on the person. Well, that's the thing that I'm trying to investigate, right? Because for you guys, if you say, if we have a purely, look, I'll put it this way. We don't have a subjective standards in the way we assess students. We have objective ones, meaning we have a set of learning outcomes and we have a certain expectation on performance that you have to meet in order to pass. So it doesn't matter what your personal capacity is, there's a threshold that is set and is the same for everybody. If we had a subjective standard, then we would say, so long as you demonstrated some effort, you did the best of your ability, then that's great. But the best of your ability could be 70% or it could be 30%. So a standard that depends on the individual could actually be very, very low. A standard that is objective is set at one level, and then it doesn't care whether you perform a lot better or you perform a lot worse, so long as you meet that minimum. But what I was about to say is that an objective standard might not actually be a great idea, because it might set lower expectations than what we want. So if you set your objective really, really low, and you say just kind of a reasonable person who has finished school, then, a 16-year-old might fall below this, but this is really very low expectation for somebody who's, say, a senior manager somewhere and has been doing it for 20 years, right? You should expect better of them. So you cannot equate everybody down to the 18-year-old. So the law achieves this by having a combination of those standards. It says there's an objective standard of care, skill, and diligence for everybody. So there is a bare minimum. So you cannot excuse dreadful performance by just saying, I'm a clueless idiot. But if you know better, then the standard is elevated depending on your personal ability. So what we have now is an objective standard plus. The plus means we will expect higher of the people who actually know better. So there's an objective baseline and then a subjective criterion that can get higher depending on who the person is. That way, we don't excuse really incompetent behavior. Nobody's allowed to do this. But if you are a seasoned operator and a kind of senior executive that get paid a lot of money, or at least they think they're worth a lot of money, then we expect them to operate at that higher level. So it's not an excuse for somebody at the top level of the expectation to say, I performed as well as your average 16-year-old. Because due to their background and experience, there's a higher expectation of performance from them. So you're going to see this if you read the details of what is in section 174. And this comes from case law that had developed over the years. So this 174 is the section that is entitled Duty to Exercise Reasonable Care, Skill, and Diligence. What the section does is that it basically puts in statutory language what had been arrived at the case law before this. So we have a lot of cases where the courts actually try to explain how you have an objective base and then a subjective top-up to the expectation on the behavior of company director. Now, an interesting or an obvious question is what happens if you breach that duty, if you perform incompetently? So if you fall below the expected level, wherever we set that level. You can compensate the company if the company has suffered any loss. And that's the same issue with everything else. If you remember from contract law, you don't claim compensation simply because you're the victim of a breach of contract. You can only claim compensation if you have suffered loss in terms of money. So if you cannot quantify your loss in money, then you got nothing to ask. A bad business decision will not necessarily be a breach. Violating the rules will be a breach. So if they violate the Articles of Association, it will always be a breach. But if the company has not suffered any loss, there's nothing to compensate for. So they took the decision to sell a company asset without getting permission from the rest of the board or without getting permission from the shareholders. And the Articles of Association said you cannot sell something major without the shareholders approving it first. It needs to be written in the articles because there are no limits to decision-making generally by themselves in the model articles, apart from certain categories that the Companies Act requires some consultation. But if the company wanted to restrict the ability of the directors to do certain things, then they need to amend the model articles to put that in their Articles of Association. So if it says you cannot sell a major asset, right, and a major asset is defined as something that's worth more than £5,000, and one of the directors comes across somebody who says, I absolutely need a van for tonight and I cannot find anybody to rent me or sell me a van and I'm willing to do anything, I'll pay whatever to get a van, I absolutely need to have one. And they've got a company van that's worth £6,000, for which they would need to get permission to be able to sell it. And instead of getting permission, the director says, I'll sell you this van for $10,000 right now. So this is a violation of the rules. So it's a breach of duty. Not respecting the company's rules is a breach of duty. But the company hasn't suffered any loss. In fact, the company made a profit because the market value of this van was not above $5,000 and they sold it for $10,000. So they can actually go now and buy another van for $5,000, that's going to be the same van, and it's not a problem, right? And they made a $5,000 profit. So you can have situations where the directors have breached their duties, but this has not resulted in any loss to the company. So then there's no remedy to this. The only remedy to this is if the shareholders disapprove of the directors breaching the rules, they can dismiss them and replace them with somebody else. But they're not going to be asked to pay compensation to the company unless the company can demonstrate that they suffered some loss. Same as contract. There is this idea, this principle that's called efficient breach of contract. What does that mean? It means you can choose to breach your contracts. And so long as you compensate the other party for whatever loss they're suffering, it's okay. But you're not allowed to beat people up because you disagree with them. And you're not allowed to smash something because it offends you, because that would be a criminal offense. But you're allowed to breach a contract, not perform on a contract, and so on. Somebody hires me to come in here and deliver a class. At the same time, somebody else comes along after I've signed this contract and I'm committed to coming here at this hour and delivering this class. Somebody else comes and says, if you come and teach for us Monday morning, because, our teacher is sick or whatever, we'll pay you 3 times as much as these guys are paying you. I could choose to go to the higher thing and breach this contract. And then, obviously, I'm not going to ask for payment. If they had paid me already, I need to return the money. If they need to hire somebody else at a higher cost, I still compensate them. I may have to compensate them for that, but I'm allowed to do it. So there's nothing that forces me to perform on a contractual obligation. The only obligation I'm going to have, if I'm pursued in a civil court, will be to compensate the party for whatever loss my breach has caused. Same thing here. If a director chooses to breach their duties and there is no financial consequence on the company, there's no loss, then they're not going to have to pay any money. Then the question is, are the shareholders happy to let them get away with it, or do they choose to dismiss them, taking the fact that they've been in breach as a valid enough reason to dismiss them? To be honest, they don't need a valid reason. They could just say, we changed our minds about you, which is also fine. Normally being in breach of duty is what leads to discussions about whether somebody is a suitable person to be in the board of directors. The other duties come under the label of fiduciary duties. You guys know why we use the term fiduciary, what it means? If you say that you've got there are equitable considerations, it has to do with justice and achieving justice and fair outcomes. If you're talking about fiduciary duties, you're talking about duties that exceed the contractual arrangements. So you've got a duty of care towards somebody for some reason. It implies a closer relationship that goes beyond the strictly money relationship. So these fiduciary duties are because there's a duty of fidelity and care that the directors owe to the company. The reason why they say this is because these are a little wider ranging than just a checklist of obligations. If you tell people you need to act within your powers, that's pretty specific because that's the paperwork. But if you tell people you need to act with somebody else's interests in mind, this is a little bit broader. So because it leaves flexibility and room for interpretation. So you're going to find a lot of discussion about these fiduciary duties, but if you're trying to answer some sort of problem question that contains somebody who has done something seemingly inappropriate, I wouldn't start with a definition of this, and I wouldn't start talking about fiduciary duties. I would stick closer to the provisions in the statute, because the way these concepts are presented in the textbooks and in the case law, they tend to be a little confusing. But if you go from the sections in the statute, it becomes a lot easier to identify what has gone wrong. Because the statute gives you a list. Here, they're obligated to do this, they're obligated to do that, they're obligated to do that. So figure out which one of the obligations seems to be violated, and then if you want to label this as a fiduciary duty or something else, you can do that later on. That ensures that you start from something specific, so you have the correct section that you're discussing, and then you have all the discussion. As opposed to starting with, let's check if this director has breached the fiduciary duties, which could be like a gazillion different things. Right, so let's have a look at things that come within that, like these categories of obligations. The most obvious and the easiest one is that they have a duty to act within their powers. So they cannot do whatever they want simply because they've been appointed as directors. They're meant to stay within the powers that have been given to them. So this is in section 171. That's why I'm saying, because the sections have quite a descriptive heading, it's always easier to start from the statute and figure out, okay, this person has been accused of having done something wrong. What does this look like? Does it look like they're doing random stuff, for instance? So I have a section here that says act within your powers. If you're doing random stuff, you seem to be breaching that. They must act in accordance with the company's constitution. If the articles say you don't take a decision on this thing without asking the shareholders first, and the director just took the decision, as in the example I gave you, then they are in breach of section 171. Because they did not follow the procedure set in the articles in order to do something. So if a director files paperwork with Companies House to dismantle the company without asking the shareholders first, then they are in violation of... So the articles will be whatever it is for this particular company, either the model without any amendments or the model with whatever amendments, and these are publicly available documents, so you can go to Companies House and download them. So there's no debate. Nobody should be confused as to what the articles say. You can get them and you can see what they say. So obviously the person who should have a good look at them is the director, because if they start doing stuff at random without looking at the articles, then they run in danger of some violation. So if they don't respect the limitations to their powers set from within the company, then they are in breach of their duty. And also, they're obligated to exercise the powers that they have for the particular purposes for which they were given those powers. You can have, as a company director, a credit card that's got your name on it, because otherwise it's not going to work, but it is the company's credit card. So it's the credit card that's linked to the bank account that belongs to the company. You're supposed to use that credit card for company business. So if you use it to buy yourself like a Black Friday deal for yourself, then you had the right to use the company credit card as the director, no problem, but you used it for the wrong purpose. You were not using it for the purpose for which this power was given. You used it to purchase yourself a gift. So that is a violation. So not only you're supposed to do stuff that you're authorized to do, but also you're supposed to do these things for the authorized purposes. Now, 172 is when it gets a little bit broader and contains some concern for the interests of stakeholders that we mentioned earlier. So 172 is the duty to promote the success of the company. So directors are obligated in good faith to promote the success of the company for the benefit of the members. They work for the shareholders. This is what this means. So this offers an answer to the question, what are they supposed to be doing? Who do they work for? Who is the boss? So section 172 says that ultimately the boss are the shareholders. So when the courts have tried to define what do we mean by company success, the answer has been financial gain for the shareholders. It does say, there's a kind of note to this section that says, while they're doing this, promoting the success of the company, they're supposed to have regard to long-term consequence of their decisions, the interests of the employees, the interests of suppliers, customers, and others, the community, the environment, maintain high business standards, act fairly amongst the members of the company. So this incorporates in this provision some concern for the stakeholders. What do you think is going to happen if a director says, I only care about my shareholders, I don't give a damn about anybody else, therefore I'm not considering the interests of employees, suppliers, customers, business. I'm not doing that because my sole focus are the shareholders. It is a breach because the law says, the way we define it is that you need to think about these things. Saying that I am not going to do it, it's a breach of 172. Because 172 says, when you're promoting the success of the company, you have to consider it. But if the director says, I've considered it and I don't want to do anything about it, so I'm taking actions only when they make money for my shareholders, and even though I've considered the impacts this have on employees, creditors, the environment, the community, I'm not actually going to do anything about this, then they're fine. Because the section says you need to think about it, it doesn't say you need to take certain action. And in any event, the only people who are in a position to kind of discipline you if they think you're not doing a good job are the shareholders themselves. So if a director says, I consider these things as I'm expected by law, but I don't take any action, it's up to the shareholders to say whether they agree or disagree. If the shareholders are cool, nothing happens. If the shareholders are not cool, then they can dismiss this director or this board and replace them with somebody else. That's why this should not be interpreted as a provision that obligates corporate boards to think about interests of stakeholders, because it isn't very strong. It's a very, very weak provision. If you wanted them to consider the interests of stakeholders, then you would have attached some penalty when they decide to do nothing about it. So this is a common theme in kind of essay questions around this area, because it causes a great deal of discussion whether this provision is enough in incorporate things like corporate social responsibility or concern about stakeholders in the environment, or whether it's not. So you will find evidence in the literature that point one in the other direction. My personal view is that it's quite weak because it does not necessitate any action. Come back to it. Company success is very much money-making for the shareholders. The only way you can improve this is if you're thinking not just the current shareholders, but future shareholders as well. Because you should be thinking not only making money for somebody who has the shares now, but keeping the company alive and successful for the people who are going to be shareholders in the future. What happens if you're in a group of companies? You don't care. Because if each company is separately incorporated, and each company has its own corporate board, so the emphasis is on the board that you're running. So if you're a director, you're looking at your own company. Maybe you're a subsidiary in a group, and maybe the group has a strategy and a plan. It's cool and it happens. It could be that the parent company is also the sole shareholder, so there's an alignment of interests in that regard. But when you're making decisions, the legal obligation is to think about what you're doing as a corporate board for this entity, not for the parent or other subsidiaries or anything else. Another one of the duties, so far we've seen staying within the powers, acting in the interests of the company. Now we're getting to a duty to exercise independent judgment. So you see, when I said earlier that you're allowed to have a management chain and other people in the organization that may or may not be directors, but this does not excuse you from doing your job, this is why. Because in section 173, it says a company director must exercise independent judgment. And this means that even when they have delegated to other people, they have a continuing obligation to oversee and consider what these other people are doing. So let's wrap this up. What have we seen today? We've seen that the directors owe their duties to the company, to the shareholders as a community, not to individual shareholders one by one. That they have overall a duty of skill, care, and diligence, which is expressed in section 174. Which is an objective standard with a subjective top-up. So if you know better, you will be held to a higher standard. And then we started to investigate the broad array of other duties, starting with 171, which is the duty to act within the powers, 172, which is the duty to act in the interests of the company, and we defined the interests of the company as mostly financial. And finally, the duty to exercise independent judgment, meaning that you cannot subcontract your decision-making to somebody else and then go home. While you're acting in the interests of the company, then you do certain things according to the company agenda, of course, in the way that it's framed in the articles and all the rest. But this is the sort of baseline of what you're supposed to do as a director. And there's no going around this. If you didn't want to do all this, then you shouldn't have accepted the position of a director somewhere. If you want this to be very engaging, and if you're actually spending a great deal of time and this becomes a significant proportion of your engagement for your daily activity, then it probably is sensible for you to be an employee as well. If you're working for your own company, that's fine, right? You don't need the specific role as we said in the past. But if you're working for somebody else's company and you become a director, then it would be sensible that they also hire you as an employee. So then you've got this additional layer of framing expectations as to what you are and what you're not supposed to do. So the vast majority of people who have a board position, they will also be hired as employees. The problem that comes out of all of this is that you're supposed to be running things in good faith on behalf of somebody else. But the somebody else is not really an entity with a personality. So you're supposed to be doing stuff on behalf of the company, and you shouldn't equate the company with the existing shareholders, because the existing shareholders obviously have got personality. Either the shareholders are individual people or they're another corporate entity that is run by somebody. So you actually can talk to them. You can figure out what they want. But your obligation as a director is to the company's existing and future shareholders. So there's always an element of what constitutes the company that goes beyond the people you've got in front of you right there and then, which is tricky, right? You're supposed to imagine this virtual entity that you're supposed to be working for and then figure out what is the best way to serve this entity for an indefinite amount of time in the future. When it comes to dealing with everyday business activity, you will very quickly come across the potential to benefit yourself as opposed to benefit the company. Or you might have difficulty actually figuring out what benefiting the company should mean and how you should react in any given situation. We've said already that directors are fiduciaries, meaning that they've got duties that go beyond the purely contractual. So your obligations as a director are not just contained in the articles of association, in shareholder agreements, perhaps an employment contract that you've got with a company. They actually go a little bit beyond this, because the whole concept of fiduciary kind of bleeds into elements of trust and the law of equity, how you've got a duty of fidelity to somebody else, to act with their interests in mind. That's why we've got all these rules that are supposed to deal with the potential of conflicts of interest between your own personal interests as a director, as a person, right? And then the interests of the company as this kind of nebulous artificial entity. The law has struggled to deal with this, and what it boils down to is that you're under an obligation to avoid a situation of conflict. There's a difference between saying you shouldn't be in conflict and in saying that if you are in conflict, you shouldn't harm the company. It is sometimes very difficult to figure out in a situation of conflict whether you're causing harm to the company or not. So the law sets the control at an earlier level. So you should not be in conflict to begin with. So the obligation is that every time that a director finds themselves in a position of conflict, then they need to disclose that conflict either to the other directors in the board or to the shareholders, depending on circumstances, and extinguish that conflict. If the conflict is not extinguished, it will be considered a breach of duty. And I want you guys to be very careful with this and remember this. We're not waiting for the conflict to cause damage to the company. Being in a position of conflict is bad in itself. So it is itself a violation. Now, if you went above and beyond this and actually caused financial damage to the company, then it generates an obligation to compensate. But the conflict in and of itself is a problem. So to sell, my equipment to my company is a problem in and of itself before we started discussing the price that I sold the stuff at. So this is expressed in the list of duties that you've got in the Companies Act in a variety of places. For instance, you've got Section 177, which says that there's a duty to declare an interest in a proposed transaction. What does that mean? That if you are planning as a director to do something that brings together yourself and the company, then that creates a situation of conflict. The way to avoid the situation of conflict is to declare the involvement that you have in this. So you have to make a disclosure to the rest of the board and explain everything that has a personal interest of yours in relation to something else. So we're talking about contractual and non-contractual arrangements. There are a variety of ways in which you could be involved in something else. You are selling your stuff to the company, or you are buying company's property. This puts you in a position of conflict. Either you or a person connected with you is doing such a thing, like a family member, right? Or your spouse, or your husband, or whatever. This is not allowed. You can only proceed with this if you have disclosed to the board of directors and the board of directors says that it's okay to do this. It does not matter whether you were planning to sell your stuff to the company for £1. It could be that you're actually trying to benefit the company. So to save the company the expense of buying new equipment, you've got all the IT equipment that you don't need anymore. Instead of kind of putting it on eBay, you're just giving it to the company for £1. Because you're the one giving it to the company, it's still a conflict of interest. And you need to disclose the interest in the proposed arrangement, even if they're just giving you £1 and they're getting valuable things in return. Equally, if you were buying something off the company and you were actually buying it for a great deal of money because you wanted in that way to contribute to the company's finances, like you're buying a laptop that's worth £100 and you're paying them £500 for it, it doesn't matter that the company is benefiting. It is still an interest in a proposed transaction that you need to disclose. What happens if you don't disclose? Then you're in breach of your duty. And that generates an entitlement, if the company has suffered financial loss, to pursue you in the civil courts for compensation. In reality, what's actually going to happen? Well, not much, because if they haven't suffered loss, you forgot to go through the disclosures at an appropriate time because you thought this is beneficial to the company anyway, or you thought that everybody knew already, right? It is a breach of duty, but if the company hasn't suffered any loss, then they're not going to sue you, are they? But our aim here is to be able to advise people who are in the position of director as to what they're supposed and what they're not supposed to do. Every time the message is clear, every time there's a potential conflict in a proposed transaction, they are obligated to run this by the other directors and inform them about what's going on. It gets worse if you're dealing with not a proposed transaction, but you're dealing with an existing transaction. So this is in section 182. It's got similar things, but there are worse consequences. So you need to tell the other directors, and if the directors are not available, then you need to tell the shareholders, if you have an interest in a transaction that's already taking place. If you don't do this, then section 183 makes it an offense. If there's been a violation, but the company has not suffered any loss, then they're not going to sue you for damages. You can only sue people for damages if you've suffered loss. It means that there's been a breach of duty, yes, but then it's up to the company, effectively the shareholders, how to respond to that breach of duty. We were talking about this when we were talking about the general duties as well. What happens if you exceed your authority, right? If you exceed your authority as a director and do something that's not authorized, then this is a breach of duty. But if the unauthorized act actually made the company money, they're not going to sue you for losses, are they? But the idea is that
people breaching their duties are probably not doing a terrific job. And perhaps they're dangerous for the future. So the fact that something has been logged as a breach of duty and notified to the shareholders then empowers the shareholders to take some action if they think the director should be penalized somehow. But they cannot actually ask the directors to pay them money if they haven't suffered any losses. We saw that in the general duties, you've got the duty to act in the interests of the company, but you've also got the duty to exercise the reasonable care and skill. So one was 172 about acting in the interests of the company. 174 is care and skill. If you don't check what you're actually buying, are you exercising reasonable care and skill? So that if you don't, then that would mean that you're breaching your duty. But it happens by accident that, the old, seemingly useless iPhones you bought or whatever you bought, then are collector's items, right? And you sell them for a fortune. So you have been negligent in carrying out this transaction, but it could have a beneficial outcome, in which case you've got this bizarre situation that there is a breach of duty, but the company hasn't suffered any loss. So the shareholders can still be unhappy with the directors for not doing their jobs very appropriately, but it's like saying you deal in some sort of, kind of rock band memorabilia. It could be that no matter what it is, it will sell at auction. A director who doesn't actually check what it is that they're buying, so they agree a price. So if somebody comes with a box and says this is filled out of stuff that Metallica fans are gonna love, and you're gonna sell it for a bundle, and you're gonna go and you don't open the box to see what's inside, then you're not doing a fantastically good job, right? So then it's a coin toss whether there's something valuable in there that benefits the company, or whether, because you couldn't be bothered to check, you've actually bought a bunch of junk that's gonna lose the company money. But what I'm trying to get to is that we have a problem if you're in a position of conflict and your duty as a director is to disclose this. If it's for a proposed transaction, something that hasn't happened already, then you can let the other directors know. If they approve it, you can go ahead with it. Okay. But if it's for a transaction that has actually happened already, then not only you're under a duty to disclose the interest you had, and then depending on whether the company has suffered any loss to compensate when they ask you for it, but it's actually an offense if you fail to declare an interest. So Section 183 says that anybody who fails to comply with the requirements of 182, which is declaration of interest in existing transactional arrangement, commits an offense. And if you're found guilty of this offense, you're liable to conviction on indictment or a fine. Rich people don't like going to prison. This is bad, right? So you're going to attain a criminal record just by being negligent as a company director. Now, why do you think there's a criminal offense attached to this? Why don't they just say, as in the previous section, it's a civil thing. If there's losses, you compensate. Why do we need to make this criminal? This is important enough to carry, at least the legislator thinks it's important enough to carry a criminal sentence to kind of highlight how significant it is. Because the problem with fines, if the fines are not of a criminal nature, if it's a civil fine, there's a thin line between something being a fine in the form of a penalty for you having done something wrong and something being a fee that you pay to obtain a different service. And usually the distinction between is this a penalty or is this a fee is the cost. So if I can park my car on the street and I need to pay the council visitors parking at £10 an hour, then I would consider this to be a fee to be allowed to park and not a penalty. If I park without paying for the parking and then I find a ticket on it that's £500, then I will probably think that, okay, I've done something wrong here and now I've got a fine of £500. But if the fee for the parking was 10 per hour and the fine was 50, you might think that if you prepay or if you organize this, it costs you £10 to park. And if you just don't want to be bothered, it costs you £50 to park. That's why you need to think in different situations when you're trying to disincentivize behavior, you need to think very carefully
how do you set the penalty? Because if the penalty is set at a low enough level, people might perceive it as a fee for an extra service. So you're not allowed to, when they're boarding people at the plane, you're not allowed to cut the line, right? If there's a queue. So if you cut the line and you're disruptive, they might deny you boarding. But if you've paid EasyJet an extra £20, then you can cut the line. So is this a penalty or is this a fee for a different service? When the legislator has to think about these things when setting these systems up, they wanted to be sure that the penalty for failing to disclose an interest in existing transactions is significant enough for people to understand that this is something they shouldn't be doing. And that's why there's a criminal violation attached to this. Now, do people seriously get prosecuted on these? I don't know. We need to look at statistics, but the threat of prosecution should normally be enough. Now, there are certain things that you cannot get away with simply by disclosing the conflict of interest to the board of directors. There are some things that you need to go to the shareholders. For instance, what if you're having an external incentive? Now, remember that for you to be in a conflict of interest, we're talking about contractual and non-contractual benefits. It could be that your interest in the transaction is not because somebody makes money out of this. It could be that you want to, like you make money out of this. It could be that you want to give the job to a family member. So if you're in charge of purchasing for the company and you choose the suppliers amongst your family members, this is a conflict of interest because you have a different motivation than purely the success of the company and you're not running the procurement process properly. So I'm not saying that you're only going to be in a position of conflict if you or somebody within your immediate family is doing stuff. It could be that you're arranging it in a way that you're somehow connected, even if you're not part of the contract. That's why these things are saying either contractual or non-contractual. But there are other interests you might have had. If you're in charge of booking stuff or buying stuff for the company, and you make the selection of where to buy stuff on the basis of which referral site gives you the highest cashback, then that's a problem, isn't it? It could be a problem both in the sense that you're not acting in the best interests of the company, so you're breaching the general director's duties, so your motivation is not getting the company the best price, your motivation is getting you the highest amount of cashback. But also it could be that you're more intimately involved and you're having direct benefits out of this business. It could be that somebody is paying you an incentive. So if somebody's giving you a bribe, for instance, to do something, then we have a problem both for the conflict rules and on the general rules as to whether you're acting in the interest of the company. So there are certain circumstances for certain types of conflicts where it's not good enough to get the permission of the board of directors to distinguish the conflict, but you actually need to tell the shareholders at the general meeting. So what you're doing is actually dodgy enough that you need to be sure that all the shareholders are okay with it. For instance, there are certain things in the law where you do need to involve the shareholders. It brings us back to discussions we had previously, right? If we're talking about the substantial property transaction, so for Section 190 of the Companies Act says that if the company is dealing with something that is big, so this is a substantial asset of the company, then, and there are mechanisms to determine what is substantial or not, but then it's not enough for the board of directors to approve it. You need to go to the shareholders. This isn't necessarily involving a conflict. It just means that sometimes you take decisions on stuff that are so significant that you need to kind of bring the shareholders in for their approval. So if you go and approve something that counts as a substantial property transaction and you haven't run it by the shareholders, then they might sue you for damages. This is a civil thing. They might sue you for damages if the transaction has actually resulted in loss to the company. If there's any loss, it doesn't even need to be a substantial loss. So if the directors have done something in breach of their duties which has caused loss to the company, then the company, not the shareholders individually, but the company can sue the directors. Yeah, because otherwise it gives the directors impunity to do whatever they want. what if the company makes a loan to the directors? Right? There's huge potential for conflict over there. Either the company gives the director money directly, or it offers a guarantee or provides security for the director to do something else. Now, this is allowed, right? For private companies, this is allowed, but it could be wholly problematic, and somebody needs to check that the company is taking the decision to do this for the right reasons, and that the loan is given on commercial rates, that the director is going to pay some interest, there's some provision for the repayment and all of that stuff. So that, because it's significant, it needs to be approved by the shareholders. Now, why do we have this dual level of approval? Why is it okay for certain things to go to the directors for approval and certain things need to go to the shareholders? So if we're talking about something major, like buying something huge or selling something huge or giving loans to the directors or other types of benefits, then surely the people whose money is on the line should have a say in this. But there's a more obvious problem. The problem is that the directors could be all in on it. So if we're talking about major things that are beneficial on a personal level, the directors aren't like hundreds of people. They're a closed, small group. So they could all be in cahoots. But since we're talking about a small number of people, there needs to be some external control that at least somebody in there is acting independently with the interests of the company in mind. So if this year one of the directors gets a loan, and next year another one gets a loan, and the year after another one gets the loan, or they're continuously involved in transactions that create a conflict of interest, and the board always approves them because they know that next time is going to be them and the rest are going to approve their misbehavior, you could end up with a closed loop there where people are kind of approving each other's misbehavior to the loss, significant loss to the company. So for fairly mundane, everyday stuff, there can be disclosure to the board, and that is sufficient. But significant stuff, either in terms of volume or in terms of importance, like loans and stuff like that, then the shareholders need to be involved to avoid the potential that all the directors might be in on the same trick. When the company engages in a transaction with a third party in breach of duty, then the third party is protected, so you cannot undo the transaction. But if the transaction is with an insider, then if the transaction has been done in breach of duty, then you can cancel the transaction. So if an asset is sold to a director, and then this kind of breaches these rules, it was not sold at an appropriate value and so on, the court can order the director to return the asset. So if the parties to the transaction are within the conflict, then the court can always order them to undo the transaction. So for a loan, for instance, if they haven't gone through if the board has authorized the loan, but they didn't bother to tell the shareholders, and according to these rules here, the shareholders should have approved it, when the shareholders figure it out and they go and complain, then the loan will be cancelled and the director will need to return the money. So there's loans, but there's also other things that are called quasi-loans, which is guaranteeing people's transactions, offering credit, offering stuff like that. So it's not only like a straight out loan, we give this person like £1,000 or £1 million. It could be that the company is supplying a credit card to one of the directors and facilitating their transactions in that sense. And it also includes other stuff like guarantees for other people's loans and offering security so they can get funding from third parties and all the rest of it. So all of that stuff, because they're very bad, they need to be approved by the shareholders. So our overall instruction is that the directors are under a duty to avoid conflicts of interest. This is in 175. And this nails down what I told you, that being in conflict is a problem in itself, and you don't have to wait for the consequence. And then we've got all the other provisions that are dealing with specific expressions of this conflict of interest. One of the things that has created a great deal of anxiety is how do you deal with a corporate opportunity something valuable as a business opportunity that the company could do, but something that the director is also interested in. And, these people are in this business because if they are, usually people become directors in companies that they understand something about the business. So it's very likely that they might be interested in something on a personal level as well as in their capacity as representatives of the company. So what happens if a corporate opportunity comes about, the director tries to convince the others in the board to do it. The others in the board, the other directors don't want to do it. And the director says, okay, I came across this opportunity. I brought it to you guys. You don't want to do it. I still think this is a valuable opportunity that otherwise is going to waste. I'm going to do it for myself. So since you guys don't want it, I'll do it for myself. Now, do you think that this should represent a conflict of interest? So the company has been presented with the opportunity and they said that they don't want to pursue. Like somebody's trying to sell a box of band memorabilia. And this is relevant to the company's business. And it comes to me, I present it to the directors. The directors are like, no, we don't think we can sell this. And I tell them, look, seriously, right? This is stuff that actually sells for quite a lot. We can put it for auction. We can even put it on eBay. And they say still, no, we're not interested. We don't want to do this. It's kind of small time stuff. It's a waste of our time. And I tell them, okay, in that case, I'll buy it. And then I'll put it on eBay by myself. Well, look, if you're working for multiple companies at the same time, it is difficult to work for companies in the same field at the same time. Because you have a duty of fidelity to the company and you have a duty to promote the success of the company. So if you're a director in two companies that are on the same field and an opportunity comes around, then how do you determine which company you take this opportunity to? So inevitably, the one that you didn't take it to, you're going to be in conflict. You're going to be in breach of your duty. So that's why, I can teach in a bunch of places different things, or even the same thing, and it doesn't create a conflict of interest. But if I was doing admissions and I was trying to convince students to come to an institution, I cannot simultaneously do this at two institutions. Because if I'm meeting the same pool of candidates, then I need to make a choice. Do I send them to one university or the other? And then the one that I'm not sending them to would complain that I'm in breach of my obligations, and very rightly so, right? So you cannot really be a director and fulfill your duty effectively if you're director for two companies that are doing the same thing. You can be director in companies that are doing different things. You could be a director or you could be in the board of governors of a university, and you could also be in a finance business. This is like quite distinct, right? That's fine. The problem with the corporate opportunity is that if you want to take advantage of something that you came across in the context of your work as a director and to do it for yourself or to take it to somebody else, then you need to disclose this as a conflict and get them to disband the conflict and get express permission to do it before you do it. If you don't ask for their express permission, simply the fact that they didn't want to pursue it is not license for you to do it for yourself, because you're still in a conflict situation. So we've got case law where this has been tested. So I'm quite secure in saying this. You've got cases like Regal, Hastings, and Gulliver. You've got Industrial Development Consultants versus Cooley. You've got Canadian Aero Service versus O'Malley. You've got Buller and Buller, which is a more recent case from 2003. In all of these cases, the court said, if something is a corporate opportunity, the role of the director is to convince the company to do it. If the other directors say, we don't want it, if you're so convinced that this is a valuable opportunity, then it is your job to convince them to do it. You cannot simply say, I learned about this, I brought it to you, you said yes, and now it's a free-for-all and I can do whatever I want. If you have failed to convince them to do it, then if you still want to pursue it for yourself, it is your job to then present it as a conflict of interest that needs disclosure and approval before you can do it. you need not only that they don't want it, that they're okay for you to pursue it. Because it could be that they don't want it, but also they don't want you to do it. And it's within their rights. I know it sounds unfair. It sounds like they're stupid and they're not taking advantage of something valuable, but they're under no obligation to let you do it if this is flagged as a conflict. So in the result of all these cases is precisely this, that you are not allowed to do it. If it is something interesting, it is your job to convince them to take advantage of this interesting thing. So yeah, and if this feeds into a concern about you working for other people at the same time and holding multiple directorships, then yeah, holding multiple directorships in companies that are in the same field, even though it is not strictly prohibited, it's actually impossible to effectively do, because every time you make a decision, you will be in breach of your duty of fidelity to the other company. Now, there are some clear stuff that you shouldn't do. For instance, you cannot accept bribes. So Section 176 says very clearly, you're under a duty not to accept bribes from third parties. Because this clearly destroys your motivation. You are no longer motivated by the success of the company, you're motivated by money that comes in your pocket. So if you are to get authorization from this, then you need probably to get authorization from the shareholders to be on the safe side, because nobody's going to look happily on you accepting bribes. So this is one of these situations where authorization from the board is not sufficient. Could be that all the board is in the habit of taking bribes when they are actually trying to procure services for the company. If a bribe has been paid to a director which resulted in a contract with the company, then the company can rescind the contract between it and the third party. We said normally third parties are protected, Section 40 of the Companies Act and so on, but if somebody is paying a bribe, they are complicit in a violation. They know they're paying a bribe. If somebody is dealing with a director on the normal course of things, they don't know if the director is exceeding their authority. But if they're paying a bribe to the director to get that contract instead of a competitor, they are complicit in the violation. When the third party is knowledgeable or complicit in the violation, then whatever contract they've done can be undone. Now, we said as regards the remedies for these breaches of duty, we said generally, for the general duties, the breach is in a civil action to ask for damages if the company has suffered loss, but there are a few occasions where there might be a criminal act attached. For instance, when you have failed to disclose an interest in an existing as opposed to a future transaction. Now, depending on the circumstances, it's possible that the board or the shareholders excuse something that the directors otherwise would not be able to do, or they would be in a conflict. There are also some provisions where the company could take the decision to protect the directors from liability. This is in Section 232, but this is carefully controlled. There are also carefully controlled provisions as to whether the directors could have insurance, or there could be some indemnity provisions that effectively take over the cost of them breaching their duties. Now, the reason for controlling this carefully is obvious. It gives a license to people to misbehave. So if the company offers a guarantee to the directors that if you breach your duty and then you have to pay compensation, then we're going to refund you the compensation, it's as if you didn't have the duty to begin with and you can do whatever you want. So buying insurance to cover breach of duty, offering coverage for the liability, or offering indemnities in case something goes wrong is something that is very carefully controlled in the Companies Act, and even worse controlled for companies that are public or listed in the stock market, because then it affects a greater number of people. So the whole array of directors' duties is there to inform people how they should behave in the absence of something really bespoke and personalized like an employment contract. In most situations, you don't have to worry about the general rules on what you should and you should not be doing, because you will have a written employment contract that nails down very specifically what it is that you're supposed to do. But being a director is not a job. Therefore, you've got this list of director's duties that operationalize and give context to the way in which you carry out your role. If you have a professional engagement and an employment relationship with the company, then in addition to the director's duties, you will have certain obligations as an employee. But remember that the consequences of breaching a duty and the consequences of breaching your employment contract will be different. And that's why they can fire you from being a director without much consequence, but they cannot fire you from being an employee. That's why somebody who's done a poor job, but not poor enough a job to actually warrant dismissal from their employment contract, they lose their position as directors, and then the company terminates their employment contract and needs to pay them compensation. That's why you've got all these kind of high-flying executives in finance that have done a terrible job, and they've lost their companies a great deal of money, and the shareholders dismiss them from their position as directors, but this is then considered an early termination of their employment contracts, and then whatever compensation provisions you had in there kick in. So they leave their director's job for having done a terrible job, but then they get a payout in the millions because their contract of employment is terminated early. So unless it is explicitly stated that there's also an employment relationship, then you should assume you're just dealing with somebody who's a director. The company directors are the people who run the show, but because they're the people who run the show, they're also the people who can get stuff done in an inadequate fashion and lose the company money. So that clearly leaves a lot of people pissed off because they're losing money. So when we talked about directors' duties and the way in which directors' duties are expressed, we came across a whole range of things that inform our understanding of how a company could be properly run and make money for its shareholders. That is the primary objective, right? Make money for the shareholders. So the director's duties came out broad categories, one of which was, what are the rights that they've got, the obligations, how do they carry them out, but also quite a lot of information about conflicts of interest. And what happens if you're a decision maker, but you're pulled in two different directions, and how do you make decisions, how to address those. What was the primary way in which we were dealing with conflicts of interest? Disclosure. Either an individual director is involved somehow in something that is the company's business, and then they need to disclose that problem to the rest of the directors and ask for permission to carry on, or maybe the board as a whole is affected, so then they need to disclose this to the shareholders. There are actually some cases where an individual director could be the one affected, but what's going on is so serious that needs approval by the totality of the company, including the shareholders. And that's how you get away with this problem of having difficulty making up your mind when you're trying to serve both a personal interest and something that is supposed to be the interest of the company. Now, all of these things go wrong in a variety of ways, but we're left with the issue, and this is where we're coming into today. If something has gone wrong, and we know that the company can then pursue the directors for having lost money and to correct the mistakes that they made and all the rest of it. But it just leaves us with this problem that if the directors are the people who are running the show, because the company is not in a position to make decisions by itself, it is a virtual entity. If the bosses are the ones doing things wrong, who is going to take the initiative to defend the company's interests? The company can only speak through the board of directors, but it is the board of directors that are messing things up. They're unlikely to have an epiphany and blame themselves. So if the totality of the board is involved in some sort of misbehavior, they're clearly not going to call themselves out. If one of the directors is involved in some misbehavior and he's in the minority in the board, it is possible that there are enough independent directors that will take some action. Do you remember what we were saying about non-executive directors? So who is a non-executive director? What are they supposed to do? The non-executive directors are precisely people who are not involved in the kind of day-to-day stuff, but they have a degree of independence from the people who actually operationalize everything that needs to happen for the company. So if you have a bigger structure where you have a group of people with executive functions and people that are non-executive, you would hope that if one of the directors or perhaps a few of them do something wrong in their executive function, the people who are non-executives who see this, they're going to go, hey, hang on a second, what is this? And then they're going to motivate the company to pursue the directors to correct whatever has gone wrong. But if it's a smaller structure and they're all in on it, or the director who's misbehaving is then supported by the others because they're friends or they're very closely linked, or it's one of these situations where they cover each other's backs when they do something wrong, then we have a situation. So it's great to say that the company is an independent entity with independent decision-making capabilities and all the rest of it, and this is carried out by the board of directors. But if the board itself is malfunctioning, there's nobody left to act on behalf of the company. Perhaps AI will be a solution. Do you guys have problems with the concept that AI might be given personality and might be recognized as like a person with its own initiative and rights and obligations and all of that stuff? It's not like we don't have examples of this happening in the law, because corporations are the example. Because you're having all these debates in the press, that AI is going to reach a point of independence in its behavior that we might have to recognize it as a person. And everybody's like, oh, that's crazy, that stuff cannot happen. But we do recognize corporations. That's the whole point of these classes, right? We do recognize corporations who are virtual entities as having separate legal personality and having rights and obligations. I mean, to an extent, we recognize rights on animals as well. We certainly do, even though, so they have like independent behavior, but they don't have decision-making capability, right? But we still recognize rights and we try to protect those rights. If you look at it from that perspective and you're not thinking about the ethical implications, but you're thinking about the practicalities of using the law to recognize personality in artificial constructs, I think there's a good parallel between corporate law, like companies are artificial constructs, and AI as a sort of artificial entity that might attain legal personality. Maybe in a few years' time, when this class re-emerges from the ashes like a phoenix and establishes itself as an independent module yet again, we'll be able to talk about companies represented by AI that actually run themselves. It's going to be awesome. So that way we don't have to do anything. We can sit at home and starve to death. Right. Okay, that aside, I think everybody appreciates the problem. If the artificial entity that's the corporation can only act through the agency of its directors, if the problem's coming from the directors, we need somebody else to take charge. So who is this somebody else? So we're starting this discussion by trying to see what mechanisms exist in the law that will allow other people who are not the directors to step in and defend the company's interests. By the way, if we need a quick reminder for context of what were the duties of the directors, right? The key obligation of the directors is to act within their powers, which is in 171 of the Companies Act 2006. Then they're obligated to promote the success of the company. What this means in practice is make money for the shareholders. They are supposed to exercise independent judgment, meaning that they cannot subcontract their decision-making to somebody else who is external and then say, well, it wasn't me, it was somebody else. They're obligated to exercise a reasonable care, skill, and diligence when they're making decisions. Incompetence will eventually lead to trouble because it will be perceived as a breach of directors' duties. They've got what we already talked about, the duty to avoid conflicts of interest. So when they're acting in company business, they're supposed to be 100% focused on the success of the company. If there's other objectives, especially of a personal nature, that they're trying to achieve, then we have a problem, and this will be perceived a conflict. They're not allowed to accept benefits from third parties, and they're under a duty to declare interests in anything that is forward-coming if, again, it raises a conflict of interest. So the directors are supposed to do all these things. How do we know that this can be achieved when the board itself is the source of the problem, but the board is not calling itself into account to defend company interests? This came up in the courts very early on. Because as you can imagine, ever since the idea of a modern corporation was established in the Victorian era, at like the beginnings of the 19th century, we started to come up these problems that stem from agency relationships. In every agency relationship, as you may have come across in commercial law or related subjects, aligning the interests of the agent and the principal is always a problem. How do you ensure that somebody is working for the benefit of whomever hired them and is not working for themselves? This came up in the courts in the most notable way in the case of Foss and Harbottle. This is an old case, like from 1843 already. And the scenario there is typical. You've got the bosses behaving in a way that harms company interests. And the key point here is that their behavior is not disadvantaging a specific shareholder, but their behavior is detrimental to the company's business as a whole. And making this distinction early on is important, and this will have consequences going down the line. So the court in Foss and Harbottle sits down and tries to think about this. How can we defend corporate interests when the complaining party is not the board of directors? What right do we allow external people, like a shareholder who has noticed that something goes wrong? What right do we allow them to come to the court and complain on behalf of the corporation? Again, this is something that's important. They're not complaining for themselves. They're complaining on behalf of the corporation. The court says there are a few fundamental rules here. One of them is that the directors are the bosses. So the management of the corporation takes place by the directors. And the second one is that kind of flows from this, is that the proper plaintiff, so the proper person to complain for something having gone wrong with the company, is the company itself. Therefore, accepting the complaints of a third party, for instance, one of the shareholders, can only be accepted as an exception to these rules. Again, fundamental rules. The bosses are the directors, they're the ones running the company. And secondly, the right person to sue on behalf of the company is the company itself. So anything else, anybody else who takes the initiative needs to be as an exception to these fundamental principles. What does this mean in practice? It means that shareholders should not assume they have the right to go and complain if they think something's going wrong. They have no independent standing to go to the court. Now, you guys are probably familiar with concepts like the doctrine of privity and all the rest. Does anybody remember what that is? So for instance, when you were doing contract law, what is the doctrine of privity? She hires you to edit her Instagram posts, and you do a terrible job. And I've seen those Instagram posts. I'm thinking, this is a disgrace. It's like an affront to culture and social media. And I would like to sue you for having done such a terrible job on your contract with your colleague there. Can I do that? No, I don't have standing. That's the doctrine of privity, right? Privity means that you have rights and obligations arising from contracts if you're a party to that contract. How do we figure out if you're a party to that contract? You have provided consideration. I, may legitimately be offended by the terrible job that you've done, but I really cannot sue you on your contract. It needs to be your contracting party. Similarly, for a corporation, the person that's in that deal is the corporation itself. So we need an exception that allows a third party to get involved. To take back the example from contract law, the exception to the doctrine of privity is that you've got a third party that's supposed to benefit from the contract, and the contract has given them that capability of being involved in enforcing the contract. So if she hired you to edit my Instagram posts, so I'm the beneficiary third party, and my rights to respond are not excluded in your contract, then I would have the right to sue you. But that would be an exception to the normal rule. Now, the exception that the court came up in the case of Foss and Harbottle is called fraud on the minority. If the directors are not simply doing a bad job, but they are actually trying to harm the shareholders to the level that the court, you should read the case because it's interesting, but the gist of it is, if what is happening is effectively trying to defraud the shareholders for the private benefit of the directors, then that creates an exception to this rule, because it demonstrates that the company is now dysfunctional, that the board cannot be trusted to take independent action to protect the company's interests. So as an exception, the court will give the right to a third party, in this context would be the shareholder, to sue on behalf of the corporation. So the court would recognize a shareholder as the initiator of an action on behalf of the company. So nowhere at this discussion are we saying that the victim is the shareholder. The victim of whatever has gone wrong is the company. But we just need somebody to initiate the action to defend those company interests. So once the court accepts that fraud on the minority has taken place and accepts standing for the shareholder, then the action is not personal to the shareholder, but becomes an action of the corporation. So the court basically passes on this action to the corporation, and then the corporation is the beneficiary if they win, but is also responsible for costs and all the rest of it. So the shareholder is not going to have to pay for the trial by themselves. The corporation takes care of all of this stuff, because from that point onwards that the court has taken it on, it becomes a corporate action. Does this sound like a good solution to this problem? Why not? I mean, actually, it's the only solution to this problem, because you cannot, I mean, in this context, I'm referring to shareholders as a third party in relation to the action. But in fact, the only people inside this problem are the directors and the shareholders. Because technically, the directors and the shareholders are the people who are inside the corporation. Everybody else who might be affected, we were discussing, is called a stakeholder, who has sort of legitimate business with the company and is affected by its behavior, but does not affect decision-making. The only people who affect decision-making, fortunately or unfortunately, are the directors and the shareholders. So if you don't recognize the shareholders as having standing to bring an action when something goes wrong, you got nobody. I mean, it would be a lot more difficult to recognize a truly external party, like an external investor, a bank that gives a loan or somebody, as having the capability to defend the company's own interests. So from a theoretical point of view, there's nothing wrong with this. It makes perfect sense. Technically, though, it's a bit tricky. Because to say the rule is proper plaintiff, the rule is management by the directors and all the rest of it sounds grand, and to call everything else an exception also sounds grand, but if you don't have exact criteria how to benefit from this exception to bring an action, then you run into trouble. And they did run into trouble. So if you look at case law that comes after this, so you see cases like Edwards and Halliwell from 1950. You see we got some cases before Foss and Harbottle. But if you want to look at more modern interpretations of these rules in Wallerstein and Moyer from 1975, we do have a continuing problem in trying to figure out what needs to happen for something to come within this exception of fraud on the minority. What is usually the conclusion of the common law being inconsistent? So if we can't figure out what's going on through the cases, what usually happens? The government legislates. So if there's a problem and the courts are struggling to arrive at a kind of workable solution, then that usually prompts legislative intervention. That's why we have a parliament. Okay? The parliament is not just to elect our mates as MPs, give them a salary and expenses, and have them going on trips. They're supposed to be there to respond to needs to amend and improve legislation. So what happened there, because the criteria for using this exception, which comes under the broad heading of derivative action, because the courts couldn't get to a point that we had consistent application of those rules or even a secure understanding of what the criteria are, then there was legislation to put this into a legislative setting. Now, as you probably know, but I think it's worth mentioning again, we are looking at case law before and after a legislative intervention. because obviously case law after is relevant because it shows us how the courts are interpreting the new rules. But since the problem is common and is consistent historically, looking at case law before what happened is helping us understand, or is helping us create arguments that we could use in court. So there's solid reasons to look at case law before and after a specific act of parliament, and it informs your understanding. Now, in practical terms, if you were addressing an essay question that says, derivative actions have been a mess, and assess the extent to which the Companies Act 2006 has improved the situation, then you have to look at the law the way it was before and then the way it evolved. Otherwise, you wouldn't be able to have a meaningful discussion. If you're answering a problem question, there is less emphasis in the law as it used to be historically, because in a problem question, you're trying to find a solution to a current problem right now. So what you're interested in is the law as is applied right now. So in a problem question, you would be looking at prior case law to help you understand what's going on, to give you arguments that you could present to the court and all of that stuff, right? But it's not obligatory when you're answering a problem question to go through a sort of historical evaluation of what the law was about. So if you were answering an essay question in the area of derivative actions, you inevitably need to discuss force and harbottle and the reasons why the case law that stems from this is not terrifically satisfactory. But if you were answering a problem question, I would start from the statutory impression of those rules and then apply it to the facts as you've got them now to try and give a real-life solution to the problem that you're presented with. And if the case is like super complicated and you need to draw arguments to convince the court about something that's not that obvious, then I would look kind of case law that has developed before and after the Act. Where is this in the Companies Act? So this is beautifully located in the Companies Act in section 260. That gives us this statutory impression of what are derivative duties and how we're supposed to do them. So it says here that a member of the company can initiate an action. Now, this needs to be something that the company itself would be able to complain about. No, we're not complaining about random stuff. We're complaining about something that would be a violation. That if the board of directors was independent enough or competent enough, they would be pursuing for themselves. So we have a valid, live cause of action, and the purpose of this is to seek relief on behalf of the company. So the shareholder is not complaining that their personal position is being disadvantaged. They're complaining that the position of all the shareholders in their totality is being disadvantaged. You can only do this about something that the directors are actually doing, so you cannot use this complaint in a prospective sense, being like, I don't like the directors, maybe I can get rid of them by initiating this. This isn't it. It needs to link to something specific. And it's subjected to a specific test as to whether this is in the company's interests. No, this isn't a free pass to the court every time you have a pissed off shareholder. You need to identify a real problem that has a consequence for the company. If you remember back to previous presentations about directors' duties and the effects of their violation, it's quite possible that the directors are breaching their duties, but this does not cause financial harm to the company. Can anybody think of an example? It could be that the Articles of Association say that the directors are not allowed to make investments without the consent of the board or the consent of the shareholders if the amount exceeds £100,000. A director goes and invests £200,000. And then they make £1 million profit because it was a great investment. So this is a violation because they breached they did not stay within their powers. You remember this was one of the fundamental rights, 171, act within the powers. They have acted in violation of their powers, but this didn't actually cause financial damage to the company. So what would be the point of suing? because they actually made money. So you don't have a live cause of action that can promote the company's interests, even though nobody doubts that there's been a violation. So if you're in that situation and the shareholders are really pissed that the directors are not respecting their boundaries and they're doing whatever they want, what should be the appropriate thing to do for the shareholders? So as a group, the shareholders are thinking these guys do whatever they want, whenever they want it, and when we complain, they go, well, we made money anyway, what are you complaining about? So what could the shareholders do? They can get rid of them, because the problem with saying holding them accountable is you could hold them accountable and then ask them to repair whatever damage they've done. But if they've actually made money for the company, there's no damage to compensate. Yeah. So one way, if the shareholders decide that they don't approve of this behavior, one of the things that they can do is to dismiss the directors. If the shareholders are unhappy with the board and they want new directors, they can dismiss the existing directors. The mechanism is in Section 168 of the Companies Act of 2006, and it requires an ordinary majority. So if more than half the shareholders are unhappy with the directors, they can get rid of them, and then they can appoint somebody new. But what they shouldn't do, and actually they're not allowed to do, is to bring a derivative action, so drag the company to court to complain about something that has not caused any damage. So the criteria in 260 is you're complaining about something done to the company, but by pursuing this action, you're also trying to get something that is beneficial for the company. This isn't simply a mechanism to express dissatisfaction. So if somebody is trying to correct something that the directors have done and achieve compensation for the corporation because the company has suffered loss out of the wrong thing that the directors have done, then the way to do this is to use Section 260 to petition the court for a derivative action. The court will accept this to proceed if there's in fact money to be made, and I'm guessing if the amount is minor and it doesn't even cover the cost of the trial, that an action would be damaging for the company. It doesn't create great press. So you need to be able to get back something that is substantial, right? In that case, the court will approve it. The court will say no if you don't have a significant interest, so there's no significant compensation coming, and the court will also say no if the initiator of the action is trying to protect something that's very personal to them, that bothers them, but does not affect the rest of the shareholders. There's another mechanism that we're going to talk about in the next presentation about dealing with something that affects you personally as an individual. But this isn't it. The derivative action is to defend the interests of the company as a whole, the totality of the shareholders. How do you actually practically approach this if it comes up in a real-life scenario? You will need to identify what has gone wrong. So to be able to address these issues about correcting wrongs that have been done to the company, and this comes under a bigger label that's called minority shareholder protection, perhaps for the reason that it's usually the majority either in the board or the other shareholders that are sort of ganging up and carrying out something inappropriate. So you might see these discussions under a heading that says minority shareholder protection. The initial point that the trouble is coming from is going to be some breach of directors' duties. Because again, remember, it's not appropriate to go and complain that the directors are not doing the jobs every time the company loses money. Sometimes companies make money, sometimes they lose money. It doesn't suggest that somebody has done something wrong. Business decisions have got beneficial or can have detrimental consequences. Sometimes the environment changes and it's outside anybody's control. Sometimes the best thing to do right now turns out to be the wrong thing, but you couldn't have guessed when you were making that decision. Yeah? So I don't want to create the impression that any of those tools are mechanisms to complain when the company has lost money. They're a mechanism to complain when the company has lost money arising by some sort of violation. Therefore, to be able to address these topics, you need to have a background understanding of director's duties, because this is where the violation is going to come from. So the starting point should always be, do we have a violation here, or are we simply complaining about having lost money? Losing money in itself is not an actionable thing. Losing money because somebody has done something wrong that they were prohibited from doing, that's an actionable thing. So you find the violation. You have to be sure that the violation has resulted in significant negative consequences for the corporation, because again, a violation that doesn't lose you money is nothing to complain about. So you got the violation, you got the loss, and you arrive at the decision. Can the company be convinced to pursue this? Can the shareholders at the general meeting have a declaration or something that requests the board to pursue a director who's been in breach? If that doesn't work, because they do this and the board of directors refuses and they don't have a valid reason for that refusal, are we then talking about the shareholders bringing this to the court on behalf of the corporation through the tool of a derivative action? And if that's happening in a real-life situation, then you have to advise them on the basis of the current law. So you would be starting from Section 260 of the Companies Act and then going from there to look at the facts and structure your argument. If it has not, if this is an essay-style question that is asking you to reflect on the evolution of the law, then you can start from Foss and Harbottle and just take us through the whole thing of what necessitated this change in the common law and then how it moved in its statutory impression and all the rest of it. The conclusion is going to be that if the court accepts to pursue with a derivative action, it then becomes an action from the corporation against whomever is at fault, and if they win, the director that has been at fault will have to compensate the company and possibly pay costs. If they don't win, then the company is burdened with those costs, but not the individual who initiated the action. I want to talk to you a little bit about what happens to minority shareholders. In any type of corporation, big ones and small ones, there should be no expectation that we've got an equal balance between the people who own the shares. It's very common that there is a majority shareholder and somebody comes in on a smaller investment. It could be that somebody wants to invest a little bit at the beginning and not to be fully invested, or somebody comes in a little bit later on and invests some additional money, brings in something in addition. But there's a weakness in being a minority shareholder. As with anything, nobody normally has a great time being in a minority, do they? I mean, the whole point of constitutional law and constitutional provisions and the whole point of law to begin with is to make sure that everybody benefits from the same treatment and has got comparable rights and obligations. And this is even more important if you belong in a minority group and you're frightened that the majority might decide to do things that go against your interests, and if they decide to do this, there isn't much you can do about it. So there are mechanisms, or there should be, if there aren't, there are mechanisms there to protect people who are in a minority position in a corporation. How would you feel if I told you, I am trying to branch out, I'm trying to raise more money, and I'm selling a 10% share in my company. So, my company is doing great. You're going to participate in the success of this company, and you can buy 10% of the shares. You don't have to do anything at all. As a shareholder, you don't have to do anything, right? I mean, you have the opportunity to participate in the general meeting and in certain types of decision-making if you choose to do so. You're not obligated to do so. So I could offer you for 10% of my shares, you pay for those, you become a shareholder, you benefit in my success. When I pay out dividends, you get a nice chunk of this. It's a great deal. But there's one problem. It is a great deal, but if I decide to do stuff that are actually a terrible idea, you have very little influence over what I do. Voting at general meeting either takes place on a majority or a supermajority. Obviously, in order to change the Articles of Association, you need a supermajority because you're changing the kind of fundamental structure of the corporation. But look, if you're a 10% shareholder, I can take decisions on an ordinary majority on a daily basis if needed, I can change the articles of association because I also have a supermajority. I've got 75% of the shares and above. So I can actually do everything I want, and there's no way you can stop me. And if it's a private limited company, it's not even easy for you to get out. Because in a public corporation, especially for one listed in the stock market, if things don't go your way and you think the corporation is not performing up to your expectation, you just sell your shares and then the next person has to worry about it. But if you're in a private limited company, it's not easy to exit. It might be difficult to find somebody to sell the shares to. And it needs the consent of other people. It needs a change in the articles to be able to get out and all of that stuff. So it's going to be problematic. Therefore, we have an issue as to how to cater for the interests and make sure that people are committed, the people running the company are committed to benefiting everybody and not just the people in the majority. So it is still possible and within the law that a director is making decisions for the company that are beneficial to the company, broadly speaking, but could be detrimental to a particular shareholder. Can you think of an example of how a decision could be legal and beneficial to the company, but at the same time detrimental to individual shareholders? The company has good profitability, and instead of returning part of that benefit to the shareholders in the form of dividends, they choose to reinvest. This could be the right thing to do for the company. So the company can grow and become more successful in the future. But you're not going to be a happy bunny if first year you're in, you don't get any dividends. Second year you're in, you don't get any dividends. Third year you're in, you don't get any dividends. 20 years down the line, you don't get any dividends. So you've blocked your money into this investment, and you're not really getting anything out of it other than the promise of selling them at a better price in some indeterminate place in the future. If they are raising additional capital, they wouldn't be able to discriminate against existing shareholders. That might be a concern. You might be thinking, I understand my participation in the company on the basis of the existing shareholding. If they create lots of additional shares and I don't have the capacity to participate and purchase those additional shares, then gradually my position is getting diluted. So, yeah, that could be another example of the company raising finance through additional shareholding, or perhaps the company taking in debt or doing something like this that might be good for the progression of the company, but might look like a dangerous or unpleasant thing for one of the current investors. So it's possible that the directors are taking decisions that are correct and appropriate, but individual people have a problem with them. When we're talking about minority shareholder protection, we're not talking about this. We're not talking about giving you like a free exit whenever you're unhappy, or giving you the rights to complain as an individual because this investment is not going in the way you wanted, or the direction of the company is not in the way you wanted. This is the way company law works. This is why you have a board of directors, and this is why they've got the ability to make decisions on behalf of the company and specific parameters within which they make those decisions. So this, you being unhappy for yourself, isn't a reason to complain. The whole discussion about minority shareholder protection is when in fact something's going wrong. The directors are disrespecting their boundaries, or they're taking decisions that are bad for the company, or they're taking decisions that benefit specific members of the company to the exclusion of everybody else, and they're doing this on purpose. That's the thing that we're focusing on. As we've seen previously, one avenue of reacting to this, if you are a shareholder, you're part of the general meeting, but you're not the director yourself. One avenue of reacting to management doing the wrong stuff is to bring a derivative action. But that is an action that defends the company's interests against misbehavior from the board. If you have a situation where there is a group of directors that take very, very bad business decisions, then you might be thinking as a shareholder, is there anything I can do to stop them? Or if they've done the thing already and the thing has caused damage to the company, is there any way that the company can recoup money from those directors because they've done something wrong? At which point you need to consider, is the wrong thing wrong in a business sense, or is it the wrong thing in a legal sense? For it to be wrong in a legal sense, it needs to be a breach of director's duties. And it needs to be a breach that causes harm to the company. The company itself is not willing to do anything about this. So then it falls to you as an individual shareholder to bring an action on behalf of the company and try and convince the court that the company has a cause of action against these people and it should be pursued and it will have a beneficial outcome if they're successful. Section 260 gives a statutory right to shareholders to appeal to the court to get permission to pursue an action on behalf of the company. And if the court thinks that it will be in the interest of the company to pursue this action, meaning there's some initial evidence that some violation has taken place and there's some initial evidence that some loss has been suffered, then the court will allow the action to proceed. Which is great, right? So we've got some things that can offer some protection to people who are not in a commanding position. I mean, you could argue that the fact that we've got different weighting for decisions at general meeting is some protection by itself. So if you need 50% for an ordinary resolution and 75% for an enhanced majority, then you ensure that with 75% you got enough volume of people who want to do something to make it a valuable thing to do. We were talking about ways in which somebody in a minority position that doesn't have a great degree of influence can do something. So one of the things that they could do is, if they're not a tiny minority, maybe they've got more than like a quarter of the votes at general meeting. If you've got more than a quarter of the votes, then you can block special resolutions. So at least you can, if you're a minority but not a tiny minority, you've got some level of control in excluding changes to the Articles of Association. So there's something. Now, what else can you do? The key difficulty is disagreeing with what the majority is doing. Disagreeing with what the board of directors is doing is already quite limited. Because as we said, they're entitled on the basis of the law, on the basis of the Articles of Association, they're entitled to run the show. So if as a shareholder you disagree with what they do, you have limited room to express that disagreement. But if you disagree with what the other shareholders are doing, like the majority of the general meeting, then you're even in worse trouble. Could you go and say, I'm in a minority position, but I want to be protected from other people messing with me and to have this expressed in the articles somehow? Could you carve out specific protections within the Articles of Association for people who belong in a minority? If they're doing something nasty to you, and I'm going to get there in a moment, if they're trying to do something nasty to you, there are some mechanisms to protect you. But could you be kind of forward about this and say, I will join the company, I will only get 10% of the shares, but I want some protections built in the Articles of Association as I'm coming in that we agree now. People in a minority position, a different class of shares, then that is a contractual, if you want to call it that, because it's expressed in the Articles of Association, but it is a valid mechanism to give them an extra layer of protection. And having somebody belonging in a different class of shares, it doesn't necessarily mean they're getting a great deal, they're getting a worse deal. It just means they're getting a different deal than everybody else. So it is entirely possible that you've got somebody joining in a minority position and you don't give them ordinary shares, you give them a different class of shares. Then, if that's what happened, the rest of the company cannot change the rights that are attached to that class without the consent of the class. And if it's only one person that is the total majority of that class, it means that they're secure from changes to their entitlements, at least in the way that they're expressed in the Articles of Association. So if I want to contribute to this company because I want to participate in the financial success, I don't want to be involved in day-to-day management, I don't want to do anything, But because I'm giving in extra cash that the company wants, I want to be doubly rewarded. So we could say that I am putting this 10% of the 10% of shares that I'm buying for myself, they actually have double dividend entitlement. Or the dividend pays first at a higher amount than everybody else. And this is written in the Articles of Association. The company cannot change their minds about this. Because if they decide to pay dividends, then the distribution is preset. I'm going to get, if it said double for me, I'm going to get double. So whatever they gave as dividend per ordinary share, I'm getting twice that. They cannot prevent me from doing this without changing the rights of my class, and I'm not going to say yes because I'm not stupid. Or if I say yes, it's part of a negotiated settlement, they give me something else. They're going to say, look, your class doesn't work for us. We're going to change the rights of your class. Everybody has ordinary shares, but we're going to double the amount of shares that you got. Right? And that's your incentive for switching. Creating a separate class of shares is a terrific way to embed some protections for people who are in a minority position. There are some other stuff that you could do. For instance, there is the idea of entrenchment. This is in Section 22 of the Companies Act. You can make some provisions in the articles subject to change only by the complete agreement of the company. You can class any provision in the Articles of Association as something that requires a supermajority to change. So you could say this, like there's a provision that says something, if you want to change that one, it's not like the rest of the articles. I want an enhanced majority. You could even say, I want 100% agreement of all the shareholders in order to change this. Now, that would mean that certain articles that have been entrenched can only be changed if absolutely everybody agrees. So if you're in a minority position, no matter how small a minority you are, unless you agree, they're not going to be able to change it. Weakness with this idea is that entrenchments can only happen at the point of the creation of the company. So you need to be there at the beginning. Or, alternatively, you need to get 100% of the shareholders to agree to entrenchment. But this is a little bit unlikely if you're joining the company at a later stage. One of the mechanisms that we've seen in the past as well would be an external contractual agreement between the shareholders, because you can always have shareholders' agreements that they say they're going to do things in a certain way. You remember what is the problem with shareholder agreements? No, it's not binding to the company and it's not binding to future shareholders. So if we sign a contract, the two of us, it's between the two of us. If other people come around, then you cannot say, because of the contract we have between us, other people have got rights and obligations. So if there is a shareholders agreement, it means that if somebody subject to this agreement changes their minds and they do something, they're going to be in breach of contract. So then you can sue them in damages for breach of contract. But if you got new members coming in, clearly they're not covered. So it is a way to kind of embed some rights, but not a terrific level of protection. So we have putting stuff in the Articles of Association, entrenching things in the Articles of Association with higher majorities, external shareholders agreements, splitting people into separate classes of shares. All of these are mechanisms that can give a greater degree of confidence to somebody in a minority position that they're not going to be messed about, but none of it is a complete agreement. The key issue that normally tends up in the courts in this area is people disagreeing with decisions of the majority. And it is a sad and painful area of company law that consistently generates new cases that go to the courts. Now, if you're wondering, well, if we got so much case law on it already, why do these things end up in the courts all the time? They end up in the courts because people are fighting over the facts. They're not fighting over what the law is. And that's why most things end up in the courts. It's not like we don't know what the law is and we want the judge to tell us. It's like we know what the law is, we just disagree what our rights and obligations are on the basis of the factual basis that we have. Now, the key problem that we've had is expropriation. What happens if the majority of the company decides to expropriate a minority? what happens if I've got this 10% shareholding and 90% of the shareholders say, we're going to change the articles to buy back those shares or buy you out. It's like, we don't want you out anymore, goodbye. So I'm getting kicked out. What am I going to do about this? Now, it might sound like this is an abusive thing to do. Why are you kicking out a minority? But the rule is, and you can see this in cases like Allen and Gold Reefs of Africa, it's a case from 1900. You got Brown and British Abrasive from 1919. You got Sidebottom and Kershaw from 1920. All these cases remind everybody that the company, as a unit, takes decisions for the benefit of the company, not for decisions of individual members. So if the company decides to expropriate a minority, if this is the right thing to do for the future of the company, it's going to be okay. I know that this sounds horrible, right? Doesn't it sound horrible? That they might take decisions to exclude you and kick you out, and there's nothing to do about this if the change is in the interest of the company. Can you think of a reason why it would be in the interest of the company? But you see, it can't be personally targeted, because if the majority thinks you're annoying, then that's not really deciding to kick you out because you're annoying. This seems to be like a kind of one-on-one personal thing, like a difficulty in the relationships, as opposed to an action that is in the interests of the company. So for something to be in the interests of the company, it has to be in some sort of reorganization context that's not personal. So you've been like a minor shareholder. We're having a new investor coming in that wants to buy 90% of the shares, or it's like in a merger scenario. So in that case, you might get kicked out because there's a major investor coming in that's got a different plan about how the shareholding is distributed. So it's not like we don't like you personally. It's like this is the right thing to do for the company going forward in the way they organize their finances and so on. So the court has said in all of these cases that what matters is that the interests of the company are behind the decisions that are taken. And this informs both decisions of the board of directors and also decisions of the general meeting. And it takes us back to discussions that we had in the past about how shares are primarily perceived as economic entitlements, financial entitlements, and not property rights. So we've got this tension all the time. Should we consider shares a property right, or should we consider them a financial entitlement? If you consider something a property right, you've got a closer link between the property and its owner. It's very difficult to expropriate property. But if you consider something a financial entitlement, what you're interested in is not the asset itself, but what it represents in terms of money. So if I were to take your laptop, you would have a problem with that, because this is your asset, this is your property, it's something that you're kind of more intimately connected with, like your laptop or your phone. But if I were to say the bank in which you have your bank account is closing, therefore we're transferring your bank account to a different bank, then you don't care if the money is the same, right? Or your electricity provider is shutting down, or they sold to somebody else and they're transferring over. You don't care. I mean, it happened to me. I was with, the electricity was provided by Co-op. Octopus was the one with the pink octopus, right? They bought the Co-op. So I received a letter that says, your account, your electricity supplier is now changing. Your account is getting transferred over to Octopus. And it said, of course, if you don't like it, because it's a change of contract, if you don't like it, you can leave altogether and go to somebody else. But the fact that they were changing over in the same terms and conditions, nothing was changing for me. I don't care. So long as the lights turn on when I click the switch, I don't really care who supplies the electricity, and the price is the same. Equally, if I have a bank account in NatWest or if I have a bank account in HSBC, so far as the rights attached to it are the same, I really don't care. But if they said, we're going to take away your phone and give you something of equivalent value, or your house, give you something of equivalent value, or your dog, you might feel differently about it. So they cannot, I mean, it's very weird that going from cases to cases, the courts cannot make up their minds as to whether shares should be property rights, that we should really keep them with their owners, or whether we should just consider them the equivalent of an amount of money. In all these discussions, how should we protect the rights of a minority, and are we allowed to kick them out if it's in the interest of the company? The position seems to be, this is money, who the hell cares? So the only thing that matters, that comes out of all these cases, is whether there's an independent and adequate valuation of the shares. So if it's independently valued, then you get the money, and it's like, that was the right thing to do, thank you for your service, goodbye. Actually, in the context of a merger, you got section 979 of the Companies Act that says if the acquiring party attains 90% of the shares, then they have the right to force everybody else to sell. This is something that's expressed in areas of property law as well, to be honest, because, this was 979 is the section. If somebody has purchased 90% of the shares, then they can, in a compulsory fashion, expropriate the rest of the 10%. They don't expropriate, they compensate, but they buy the rest of the 10%. Because otherwise you would make the functioning of the company weird and uncomfortable if you had like a 10% complainer group stuck in there to kind of be as a wedge to every decision you're trying to make. If in the stock market, somebody is wishing to purchase the totality of the shares to take a company private, to take them out of the stock market, and they get they hit 90%, they can get the remaining 10%. And the people who've got that remaining 10% cannot object. So long as, of course, that they're compensated adequately. In the Twitter situation, Musk was actually paying above what was the market valuation of the company. So there was actually no reason to complain on the money. The only test that we've got that is checking this is whether the decisions are taken in good faith. So, is the decision in the interests of the company? How can we tell? Because it's not the job of the court to kind of second guess decisions of the board of directors, but they kind of have to think where the decisions taken in good faith. So the only way you could challenge it is if you find that actually, you know what, they're not doing this because they think it's the best idea, but they're doing this because they hate me personally, because I challenge their policy, or, we have a personal thing going on, etc. Limited grounds, therefore, for somebody to resist decisions that are taken by the board or to resist decisions that are taken by the general meeting on the basis that they don't agree with the decisions. This isn't how company law has organized stuff. But what if they are actually out to get you? Derivative action is not going to help you here, because the derivative action wasn't they're out to get me. It was like they're doing bad things and damaging the company. So, either they're incompetent or they've got some sort of evil agenda that affects all the shareholders. What if they are actually out to get you? The mechanism for this is in section 994 of the Companies Act, and this is called unfair prejudice. So you're going to the court and you can complain that the company's affairs are being conducted in a matter that is unfairly prejudicial to the interests of the company generally, or to some of the shareholders, or just to you. And this can relate to things that the company has already done or things that the company is planning to do. You can do this and go to complain to the court for your personal protection. What sort of things are you going to complain about? If it was simply about violations of rights, so if you simply wanted to say this is a breach of directors' duties, etc., then you won't really need this, because you can always bring a derivative action. Yeah? This is to protect expectations that you have that could either be expressed in the Articles of Association or in an external contractual document like a shareholders agreement, or, and this is significant, expectations that you had arising out of the relationship. So this is something that you can use to complain that your legitimate expectations are getting violated by what the company is trying to do. So that's why the unfair prejudice stuff is considered to be kind of wide-ranging and quite flexible, because you're saying they're after me because they don't like me or they're trying to mess up something, and now our understanding is that we're going to do this differently. And they kind of change the tables on me, which kind of messes up the whole reason why I'm here. It negates the value of my investment, or is kind of targeting me as an individual. So you've got the entire opportunity to do this using what is found in Section 994. But you cannot simply use this to complain that they're losing you money. So you need your legitimate expectations cannot simply be, I got into this to make money, these guys haven't paid dividends in 20 years, therefore what I'm doing here. That cannot be. Right? You need to find something that is targeted and is a violation either of an expressed right or a legitimate expectation. And if they're trying to kick you out, so if you're complaining against an attempt to expropriate you, this isn't enough just in and of itself, because if they're paying you a good price for yourself, for your shares, the court will consider that they're treating you fairly. And again, it brings back to what I was saying earlier, that this sounds kind of weird that they're ganging up on you and they're trying to exclude you, but the court will be very much focused on the idea that you're getting fair value for your shares. So what sort of situations do we have that we can actually nail down what is unfairly prejudicial? Because it's nice to say it can be a bunch of stuff, but it would be good to know what we can have. If you look at cases like Sol v. Harrison, which is a case from 1995, the court said that the conduct being complained about must be both prejudicial, in the sense of causing prejudice or harm, and also unfair. So conduct may be unfair without being prejudicial, or prejudicial without being unfair, but we need both of them to be the case. Right? Okay, cool, but that doesn't actually give us any concrete examples. In O'Neill and Phillips, that is a case from 1999, again, they were talking about things along the same lines. Now, the best example is, of course, the majority taking away financial benefits. So if they're doing things that put you in a worse position, or if you have a class of shares and they're doing things that undermine the value of that class, that could be something to complain about. But the best example of unfair prejudice complaints, and actually the majority of the cases in the courts, is about people having started a business with somebody else, and at some point they get into a fight and they're getting kicked out. This is where all this is coming from. And remember that the vast majority of corporations are small outfits where a bunch of people come together, and the same people are the shareholders, the same people are the directors, and they're coming together to run their business through a corporate form. So let's say that there's three of us, and we've been working already, we have a shop together, we'll be working as sole traders or as contractors in close collaboration. We're thinking, let's incorporate, right? And do this in a more predictable organizational form, take advantage of tax advantages, issues of dealing with liability, and all the rest that we can have through a corporate entity. And we incorporate. And we are the shareholders, shareholding split three ways, and we're also three of us are directors. And at some point, we get into a disagreement. I want to move the business online. You don't. You want to keep the business, and the other guy want to keep the business physical. And you guys, because there's two of you and one on me, and you want to keep it that way, you decide to kick me out because we don't see the same way about the company anymore and the future of the company. Now, the way in which the unfair prejudice provisions in Section 994 can help with this is that I can go to the court and say, I had a legitimate interest in continued participation in the way that this company is run. So I wasn't in it simply to be a shareholder and a director from time to time. I wanted to be a director for all time. And I wanted to be participant in the decisions and discussions about the future of the company. So if we started off in being positions of shareholders and directors, and because we disagreed, you guys kicked me off the board, I'm a shareholder, my money is still invested here. But now, because I'm not on the board, I don't participate in anything, and because you guys have got 2/3 majority, you can do anything you want with the company at general meeting as well. So I have now zero influence in what's going on, and I'm still stuck in the company. And this is unfairly prejudicial to me because this isn't what it was meant to be, and we create this company with another objective in mind. And the way this is expressed in the case law, these cases come under the label of quasi-partnership companies, because they are companies, but in essence, they work like partnerships, where all the people were supposed to be kind of in close collaboration with each other on what they do. Right? So are we in agreement with this, that if there was three people that started to do something together, and this was their livelihood, they didn't want to just be there as shareholders, they also wanted to be present in the board. So they wanted to be fully participant in running it, in deciding things, in distributing the benefits as shareholders when it came to it. So when they get into a fight and one of them is being excluded, the person being excluded, in fact, is losing something more than the technical rights to be a director if you get voted in. It's more fundamental what they're getting, and they're marginalized as a minority, and then they're left in a position that they're stuck. If that's what's going on, and you're successful in using this section to complain about it, what would you think is an appropriate solution? So what can we do for the person that's like the odd one out? I know, it sounds weird that the primary remedy for unfair prejudice is for you to leave the company. But it's the only rational solution. Because if people don't like each other, you cannot force them to work with each other anymore. It would be dysfunctional, and the company would not be successful. If they decided to part ways, what you can have is like a clean break, where they give you your money back and you go. Actually, not your money back. They give you whatever your investment represents right now, whatever the shares are valued at right now. And then you leave, and you can take your money and you can do something else with your life. So you're no longer stuck in this position of having no influence, but still having your money locked into this thing. On occasion, a remedy could be that the majority gets kicked out. Depending on what the facts are, it's also possible that the court is going to say, actually, you know what? The majority partners sell their stake to the minority if the minority is able to purchase it. And then the one person left carries out the company. If the company has become dysfunctional beyond repair, or the relationships are so damaged that the company would not be able to operate effectively, another possible remedy would be that they shut the company down. So the company is wound down and the money then is distributed to the people that were the participants. So there are all these options, that the minority person remains, that the minority person leaves, that the whole company is shut down. All of that is possible. The court will assess what is the most appropriate response in the circumstances. But the important thing to remember, and we'll finish with this, at least this part of the presentation, is think of shares as money, as financial entitlements more than property rights. And when it comes to things falling apart and people in a minority position feeling that they're in trouble, there are various ways that you can deal with this, both in the way that you organize the relationship on the way in that can help you, but on the way out, there is ultimately the ability to complain for unfair prejudice, and this again gives you a range of options. This is very contentious. People get into fights, relationships break down, people end up in the courts about it. It's something that generates like lively jurisprudence. And even though we have clarity now, better than we used to, on what the law is and what are the technical steps to complain for unfair prejudice, it's still something that gets debated even on the point of the law. Sometimes you got cases like this that reach the higher courts, that they talk about it. So it's an interesting area that can generate both kind of theoretical questions about how the law is evolving and practical questions as to how do you advise somebody who's in a minority position. What do you think is the main reason that companies go bust? If they've got difficulty matching their liabilities to their income and their assets, where is that going to show itself? Yeah. So it's the paperwork that causes companies to go bust. Of course, the underlying reasons why they're not performing well can be multiple, but the way in which it's going to show itself is in problems with the paperwork. And most of the scandals that you've come across in the press, they have to do with problems with the paperwork. And very often is the company's inability to keep track of the expression of the financial position in the documentation that causes managers to lose sight as to what's happening, and then they get into trouble, and then they get deeper into trouble, and sometimes they lie about the amount of trouble that they're in, or they have difficulty actually figuring out what's going on, and eventually, when all of it comes out into the open, they go bust. The speed with which things go wrong is usually determined by the speed with which people discover that the paperwork is all over the place. For instance, you guys remember Patisserie Valérie? Patisserie Valérie was a fairly well-known chain of coffee shops, and they had all these kind of nice big cakes. You guys have seen Café Concerto or something like this? They're all over the place. Yeah. So this kind of rather impressive looking big cakes, or all the tourists walk across the street, they see that stuff, they're thinking, oh, that looks funny, let's go in there. Of course, most of this stuff is inedible anyway, but it doesn't matter, right? It looks nice. So Patisserie Valérie was a relatively successful looking brand because they were opening shops all over the place. They did some weird stuff that the way that they made the cakes was actually quite distinct from the shops. So sometimes you would order a cake and the cake would arrive from like some random location. So I ordered the cake to be picked up in Canterbury because they had one there. And I realized that the cake came from London in a cab by itself for me to be there to pick it up. And I went there with a train. Like if I knew all this, I would have traveled together with a cake in the cab. Right? It's just madness. And they didn't charge extra or anything. Anyway, some weird stuff about the way these guys were running their business. But it looked like a successful business. They had a lot of shops. They had a lot of customers. They kept expanding. Suddenly, poof, they disappear. You see a headline that says, Chief Financial Officer arrested, and there's pictures of him kind of being banded into police cars and stuff like that. And you're thinking, hang on a second, what happened here? What happened is that they weren't keeping track of the paperwork, and they were accumulating significant losses, and people involved in the company were also lying in the paperwork and stealing a little bit of money. So the person who was responsible as the chief finance officer was accused of being behind a great deal of this manipulation. Of course, when it all came out, everybody freaked out, and the creditors and the landlords and everybody else freaked out because obviously these guys were renting the spaces where they had the shops. People asked for their money back. They couldn't pay because they had run out of money. And they couldn't actually defend any of their prior accounts going back years. So the reason why they went bust is probably there was some issue with the way they were running the business, but this disease expressed itself in the dodgy paperwork. And I think instead of being upfront about this and trying to correct the problem or representing accurately their position in this paperwork, they tried to hide it, which made things all a lot worse. Clearly, there are various kind of civil and criminal law implications of lying in the paperwork that you return to Companies House, and we can go into that in a moment. But the important thing is that the paperwork that has to do with the maintenance of a company is not some sort of boring inconvenience. It is actually fundamental to what a company is doing. And if people are not clear about the paperwork and what it represents, then there's a quick trip from there to failure. There are a lot of people who are in a position to find out. If it is a bigger corporation that has got non-executive directors, they're meant to have an active look as to what is going into this failure on multiple levels. In addition, you've got independent auditors. If you are a company of a certain value and above, then you have an accountancy firm that is looking and approving your accounts. So clearly, if they're doing their job, it shouldn't be easy to kind of manipulate the numbers. Now, the creditors are going to keep a careful eye over what's going on, especially if you go to refinance loans. Because the majority of corporations don't actually pay back their loans. When the loans come to maturity, they go back to the banks or their investors and they negotiate an extension to the loan. So at that point, everybody has an incentive to look at the numbers very, very carefully and to be sure that what they represent about themselves is actually shown in the numbers. But anybody can actually do their own due diligence by going to check on the documentation that they upload onto Companies House and get some at least basic level information about their finances and their operations. So if you were invited to buy shares in a company, the sensible thing to do would be to go check what it is that they have in company's house and to assess for yourselves. So what are we doing today in the context of this presentation is to show you what to look for when you are engaging in this process. So if you want to go check a corporation and figure out whether it's a healthy one or not for yourselves, you need to be able to have an understanding of what goes into the company's accounts. So this is a key skill that one needs to have both in the context of studying company law, but also in kind of everyday reality, right? When you're thinking of doing business with somebody, taking a job with somebody, or investing somewhere, or purchasing their shares, or even doing business normally. If you wanted these guys to cater your wedding, maybe you want to be sure that they're not going to run out of money halfway through. So having a quick look at what the paperwork represents about themselves might be a good idea. We've said in the past that there's a great deal of information that one needs to release about themselves if they are engaged in that process of having a corporation. The bigger the corporation, the higher the disclosure requirements. It might sound annoying, but this is what you have to give back to pay for the benefit of limited liability. You cannot tell people on the one hand that a corporation is a separate creature, and it is a separate creature that is protected by limited liability. So if it runs out of money, you cannot run after the shareholders and get additional cash. That's it. And then not tell people anything about this corporation. So clearly, a level of disclosure is obligatory, so people have the capacity to judge for themselves whether they're confident in getting into business with a corporate entity because there's nobody behind it. Now, if they're not comfortable, then they could get a guarantee from somebody else. So if you're thinking this company's financials are dodgy, you can get like one of the big shareholders to give you a personal guarantee that they're going to cover the loss if the company goes bust, then that's fine. But normally this doesn't happen. Normally, you do your own checks, make up your mind as to whether the company is safe or not, and then you go into business with them. Now, there are other reasons why you may want to have a look at what they're doing. It could be that you're interested in the company's engagement with other things. It could be that you're a shareholder and you would like to know more about the company's engagement with environmental issues or community engagement or any of that stuff that comes under the label of stakeholder concerns. So you might find in these submissions also some information about how the company deals with the outside world beyond its kind of clients and customers and all that stuff. We have a series of mandatory publicity requirements, and these are the same in every jurisdiction, because everybody who has corporations that benefit from limited liability understood a long time ago that they need to make some disclosures of information. The job falls on the directors to produce these annual accounts and produce all this information that communicates to these various interest groups what is happening within the corporation. So the directors clearly will produce the accounts that are then presented at the annual general meeting to the shareholders for the shareholders themselves to be able to make up their minds as to how the company is doing or not. For a company above a certain level, then these need to be audited by external parties. Now, if you have a very small, private, limited company, clearly you don't need to get an accountant to validate your paperwork. In some jurisdictions you do, but in this jurisdiction you don't have to. But once you hit certain thresholds, then you need to have them audited by somebody who's qualified to do this. In the vast majority of the cases that we're looking at corporations that are slightly bigger. So in this context, they would need to be audited by somebody external. The directors will also produce various types of reports that accompany and contextualize this information for the shareholders. So it's not simply that they give to the shareholders like a bunch of documentation with the numbers, but they will also give them some other documents that explain in a narrative sense how the company has performed, whether it met its objectives, what its objectives are for the future, and so on. Now, what happens if you have a mistake or you contain some information in these reports that is not true or is misleading? Now, this is a bad idea, and there is, in fact, imposed by the Companies Act liability for misleading statements in reports. So, this covers the director's report. It might cover reports that have to do with remuneration as well. That is something that people give for bigger corporations. and in the financial statements that are embedded in all those reports. So if you look at Section 463 of the Companies Act, it tells you that if wrong information is put in these reports and somebody internal to the company or the company itself suffers loss as a result, then the directors become liable to compensate the company. They suffer loss because of the mistake of the misleading or mistaken information that the directors put in their reports. So it's the shareholders that are going to suffer loss, either all of them together or individual shareholders. But of course, this isn't for kind of minor clerical mistakes. It's for things that people have done because either they were lying, so they put misleading statements or false statements on purpose in the reports, or there's some dishonesty involved, or they fall below appropriate levels of duty of care and diligence and so on. The interesting thing is the damage will be to the company. You don't really have a redress if you were external to the company and you made investment decisions on the basis of incorrect information that you found in those results. So it sounds a bit harsh to say that the directors are liable to compensate if loss is suffered, but remember that this does not cover outsiders. So basically the obligation is between the directors and their own shareholders. So if you're not an existing shareholder, then you cannot impose liability on the company or on the directors personally for any inaccurate information that you found in the director's report, in the remuneration report, and all of that stuff. Now, why is this? Because it is deemed to be too burdensome on corporations if the corporation as a whole is penalized by the wrong investment decisions of outsiders because one of the directors has made a mistake. So they're trying to contain, they acknowledge the fact that the directors should be held liable for this, but they need to contain the damage to the level of the director, not to damage the company as a whole by getting them to compensate external people. Now, you need to remember that for bigger corporations, there are also auditors involved, right? So if it's a bigger corporation that needs to have its accounts audited, and it's the auditors that get it wrong, then that might be a different issue. If the mistake is of the auditors, then the auditors are liable in the civil courts to people who rely on the poorly put together accounts. So while the company is not liable to somebody else who reads this stuff and goes and buys shares, the auditors will be responsible to this third party. Now, why is this difference of treatment? Because for the auditors, it's their job, right? That's what you hire them for. Otherwise, you would have all the auditors who kind of go, yeah, okay, we had a look at it, it looked okay, never mind. And then they get away with it. So that's not how this works. And in any event, all these people in all professional services, you got professional indemnity insurance. It's to cover exactly this sort of situation. So yeah, it's a lot more burdensome on the auditors who are supposed to be looking at the accounts. But then again, the auditors will be insured, meaning that anybody who suffers loss out of this situation probably has higher chances of redress against the auditors than they would have against the company if they were able to go against the company. But to summarize what I'm saying here is mistakes in the reports is a terrible problem. But it's a terrible problem for the directors who are responsible for the mistake. It is also a terrible problem for the auditors if the auditors were responsible for the mistake. It is less of a terrible problem for the corporation, and whether as an external party you would be able to go after them and obtain some compensation because you made a bad investment decision on account of the dodgy information depends on who is responsible for this information being wrong to begin with. Yeah, I know that it might not sound particularly satisfactory if you're on the outside, if you're the person losing out, but the law needs to set some boundaries that make the whole system a little bit more functional. There's one way that you could obtain the redress against people in a more direct sense, and this comes from situations where you have a particular duty of care, meaning somebody advised you specifically to do it. In which case, you have a tort claim against the person who gave you the advice, because the loss is arising out of the personal relationship that you had. So we're no longer talking about you interpreting reports that are made publicly available and then there's some mistake in the reports that has some sort of negative consequence. We're talking about the situation where somebody sought you out specifically and gave you advice to do something that then ended up being damaging to you. So in a similar way as in tort, then they're responsible for the loss that you're suffering because there's a duty of care, right? So in the same way that if they dug a hole in here and you fell in when you walked into the building after being invited, similarly, if you engage in an investment decision after being encouraged to do it by another, the person who encouraged you and advised you has a duty of care. This idea of a special relationship and what it means and when it brings about the duty of care can be found in cases like Caparo Industries and Dickman and so on. This is like a rather famous case in the area from 1990. So you shouldn't assume that the company is entitled to do whatever they want and to put whatever they want in their accounts. There will be consequences for errors and mistakes, but also you shouldn't assume that if you're the victim of something going wrong, then you got endless opportunity to go and obtain compensation. The situation is somewhere there in the middle. You have a duty of care, then the burden is on the person who provides you the advice. If you made your own mind up without relying on the advice, then that breaks the chain of causation, so it's no longer their problem. But if there is a duty of care and you're relying on the other person for advice, and you did rely on that advice, then there is no external obligation on you to have done your own due diligence. Depends. If you were relying on the family member for advice, then they have a duty of care. Yeah. But that's why if you engage with anybody in their professional capacity, they're going to tell you, I am here to analyze the situation. You make your own decisions. I'm not advising you to do anything. So anybody who's engaged with a broker for a mortgage, for financial products, for anything, the broker will always flood the place with disclaimers that say, I provide you with information, I provide you with analysis, you make your own decisions. At no point am I advising you to take this product or other, because they don't want to take the risk that it's going to be treated as advice and then you go after them if you suffer consequences of that advice. Similarly, a lawyer is not going to order the client to do anything. So people go to lawyers to explain the situation to them and then they make their own choices. So if you were advising somebody on how to draft a contract, they would say, if you put these things in your contract, it might have these potential consequences. If you put different things, it might have different consequences. Negotiate to the extent that you can to have the sort of optimal situation for yourself, but they're not going to tell you you're not allowed to sign something or oblige you to sign something you're not comfortable with. But you need to be very careful. Yeah. And in areas where you do provide the advice and you expect the people to act upon it, then there are issues that have to do with professional negligence, and people will then have to purchase insurance to be covered in case something goes wrong and all the rest of it. But of course, it's easier if you're not responsible. If you try to avoid this duty of care, you try to avoid the situation where people are reliant upon you for your advice, and you just kind of give them the tools to make their own decisions. Now, why is it important to have all these financial records and documents? I think from what we said so far, it is obvious. If you don't have an accurate representation of the data as to how the company is performing, then nobody knows what's going on. The shareholders will need to have a look at this to determine both how well the company is doing and also to anticipate how they can benefit from this. Because if a company is not operating profitably, then you won't be able to pay dividends. Therefore, the benefit that you get by participating as a shareholder is going to be less. We need to be able to understand financial performance for the benefit of insiders, but also for the benefit of outsiders. What happens if you need a loan? Right? You go to a bank and ask for a loan. You need to explain to the bank what your business is about and also the potential that your business has to be successful and to be able to repay the loan that they're giving you. And if you want to attract new investors, if you make new shares available, again, you need to be able to demonstrate these things. If you want to list in a stock market, there's a great deal of paperwork you need to disclose about yourself and your situation so that you allow the regulator to understand what it is that you're doing, to be confident that you can explain this information to potential shareholders, and then they will allow you to list your shares for the public. How are you supposed to do all this? To understand how the company is performing. Now, there's a very obvious step. You need to keep accurate records of what you do. If you don't keep records, you've got no clue of what's happening. Soon you're going to start forgetting stuff, and crucially, you won't be able to demonstrate to anybody else what it is that you're doing. So if I say for my company, if I don't keep accurate records of the invoices that I issue, or if I don't issue invoices that the work for that I do, people are not going to pay me. People are unlikely to send you money unless you've sent them an invoice that sets out in writing what it is that you want to be paid and what are the time frames and all the details that have to go with it. People don't just send you money. If you issue those invoices and you don't keep accurate records about how many of these invoices have been paid or not, then you're in the risk of losing money because you might not spot when people have not paid you. If you don't record that loss, if in fact they haven't paid you, then you might end up paying more taxes because you might make mistakes in your statements suggesting that you received more money than you actually have. If you don't keep accurate records of all your expenditure and record this appropriately in your financial information, then you might not be able to tell whether you got enough money left to fulfill your obligations, which might then bring you to the situation that somebody comes from a demand of payment, you cannot meet that, and then you have to go insolvent. So the key to everything is accurate record keeping. Now, the form of it is not particularly material. I mean, I'm not saying that you need to kind of get yourself a locker box and kind of print out all the invoices and kind of stack them in chronological order. But you can have an Excel sheet where you put this information in there. So you're able to give, when demanded at any given point, you can tell people how much money you've got left, where that money is, and what is the balance between incoming and outgoing funds. The way this is expressed easily to be able to kind of show this to everybody else is by having a simple balance sheet. A simple balance sheet might represent how much, what you do with your money. Let's say that you're providing services, the money that you received for the services. Over the space of a year, you've done work that you've sent out invoices worth £5,000. So that is your annual turnover. In order to provide these services, you had expenses. You needed to buy some equipment, you needed to pay for certain things, you need to pay bills that are associated with your business. So let's say you've got expenses of £2,000. Now this quickly gives you an impression of whether you got enough money running into this business or not. Because if your turnover is £5,000 and your overall costs are £2,000, then you've got a leftover of £3,000. Now, this isn't real money, not just yet, because you've obviously have committed this to some other things. But you have at least a broad impression as to whether there's any money in this company or not. Because if you hadn't turned any money around, so if you sold nothing, so you established your business, you bought all these things, you got yourself a new phone, you got mobile phone contracts, you bought a printer, you bought a laptop, you got like a Netflix subscription, you got like a YouTube subscription because that's relevant to what you're doing. All this kind of builds up an expense. So it could be that you've actually sold nothing, you've issued no invoices, and you already had expenses of £2,000, which means that you're £2,000 in the minus. So how is this covered? If this is not covered by anything, you're going to run into trouble. A very quick impression of what happens in a company is to have a look at what we call the profit and loss account, like money coming in and money going out. The expenses you're going to have are going to come from a variety of things, like the money that you spend in order to run the business, but also You have to pay employees, you have to pay various suppliers, you need to calculate how much your taxes are going to be and set money aside for this. So it gets a little bit more interesting than a simple profit and loss account. And that's why the better way to illustrate where all this information is to express it in the balance sheet, because it might contain, again, things that are a little bit notional, not exactly real. So the accountants are famous for what they call double entry bookkeeping, which has in one area things that are coming in, and in another area things that are going out. The invoices that people paid you, right? So you issued invoices to the value of £5,000, but then you have a series of expenses. So you have paid yourself a salary, right? So £1,000 is the salary. Then you had another £1,000 of expenses in equipment, bills, and all of that stuff. Then you have tax bills. So after you calculated your expenses and you took them out of your turnover, you can assess what is going to be your tax liability. Let's just assume that you got another £500 as tax liability. Then you got some series of overheads and so on that cost another £500. So that gives you a sense in your balance sheet of what is the dynamic position in your account. So once you match all those together, if you say that in this financial year I had 5,000 coming in, and now these are all the things that have either come out already or in the process of coming out. So we've got 1, 2, 3,000. Then it leaves me with £2,000. So it's like it's the same outcome as before with the profit and loss account, but this represents things in a more complete breakdown. Normally, this should match what you've got in your business bank account. Because if you're going through all this process and then you check the balance in your bank account and your balance in the bank account says something radically different, then you should think why that is. So you should be able to have this as a running thing, so you can take a snapshot of the position, say today. As you know from your personal bank accounts, this might change till the evening, because it's not like these are not static amounts. It could be that the direct debit paid today or something, or a bill came through, or you bought something with a credit card. But if somebody asks, is this a viable business? Having a quick look at this balance sheet and it corresponding to your bank account tells you that this is a viable business that is more or less surviving. But these are the real cash flow things that are moving around all the time. It could be that you got other stuff. It could be that you've got long-term assets and liabilities. So if you took a loan, but this loan doesn't need to be repaid immediately, this needs to show somewhere. So in your balance sheet, and the way that these things are expressed in this paperwork, you should have also the things that go further into the future. So if you've got a £10,000 loan that you need to repay in 3 years' time, this should make its way into your financial statements. But also, you need to put in there long-term assets. What if you bought premises? You bought like a storage unit, or you bought a van. This isn't something that you buy and sell every day, but it's something that was expressed in your balance sheet when you made that purchase, but now it has remained as an asset of the business. So this tells me, the profit and loss statements and all of that tells me how much money am I supposed to have in my bank account right now, but it's not the totality of the wealth of the corporation. Because it could be that I bought a laptop, I bought a mobile phone, I bought a motorcycle so I can go around and make deliveries. And all of that, the value of all of that stuff was £10,000. It could be what I spent my original loan on. So I've got this, which is a representation, a snapshot of what is happening on a daily basis. But then I've also got this, that's got the assets of the company that I don't intend to get rid of, but it's also got long-term liabilities that I need to pay back. All of this is going to be reflected in the paperwork, in the submissions that you're going to make to Companies House that detail your financial situation. It is going to register as outgoing funds, but then it's going to generate an asset of that value that is present on the asset side. But that's why it's called double entry bookkeeping, because everything that you spend money to purchase shows as an expense, but at the same time it shows as an asset that's been accumulated by the company. This stretches your understanding of the value that exists in the company across time, because this is cash, right? So this is stuff that is available right now. But that stuff's not cash. So how can we tell if a corporation is doing well or not? The overall position needs to be positive. So if your assets, which is long-term assets and money in the bank right now, perhaps incoming money, there could be a few invoices that you've issued that are going to be paid by the end of the month. All of that stuff counts in the positive sense. You need to compare this with the outgoing stuff, which is your loan repayments, say tax bills, any other things, or things that are getting paid currently, or things that are to pay shortly into the future, or all perhaps things that need to pay a bit longer into the future. The overall picture needs to leave you positive. So if you have a negative balance and you're in the red, when you compare the totality of your assets and the totality of your liabilities, you're in trouble. It doesn't mean that you're instantly insolvent. The instant death comes out of an imbalance in your accessible money, the current version, the live version of your balance sheet. Because the problem here is that if you've got more money coming out than money coming in, and your account cannot meet that, you need to find a way to satisfy that demand. Otherwise, if you tell people, I'm unable to pay because I've run out of money, they could start the process that puts you into insolvency. And they don't care what is the rest of your long-term asset base. And this is the thing that kills corporations that are seemingly quite wealthy. Because people always have difficulty understanding how a business can go bust when they clearly have a lot of wealth. So they've got factories, they've got shops, they've got loads of products and goods that they're in those shops or in their warehouses. So since they've got all this wealth, why are they going bust? They're going bust because if you compare all this wealth against all the money that they owe people, they're probably in the red. But also, crucially, they have difficulty right now meeting the demands of people for payment. So as we're going to see when we talk about insolvency, if you owe somebody in excess of £750, they can go to the court and ask that they shut you down. And I'm not saying you don't want to pay because they dispute the claim, because you think it's a mistake, or somebody asks for payment and you're like, I paid for this already, I'm not going to pay you again. I'm saying you acknowledge the claim and then you say, I'm not in a position to pay. Your options then are to consider the structure of your balance sheet. If you need cash, so if you've got problems with the immediate money, are you going to liquidate something to generate cash to pay people? Is that possible? Can you sell some of your stock quickly? Can you sell some of the stuff you have? Can you put like the laptop that you purchased on eBay and you get some money quickly to be able to give it to somebody? Is that possible? If you do that, then you can cover the shortfall that you got short term. Or can you borrow money? Can you go to the people who supported you in the past and ask them more money? Or can you go to a bank and get a loan or an overdraft? If you cannot do this and you cannot meet the obligation, you run the risk that the person that you owe money to is going to put you into that process. When the court appoints somebody to look at your situation, when they have a look at your situation, if they realize that your problem isn't just a temporary cash flow issue, but is a deeper thing that your overall liabilities exceed your overall assets, then you're dead. But imagine, to go back to what we were talking about originally, how are you going to be able to figure this out if you don't have a good command over where your money is, what sort of operations you're running, and to have accurate dates for when things need to go out and when things need to go in. It can make all the difference in the world. You get a tax bill. Whether you can pay the tax bill immediately or whether you need an installment plan could make the difference between you going insolvent or not, right? Because if the tax bill is payable immediately and you don't have the cash flow, you're dead. If the tax bill can be paid in like 3 or 4 installments, and you know that you got invoices that are going to pay you the next month, the month after, enough to cover the liability, then you're fine and it's nothing to worry about. But if you weren't clear on this, there's no way you're going to be able to arrange this. Another reason why businesses go bust is that what they thought was a controllable process for getting money in and getting money out is somehow disrupted. What happens if you're in a normal situation where people give you lines of credit and then suddenly they don't? What happens if you always paid your suppliers in installments and now your suppliers say we need payment up front, otherwise we're not going to give you the goods? That might actually push you over the edge. Yeah? Many businesses that are bigger, they go bust when the banks refuse to roll over their loans. It could be that the economic situation has changed overall and the bank wants more money for the loan or a different payment schedule, or it could be that, something has happened with the company, they don't want to lend them at all. But usually is that the banks ask for more money as a repayment for the loans or to roll over the loans. The company says, actually, we're not comfortable doing this because now servicing those loans is costing us so much money that we won't be able to make any profits. At which point the banks go, well, then we're not going to lend you the money, and all hell breaks loose. Big businesses that go under is because they have their funding pulled out by the banks because the banks change their minds. The big airlines, Monarch that went out of business a few years ago, Thomas Cook, there was a travel agent that went out a few years ago. All of this went under both because they couldn't make some payments to the regulators, because to renew your license, you need to pay some money every year. So they had difficulty doing that. But also, crucially, the banks told them they were not willing to continue to give them credit in the same terms as before. And the cost of borrowing was much higher, and the company wasn't able to justify that extra cost. The banks refused to lend, everybody else refused to lend. These balances here went out of whack, and the businesses were bust. The trick of what we're doing is all about being able to interpret balance sheets. So do you think you would be able to figure out, if you got a basic appreciation of what the balance sheet is meant to do, do you think you would be able to look at the finances of a corporation and work out whether it's okay or not? I mean, I'm not talking about the really, really complicated stuff for the massive corporations that are turning over kind of billions, the ones listed in the stock market, even though there's plenty of information about them. But sometimes the more information you have, the more difficult it is to sift through this information. But they will, in the directors' reports that are coming out every year, they will give you, usually, a very concise infographic that says this is what the company performance has been. Sometimes they say they lost money. But that's not the end of the world, because if they can manage this, losing money isn't what puts you out of business. The balance here is what puts you out of business. Because the company could have lost money, and they say, we have secured funding to cover that loss and to cover our operating costs for the future and so on. So, yeah, we lost money, but we're going strong. That cannot pay stuff. The people who are left unpaid are the ones who can choose what happens. So if you're owed more than £750, then you can go to the court and ask them to appoint administrators to take over this company. And when they do this, then they will have a look at this paperwork and at this situation and make up their minds whether this was a temporary problem or a mistake, or in fact, the company cannot meet its obligations. If the company cannot meet its obligations, then they're going to see, can it be rescued by selling something, getting somebody else to come in and help, arranging a loan. If nothing can be done, then the company eventually will shut down. Because if the company, but that's exactly why this is not good, right? Because if a company is going into insolvency, which is, they tried a bunch of stuff, the end of the process is, well, there's no saving this, it's going to go under. So the company is going insolvent. Then who gets paid depends on how you rank on an order of priority in insolvency. And we've got like a presentation specifically on this one. We can talk about this. If you're high on that list, you got some chance of recovery. Nobody ever gets all their money back. But if you're lower down on the list, you get nothing. That's why you need to do your homework before you start doing business in any serious way with anybody. There are loads of very well-known, seemingly quite wealthy corporations that have gone extinct. Now, these big things go bust all the time. The latest, at the time that we're having this discussion, the closest big failure that hit the news was WeWork, the shared office space. They have gone under in the United States, but not in the rest of the world. So the UK part of the company is still up and running, and that's why you see their buildings around London. And no, the company were insolvent, but the IP got bought by somebody else, and their website is running again, but not the physical shops. Today, what happens when a business goes bust, and then there are some things that can survive. So you might still see some of their IP, and you might still see the logo and things, but it will not be the same company behind it. Usually we associate the company with its intellectual property, its trademarks and stuff like that. That makes it recognizable. But quite often, some of the IP will survive and then it's taken over by another company. An example is Habitat. You remember Habitat? They had various stores around London, and it was furniture and things like this. So it was like an upmarket version of IKEA. Exactly the same stuff, but they had assembled it already before they gave it to you. And you paid like a kind of 60% markup. But anyhow, Habitat was fairly well known and fairly well established. It went under quite some time ago, but you will find some of the branded items in other shops. It's because some other companies have bought the IP, have bought some of the design rights, and they continue to produce some of these things, and now you find them in other places. Electrical retailers are normal victims of modern business practices. There used to be various electrical retailers on the British High Street and various mobile phone shops. Almost all of them are gone. There are many dodgy stores, like W.H. Smith's is my personal favorite because it looked horrible when I got to this country more than 20 years ago. And it still looks exactly the same. Like overpriced stuff you could get anywhere else, displayed in horrible, badly lit, crammed, dingy buildings surrounded by school kids who steal stuff. It just blows your mind that this thing's still there. But anyhow, all the electrical retailers have disappeared. There used to be Carries that sold various types of electricals, from computers all the way to kind of home white goods and so on. There used to be Comet. There used to be Dixon's. You remember Dixon's? Carries is still around. So it was Dixon's, PC World, that all of these consolidated. They kept buying each other. I think the only one left, in fact, is Carries, because they bought everybody else or whatever was left of everybody else. Sometimes this is consolidating brands without making a great change to the corporate arrangements behind them. But very often, the corporate will have failed, and then either it completely disappears or the bits get bought off. And don't forget that because corporate entities are set up in particular jurisdictions, it could be that the brand is global, but it's the local impression of that brand that has gone under. There were the supermarkets, there were Woolworths and stuff like that. They closed in the UK. They continued in other places. So you might come across, as you kind of going in other countries, you come across something that used to exist here and your parents used to take you when you were kids, and you're like, oh my God, this thing's still here. Yeah, because the American version of it was fine. It's just the British version that didn't make it. Yeah, because that's precisely trying to figure out what we mean by insolvency is the main part of the discussion we're having today. So we've got all these things that, they, especially the companies that have got a retail presence, they exist and we see them and they're kind of foregrounded in our experience as consumers, and then they're gone. Now, why are they gone? Most of the time, they're gone because somebody made a mistake. It's quite possible that as businesses try to evolve, they invest in the wrong thing, or they try to get a great deal of debt to overcome something that they think is a temporary problem, and it turns out to be something more than a temporary problem. The way business operates, it's usually an unmanageable level of debt that kills companies off. The reason why they accumulate the debt is probably bad business decisions or bad business structures. So a company either is healthy but invests a great deal of money in something that does not work out, then they find themselves unable to repay those debts and they go under. Or a business that has successful operations and has had a successful track record gradually becomes less and less meaningful and starts to kind of bleed its clients up until the point that nobody wants to buy stuff from them anymore. Then they usually try to get loans to get them out of a temporary problem. Then the loans become the problem itself. Usually, the avenue to disaster is taking on, instead of changing the business model or addressing the underlying problem, is taking on debt to keep things running, and then you have an unmanageable problem of debt, and then you fail. If you think about the businesses that we have around us that have gone bust recently, debt has always been the thing that killed them. WeWork, at least the US part, took on incredible amounts of debt because these guys were trying to deal with issues with their cash flow. They needed to rent all these buildings, renovate them on long-term contracts, and then lease them out to people on short-term contracts. This means that they needed to borrow a great deal of money and make all this capital investment to be able to operate, and then they were having an incoming trickle of funds. So this needs to be balanced very carefully because, of course, you need to have the clients that you're eventually selling to, but you need to match your outflow, your debt repayments, with your incoming streams of funds. And if these don't match, then your level of debt goes wider and wider and wider, and at some point, people ask for their money back and you realize you don't have it. So this is what happened with WeWork, but of course, they were hugely affected by the lockdown. I mean, what's the point of having rental office spaces if the country's in lockdown and nobody's allowed to leave their house? Nobody's going to go rent things. But you still have to pay rent to the buildings that you already have. Other businesses like Carillion, for instance, that was like a huge construction company, again, huge amounts of debt. They don't want the press to know, usually because that affects share price. The companies that are listed in the stock market, they want to maintain their share price stable for a variety of reasons. As we're probably going to see in the context of other presentations, as your shares are getting traded in the stock market, you as a company do not get additional funds. You only get the money the first time that you sold the shares. Then people are selling to each other. Right? But if your share price drops significantly, this isn't great because the company still has some of its own shares, so the value of its own assets goes down. And that looks bad on the accountancy books. Also, some of the employees might be paid and rewarded in shares, so the value of their income goes down. Plus, the overall perception of the company is not positive. So for publicly listed corporations, bad press is something that they really try to avoid because they're concerned about the immediate impact this is going to have on share price. If a company is not listed in the stock market, then negative press is never great. If you're exposed to retail, it might put off your customers, for instance, but it's not the end of the world necessarily. If you're an industry business, so your model is business to business selling, and you're a private limited company and you're not in a stock market, then maybe some adverse press might not be the end of the world. But nobody likes negative stories coming out. That's why the kind of traditional thing that you see in the movies, every time something kind of goes off the rails with the businesses to try and keep it as confidential as possible. Yeah. So it's always a good idea to keep things confidential, but it doesn't have the same amount of influence at any level, at every level for every type of business. Companies that had taken on too much debt that failed. I mean, we mentioned WeWork, we mentioned Carillion was a big construction business that went under and had significant consequences here. A lot of travel companies have gone under because they were in trouble both before and significantly after the pandemic. They were borrowing a great deal of money. And again, borrowing money in itself is not a problem. But how you borrow money and how this fits into your income inflows and outflows, this is what makes the difference. It's possible that you have a very profitable business, but you need to have a great deal of cash to be able to do stuff. So if you're a travel company, you need to renew licenses every year. These licenses cost a great deal of money. It could be that you have to pay for those licenses before your clients have paid you for the services that you offered. If people are paying a deposit to go on holiday, they will pay the balance on that deposit closer to the time of travel. So if everybody is booking the summer holidays in January and pays like a 10% deposit, and then they pay the rest of the money in May to go on holiday in July, then the company knows that it's got a great deal of incoming money in May, but it still has a great deal of expenditure now. If they haven't saved the money from the previous year, they will need to borrow money to be able to keep operating till they get the cash flow coming in. Because the banks, we're talking about commercial businesses here, we're not talking about banks. Banks are controlled in how much money they have aside, how much money they make out as loans through different systems of regulation. And so long as they keep within the boundaries that the regulator has set, then they're considered to be safe to operate. So we're not worried about this. Plus, the banks are not running business with their own money. The banks are there to kind of funnel other people's money to allow them to do their business. The banks are not. They have a model of incoming and outgoing funds, and the regulator determines how much they need to keep aside for security, but they're not, in fact, betting their own money. Yeah? Once the problem hits, it could hit because the incoming and outgoing cash has become unbalanced. It could hit because the level of debt has gotten too high and the repayments of that debt is too high. It could simply come from business reasons, commercial reasons. You're selling a product that nobody wants to buy anymore. There are plenty of those, right? Or you're an electrical retailer that because you have shops on the high street and employees there and you need to stock things close by, you've got enormous expenses. So you can never offer the same prices as an online retailer that their warehouse is in some random place in Scotland and everything happens online. So the model is very, very different. So it's extremely difficult to compete if you are a physical shop with somebody who's selling the same stuff online. The online stuff is likely to be a lot cheaper. I mean, if their distribution network is effective, or it could be that you're simply selling something nobody wants. Who buys overhead projectors? What you gonna need overhead projectors for? Right? So look, in your average lecture theater, you got machines that we used to kind of project things on the walls or whatever, or put a set of slides and have them up on the wall. We don't need those anymore. We've got screens everywhere. So either you innovate and build something new that is relevant to the way people live now and something that the customers might want to buy, or you're going to go out of business. So the world might have changed around you. Your customers may no longer be there because nobody buys that stuff. You could have invested in the wrong thing and you spend a great deal of money and that ruined your business. You could simply have taken on too much debt, either because you were trying to invest in something or because you tried to get over a temporary difficulty, and then you cannot service your debt. These are the business reasons why businesses get in trouble, but it is not the legal pathway for a company to shut down. The legal pathway is rather more mundane. What happens is that one of your creditors turns up and says, you owe me money, I would like you to pay that money. If your response is, I'm sorry, I cannot pay you because I don't have enough money, then we have a situation. I'm not talking about the situation where you dispute the invoice. It's not like somebody turns up and says, you owe me £1,000, and your response is, who the hell are you? I mean, I don't know you. We don't have anything to do together. I don't owe you anything. We're talking about the situation where you acknowledge the claim, but you also acknowledge a temporary inability to meet that demand. If you owe somebody, we're not talking about £50 here, but if you owe somebody a slightly more significant amount, not huge, if you go through the Insolvency Act, it says £750 is where they set the limit. I mean, it can fluctuate depending on how the legislation is set up, but currently it's there. If you have an invoice that you need to pay that is in excess of £750, and your response to that demand is, I'm sorry, I don't have enough cash to be able to pay you now, then the person that is owed this money can go to the court and can start a process that could end up in your insolvency. So they go to court and they file appropriate documentation for this unpaid demand. The court will then appoint, well, once they do some basic checks to make sure that this is not an error. Because of course, if you were paying something with a standing order and you change bank account or something went wrong with the bank and they didn't pay out, they're not going to shut down your business because the payment is delayed for a technical reason. Once it is determined that the invoice has not been paid because of an inability to meet that payment, then you're beginning with a process that starts with the appointment of administrators. So the court will bring in people to have a look at your company and figure out what's going wrong with your finances. This has a series of very important consequences, because from the moment that the court appoints administrators, these are court-appointed officers, and they take over the running of the company. So the board of directors is no longer running the show. It's the court-appointed officials that are running the show. What they will do, they will have a look at the company accounts to see how much money is available and what this money is supposed to be doing. If you think back to the presentation that we had about accounts and how these accounts are represented in the balance sheets, the profit and loss statements, they will have a look at that stuff. They will have a look at current assets against current liabilities, and also long-term assets against long-term liabilities. If your short-term liabilities exceed your short-term assets, it means you cannot make payments. So then the question becomes, is there enough residual wealth in your company, in your long-term assets, to try and turn this around? So your company is still operating. The company is not dead yet. But crucially, they're going to have to think, where is the value placed in this company? And if it is placed in kind of long-term stuff, can this be turned into cash to help you cover your liabilities right now? It could be that the company has enough wealth that can be changed and turned around in a way that it addresses a temporary liquidity problem. If that is the case, then they will make those changes. Once the company is restored to financial health, then the administrators can leave and the company can continue. Most of the time, they will find something more significantly wrong with the company, so they will need to sell off something important. That's why you will read in the financial press that once administrators have been appointed to look at the corporation, then they look at things that are significant. Shutting down stores, selling significant assets. If you have a significant retail presence and you have a lot of shops around the place, maybe they're going to close the shops that are loss-making and just keep a few that are making a profit in order to turn the company around. It could be that they sell parts of the business itself. If the business has got like a kind of physical arm and an online arm and something else, or a part of it is services, part of it is goods, maybe they're going to determine which one is actually making money, which one's making loss, and get rid of the one that's making loss. That could be a way to kind of restructure the business looking into the future. At that point, as I said, the company is still operating. If the problem is beyond the temporary, then we're looking at other situations. Because if the problem cannot be fixed by reorganizing the business, dealing with expenses, dealing with costs, liquidating some of the assets to generate cash, if that is not fixing the problem, then the company shifts to another process and begins the process of shutting down. So at that point, the administration turns into liquidation, which means that the company now is not going to survive and everything is beginning to kind of come apart. In that case, the board of directors is not returning. So the directors were sort of in the background while the administrators were having a look at what the situation is. If the situation cannot be turned around and the company cannot be restored to operations, then the board of directors is gone. If it turns into a liquidation situation, then the officers that have been appointed now have a different job. Their job is not to check whether the company could survive. Their job now is to check that enough value can be generated out of what the company has to compensate the creditors. In any event, once you begin such a process, the focus has shifted to the creditors as opposed to the shareholders. You will remember from what we've seen in the past that the company is run in the interests of the shareholders. So returning profits to the shareholders is the primary goal of having a corporation. But once you get into this sort of trouble, that the company can no longer pay its creditors, the focus shifts to preserving money for the creditors. Nobody cares about the shareholders. If you graduate from an administration that might have the company surviving to a liquidation, which means the company is not surviving, then the shareholders are out. So the shareholders both their interests are irrelevant anymore. What they might want to do doesn't matter to anybody. The only thing that matters is the creditors. And the shareholders are not getting anything back. So there's no extra value that they're going to get out of the company. They effectively hold a bunch of shares that are now worthless because the company is going to shut down. They're not allowed to sell them or do anything with them. They lost the amount of money that they put into the company to begin with. So whatever money you paid to purchase the shares, if the company is going insolvent, these shares are worth nothing and there's nothing you can do about it. Now, this might sound harsh, but remember that that's the whole point of this organization. If you participate in a company, a private limited company, the whole point of your participation was that you have unlimited potential to benefit when the company is doing well, but if the company does poorly, the maximum you can lose is the amount of money you paid to purchase the shares. Well, now things have gone wrong, so the worst thing is happening to you, but it could get a lot worse. If you were not in a private limited company, then they might come after your personal money as well to satisfy the creditors. So if you were working for yourself and you didn't have the protection of a corporate entity, if you owe people money, you need to pay that money. Nobody cares if that money is in the drawer that says business or it's in the drawer that says, Tesco money. Having the benefit of limited liability means that they cannot come after your personal drawer, but whatever was in the business drawer is gone. Okay? Now, the important thing now, once you're going through the process of Insolvency, so the company is getting liquidated, is to figure out who gets paid and in what order. Because all creditors are not the same. And this is very important. There are loads of people that a corporation might owe money to, even on a small level. You have to pay internet. You have to pay mobile phone bills, right? You have to pay your employees' bills, your salary, their salaries. You have to pay national insurance contributions. You have to pay pensions contributions. You have to pay your taxes. You need to refund VAT to the revenue. You have to pay your suppliers who brought you stuff, either stuff that you consume in the running of your business or what are the components of the goods that you're selling. So you could owe a great deal of money to people who are supplying you with products. You might take benefit of various services. You could be using cloud services. You could be using all sorts of stuff that have got a cost. You need to pay for the maintenance of your website. You need to pay your accountants, your lawyers, other types of professional consultancy services that you might have needed. All of these are a long list of liabilities, and it doesn't even include debts that you might have to banks or loans that you've received from other investors and interest that you need to pay on all those loans. So every business that has a significant level, even a small level of turnover, but from the moment that you're having a level of turnover, you will have generated all those liabilities. Now, normally these liabilities aren't a big deal. They're represented in your accounts, so you can see where everything is. They only become a problem once you've run out of money and you cannot pay these people. The people who are running the show now, the liquidators, are going to have to make decisions on who they pay. There needs to be a system and a method that allows them to determine who gets paid first. And all this is built into the law. This is not at the command of the liquidators. So they don't have freedom to make choices. So they cannot say, let's pay the little people first because they might be the worst affected, or let's pay the banks first because the banks look scary. Right? Determining who to pay and when to pay them is all in the process that is built into the law, and your reference for this is the Insolvency Act. So in this domain, if we're discussing company business law and all of that stuff, usually when we were talking about corporate organization, setting things up, and then looking at the rules as to what makes a company operate, we were looking at the Companies Act. Now that we're looking at the failure of the system, we're not looking at the Companies Act primarily. It has some role to play, but not so much. We're looking mostly at the Insolvency Act, which is specifically built for this. Every act of parliament is subject to changes all the time. So if you're looking at the legislation.gov.uk site, it's going to tell you that what it shows you is the act as applicable at. So you look at the screen that says the act as it is currently in force, and that will contain all changes that have been made since. But when you refer to the act, you still refer to the act with the original date when it was passed. Yeah. So in the same way that we talk about the Companies Act of 2006, we talk about this Act of 1986, but clearly we're not looking at an old statute book to take the version of what it was back then. We're looking at what it looks like today after all the amendments have been passed. The amendments are passed by statutory instruments is something that happens all the time. Right. So there's a list and there's a process that will tell the liquidators who gets paid first and how to determine between the various types of creditors. Bankrupt is not a term in English law. They go bankrupt in the US. Here, if you say bankrupt is for personal bankruptcy, if an individual cannot pay their debts, then they go bankrupt. But in the corporate domain, it's called insolvency. So, in effect, nobody goes bankrupt in the UK, they go insolvent. If you bought a phone from a mobile phone shop in the high street, and you bought it SIM-free, right? Just a device. And you paid for it in advance, and they said it's going to be here, collect in store, couple of days. So you paid with your card, fully charged on your card. You go to the shop in a couple of days when they said it's going to be there, and you find that the shop is closed. And they've got a sign saying, sorry, we've gone past. But the phone that you ordered is sitting there on the desk, and you can see it from the window, and it's got your name on it. It's got like a post-it note with your name on it, and it's sitting there on the desk, and you fully paid for it already. Can you get it? No, you're not going to get it, because this is still an asset of the company till they deliver it to you. So what you have is a claim to the phone, but it's not yet your property. Do you think that you're going to be able to get it if you talk to the liquidators, you talk to the offices that are running this and say, it's my phone, it's just there, it's got my money, I don't want anything else from you guys, just give me my phone. You think they're going to give it to you? The owners of the company are gone. So you would want to know, because now there's you and there's a bunch of other people waiting to get stuff. You would like to know how you rank in relation to all the other people, and whether you have a claim to be the first in line to collect it or the last in line. Now, unfortunately, in your case, you're going to be the last one in, because the order is, first, you have the people who are called secure creditors, then you get the people who are called preferential, then anybody who has a floating charge, then anybody who's unsecured, meaning has got no particular claim, which is you, then any interest on any of those debts, and then in the end, if anything's left, the shareholders, but of course, in these cases, there's nothing left for the shareholders. So we need to kind of try and figure out, within that order, who is who, to try and position you, and to give you a sort of estimate as to whether you got any chances of retrieving that phone or not. Secured creditors are the people who run the show, because the court-appointed liquidators are not doing this for fun, they need to get paid. Usually they get accountancy firms to do this. So these people have got bills. So the first thing that gets paid is them. Is the expenses of the court, the expenses of the process, the bills of the liquidators themselves. Which makes sense in a way, otherwise you would have nobody running this process. Then you have the people that are holding fixed charges. But look, none of these things mean anything in a normal language sense. All of these things have got specific definitions within this context, right? So don't try and work it out by thinking, what does a fixed charge mean for me? For you, yeah, it's probably the things that come out on a standing order every month, this is exactly the same amount, but this is not what we're talking about. Fixed charges are entries into the company's books that somebody has a claim over a particular asset of the company. And people take these as securities, as security for loans. So a mortgage is a fixed charge. It means that the bank is giving you an amount of money, and that money is secured by the house. So if you don't pay the money, they'll come and take the house. Yeah, the point with the mortgage is you're buying the house, but they're saying that if you don't finish off with the payments, they're going to take it away from you. So if you're renting something, you never had ownership of the asset. For fixed charges, this is a claim over an asset that you own, that they say if you don't keep up with your payments or if you don't satisfy a particular obligation, then they will come and take that particular asset. But the whole trick is precisely this, that the charge is on a particular asset. So if you go, we've gone in the past through looking at corporations and companies' house and the documentation that they've got in there. They have a list of charges registered on the company that you can see on the documents that are in Companies House. So the banks that have taken fixed charges over their assets, this is actually publicly available for everybody to see. Why is it publicly available? Because if you're doing business with them, you would like to know about other people that have got claims over their assets. Because if everything of value that they've got is already taken over by somebody else, in case you get in trouble, then maybe you're thinking, if you give money to this company, you've got nothing to secure it against, so maybe it's a bit of a risky thing to give them more money. But a fixed asset is over a specific resource, right? So a fixed asset is going to be over something that you can identify. And this is the particular thing that they're going to come and take away. So you could have a fixed asset over vehicles, over property that they own. If we're talking about movable goods, about specific goods, so they need to be securely identified. It could be all the IT equipment, the specific IT equipment that is now in this building. Yeah? And because this is burdensome, you need to go through the process of registering it with Companies House, and once something has a fixed charge on it, the company is not free to sell it, change it, and so on. So if they need to do anything to it, if they want to replace it, if they want to fix it, if they want to do anything, they need to get the consent of the charge holder before they do it. So this is heavy going. It's not done for fun. It's done to secure significant loans. That's the reason why it ranks high in terms of recovery. That's why the fixed charge holders are at the top of the recovery list, because this thing is burdensome enough to do, so they deserve that additional level of protection. So the first people that get paid are the expenses of the liquidation and anybody who has a fixed charge. So if the company has run out of money, has got no cash available, then people come and start taking these things away. Then you have the preferential creditors, which are wages, pension fund obligations, and things that are owed to HMRC, primarily national insurance contributions, VAT redemptions, and income taxes and stuff like that. Now, this has changed. You will see here I had the revenue down in level 4. This has changed recently by legislation, so the revenue has gone up to number 2. I think they realized they were losing too much money because everybody was going bust during the pandemic. So that became an issue for them, and they moved them up. So these are the preferential creditors. It's nice to be a preferential creditor, not as secure as having a fixed charge over an asset that represents your money, but, not a bad deal. After that, you've got the floating charge holders. Now, these are people who have also registered the charge, but there's something different between this and the original charge. Fixed charges are over specific assets. These particular screens or computers, this particular building, or this particular vehicle. Floating charges are on something that belongs to an asset class. So it could be on IT equipment owned by the business, but it doesn't specify which IT equipment. It could be vehicles owned by the business, but it doesn't specify which one. So it's less burdensome. It means that you have a claim over things that belong to a class up to the level that you've set up your charge, but it doesn't need to be a particular thing. If we had a fixed charge to secure £1,000 worth of IT equipment, they would probably have said 3 screens in here. There's 3 TV screens in here, these 3 TV screens, because if you add them together, they make £1,000. These specific TV screens. But if it was a floating charge and it said, we're securing £500 over IT equipment in this room, then it could be when it happened, you would select 1 or 2 of these screens, not all 3 of them, and you don't know which one. So it's more flexible, it's less burdensome, but also because it's less burdensome, it's less secure. how do you determine which particular thing you're picking up is when the floating charge crystallizes, and it crystallizes with particular trigger events. So the contract, the information that gets logged into the books of the company will say, we have a floating charge over assets in that category. This entitlement matures if that happens, and at that point we can come in and get the stuff. So the floating charge will crystallize and become something specific when a particular event occurs in the way that it's determined in this documentation. Usually, it's going to be a default situation. Like if the company defaults on its loans and somebody goes to court and begins the process, at that point, the charge crystallizes. Or it could have other triggers. You could say if debt as a percentage of turnover exceeds a certain level, then that's the crystallizing event. It could be anything because this is contractually determined. It will have to do with the performance of the company, or it will have to do with the actions of others, like who starts a process or who has an unpaid claim, but it can be a variety of things within those bands. Is it good to be a floating charge holder? Well, better than other stuff, yeah? The one thing you're trying to avoid is to be an unsecured creditor. An unsecured creditor means that they owe you money, but you've got no special entitlement. So all the suppliers that have got unpaid invoices are unsecured creditors. All the customers that have paid in advance or put down deposits and they're expecting to get something, they are unsecured creditors. You remember the House of Fraser, the shop? They went into insolvency a few years ago. Now, the brand is still there. Some of the shops are still there because some of it got sold along with the IP to somebody else. The original entity, when they went under, they had a lot of customers who had made orders. The orders that had shipped could not be stopped because they were already with the delivery companies. So when they left the main warehouse and they were part of the distribution network, they could not be retrieved. So these made their way to the customer. The ones that hadn't been shipped already, that customers had already paid for, they were part of the insolvency process. The customers were unsecured creditors. The advice to them was claim back through your payments facilitator. Was it your credit card? Was it your bank? Was it PayPal? Did you pay through some other means? It is your bank that will refund you, not the company. People who had gift cards got nothing because unless they could get a charge back through their bank or something for when they purchased the gift card, and if they hadn't purchased it themselves, it became a lot more difficult, they were unsecured creditors, so the gift cards were wiped out. So keep that in mind if you're buying people gift cards. If something happens and the company goes bust, then the gift card is wiped out and you cannot retrieve the money from anywhere. So like a colleague leaves at work and everybody kind of chips in and you get them like a £500 Waitrose gift card. If Waitrose goes bust, that thing's gone because it's not insured anywhere. Yeah. So the people who were in that situation lost a great deal of money because they were unsecured creditors. In my example, if your phone is sitting there in the shop, even though it's got your name on it, ownership of it has not passed to you because you didn't pick it up. So it's in sale of goods, unless there are specific terms, ownership passes on delivery. It hasn't been delivered to you, so it still belongs to the shop. You are an unsecured creditor. You are at the end of this list. After they've paid the fixed charge holders, all the preferentials, and all the floating charge holders, do you think there's going to be anything left to compensate you? You will certainly not get that particular phone that's sitting there. You won't get that, but you won't even get the money back. So when this happened, it happened to our students because there was a phone company called Phones for You that had a shop next to the main building. And a lot of students got phones and stuff from them. It was like a common thing to do. The ones that had bought a contract, like a pay monthly contract that came with the phone, their contract was with the company that gave them, because say you were buying a contract with Vodafone and Vodafone gave you the device and the airtime and all of that stuff. Because the contract was three parties, the student, the shop, and Vodafone agreed to fulfill the terms of the contract and gave people the phone that they had ordered. The people who had ordered stuff SIM-free, just a device from the particular shop, couldn't get it because they were considered to be unsecured creditors. And there was nobody else to help them. So for those people, we said, check with your bank. If you paid by credit card, then by law, on the basis of the Consumer Credit Act, the bank is a third party, is another party in your contract with the supplier. So if the supplier doesn't fulfill the contract, your bank becomes responsible to do so. Therefore, your bank will refund you. If you have a debit card, it's not an obligation by law, but usually they will help you out for contractual reasons. So a lot of people got refunded because they managed to do a charge back on the debit card. So they got the money back. Anybody who bought by PayPal or something, again, contractually, PayPal guarantees the transaction. So if you don't get your item, then they're going to give you back the money because they've got that's part of the deal that you've got with them. Other facilitators might have offered similar things. But the people who, say, paid cash to order the phone, and then they were just waiting for it to be delivered to go pick up in store, and they had no relationship in this transaction with anybody else other than the shop there, they lost out. So the last thing you want to happen is for you to be left as an unsecured creditor, because then you have all the risk of the transaction going wrongly. Could you get insurance? I mean, from a retail point of view, you might. Not so much for goods, but usually for services. If you buy a flight or you buy a holiday package, at some point in what they're selling you will pop up and say, do you want to purchase insurance? This covers your inability to travel, it covers a failure of the supplier or anything like this. Sometimes this is by law. If you buy like an atoll protected holiday, they will say that atoll guarantees the supplier's end. So if the company fails, then they will refund you for your holiday. So sometimes the stuff is prepaid and it's part of your package. Some stuff is an opportunity to purchase additionally while you're making this transaction, or sometimes you can protect yourself externally. That's why we buy travel insurance for ourselves that covers all the travel that we have in the year, or your credit card might offer you travel insurance as a top-up, or your bank account or something like this. But what I'm trying to get to is there are rules within the corporate insolvency system as to who gets what and when, and everybody gets attached a different label, and that label puts them on a priority list. What you need to think about is how do you elevate yourself within that priority list to be at the safest possible point. If you cannot elevate yourself within that list, then try and get some external protection through insurance, contractual obligations by an external provider, consumer credit protection, or something like this. If this is a business-to-business situation, there's something else that you could do. You could, in your contract of sale, separate ownership from possession. Did you guys do anything about the Sale of Goods Act when you were doing contract law? Now, maybe you didn't talk about the law of sales when you were doing contract law. If you had done business law, certainly there were parts about the Sale of Goods Act in there. But in any event, in the Sale of Goods Act, you have the opportunity to separate possession from ownership. Normally, you gain possession or you gain ownership when the goods are delivered to you. But it's not necessary. So you can say you have possession, but ownership belongs to somebody else. That can provide a way out of this situation here. If you deliver the goods to the company and your contract of sale says ownership to those goods passes to the company when the invoice is fully paid off, or perhaps when all the invoices we have together are fully paid off, then they might have physical possession of the goods, but the goods are still yours. What this means is that if the company goes bust and the administrators, liquidators, etc. come in and try to divvy up assets, these assets are not part of the insolvency process because they don't belong to the company, they belong to you. What you also need is to give yourselves right of access to say that not only till the invoices are paid off, these things belong to me, but also I have the right to access your warehouses to retrieve those if I am unpaid. But that way, you kept yourself out. And this is a cheap way to do it. You don't have to register a fixed charge. You don't have to register a floating charge. You don't have to worry about anything else. If the only thing you're interested in is getting paid for those goods or retrieving those goods, a retention of title, as this is called, is an excellent way to do it. The law has well integrated in this concept. It's not a problem. As I said, it's in the Sale of Goods Act. There's lots of case law that validates the retention of title clauses. One area of difficulty that we had is when the goods have been messed with. The key issue with retaining title is that your goods remain distinct. So if they take them, they put them at the corner of the warehouse away from everything else, and they know which one it is, then it's not a problem to say this thing doesn't belong to the company, it belongs to me. But if what you gave them is generic, you gave them potatoes, and then they emptied them in a big bucket of potatoes, you don't know which one's yours and which ones are the others. In that case, your clause is not going to work. Or if you've got a delivery of cans of tomatoes and the packaging is the same for everybody and they put them in a massive warehouse along with the others and you cannot identify them anymore, you have a problem. Or if they open these cans and they make sauce out of it, pasta sauce, then they've used them. So again, you lost the right. If your goods are mixed or part of some sort of manufacturing process, or even worse, sold off and turned into money, then it becomes very difficult to trace your ownership into that outcome. So long as they remain distinct, my boxes in their packaging, the way you got them, sitting somewhere separate and identifiable, are mine until you pay me, then that works very well. So that's like a final, not for retail, of course, doesn't work, but it's a final mechanism that you can use to protect yourself and elevate yourself into this order if you want, or even, the best way to play this game is not to be part of the game to begin with. So you remove yourself from that discussion by making sure that the goods that you're interested in were never owned by the company. There are a couple of important things that I want to talk to you today about, and it follows on from the discussions that we had in previous presentations about going bust. You remember all this stuff about insolvency? Nobody enjoys going bust, do they? It depends. You want an example of people who walked away smiling out of a process like this? Body shop. So what happened with the body shop is that they got purchased by various kind of equity groups and finance people and so on, and they kept changing hands amongst them. They ended up with the private equity group that they're in now. They got purchased fairly recently. Now, all of a sudden, even though they got purchased like a year ago, right? All of a sudden, they kind of go, yep, this is bust, goodbye, and they put the whole business into administration. They had already restructured the guts out of the international business because this is all over the world, right? But the British version, they put them into administration. we've seen, when we had a discussion about insolvency, we've seen what that means. When somebody gets in trouble, the first step, well, you know that they're in trouble because one of the creditors usually comes around and says, you guys owe me money, and the company goes, yes, sure, but we cannot afford to pay you, please come back later, at which part the person owed the money has the opportunity to go and petition the court to start this process. So the beginning of the process is an administration where an external party comes in to check what is happening with the business, whether it's got an opportunity to be satisfactorily restructured or not. If it cannot be restructured in a satisfactory manner, then the administration graduates into a process of insolvency where people come in and kind of chop off the bits and try and sell them off with the aim of generating the maximum amount of money for the creditors in the hope that people get as much as they can out of the money that they've invested. Now, what happens with the body shop is that new owner puts them very quickly into administration, and then they are dealing with this through a major restructuring of the business, during which the creditors are getting a huge write-down on their investment. So anybody who was actually expected to be paid back by the body shop is not going to be paid back a great deal of money, because as a result of the restructuring, they're taking a very, very significant haircut on their investment. And you're thinking, hang on, the people who just bought them, they put so much money to purchase the business, and they immediately declare that the business has gone bust. Doesn't this look a little bit iffy? It does. Because if the business was so fundamentally rotten, when they did their due diligence before they purchased it, they would have worked this out. So what's going on? What's going on, very interestingly, is that they themselves purchased the business, so the private equity group that got the business, they did. But then they made a great deal of loans to the business. So the shareholders gave loans to the business. These loans, using the mechanisms that I'm going to explain today, have elevated priority in insolvency. So they managed to secure the money that they themselves lent to the business and to put themselves on top of the pile of potential creditors if something goes wrong. Then they immediately turn around and put the business into administration and do this restructuring plan. And, as luck would have it, they're the ones who get all their money back because they're at the top of the list and everybody else is left with nearly nothing. So this looks like a super scammy thing to do to the other creditors. Everybody knew that the body shop was in trouble, but nobody knew it was immediately going to go bust. So this looks like a scheme to actually defraud the rest of the creditors. And I'm sure in a couple of years' time, we're going to be telling students like yourselves about cases going through the courts about this. But let's try and work out what they've done to achieve this, which is really nasty but very interesting thing to do. Now, you will remember that on insolvency, we've got a list according to which people are paid. So how do you know if you're going to get any money back if your business goes bust? You're going to fit somewhere in a list that starts with secured creditors, then moves on to preferential, then to floating charge holders, then unsecured creditors, and then any interest, and finally, if there's anything left, by chance, which there won't be, the shareholders get something. Does anybody remember what we mean by secure creditors? They don't actually have it, right? But they have a claim over a specific asset of the property, right? So they are the people who gave the company money, and in exchange of that, they said, in case you guys run into trouble, then we will come in and collect a specific asset that you have in order to recoup the money that we gave you. Best example of this stuff is a residential mortgage on a house, right? The bank gives you the loan to purchase the house, and they have a claim over the property if you stop making the repayments. So they have a fixed charge over this valuable asset. This is rather restrictive on you. So if you want to sell your house and move on to a different one, you cannot do this without first negotiating with the bank. Some banks, if we're talking about residential real estate, some banks will give you the opportunity to keep your loan and transfer it to a new property. Others will expect you to repay the whole mortgage early and then move on to a new property. But of course, repaying early, if it's not allowed by your contract, might have specific and significant costs. Even if it is allowed, you will still have some costs attached to it. So the fixed charge holder has control over what you do with the asset, even though technically the asset belongs to you. For somebody to be called a fixed charge holder, they need to put an entry into the company's books and the publicly available information that is in Companies House that says they gave you money and now they've got claim over a specific asset. And this is part of the public record. We've discussed in previous presentations the sort of documentation that the company needs to reveal to Companies House and the part of the documentation that is being made publicly available and all the rest of that stuff. So charges are going to appear in the public information that is there in Companies House. Fun fact, everybody lost their shit a couple of days ago because they looked at their own company information and they found a whole bunch of stuff they weren't expecting. So somebody has messed with the record at Companies House and put wrong information about charges. So now everybody is completely freaking out about this. So this is either something having gone wrong with the database and it kind of went loopy and started making up stuff, or they've been hacked and somebody has been messing with it for some purpose or other. But this is tremendously important because if you are in any fundraising situation, the first thing that a potential creditor is going to do is going to look at what obligations you've got already. So if the publicly available record gives the wrong information about what obligations you've got, what assets you have pledged to other people, or which loans you've repaid and which ones you haven't, this is making a mess. Nobody's going to accept to give loans anymore unless you can convince them that the record that they see is a reflection of reality. So there's a lot of people having a very bad time over at this service right now trying to figure out what happened and how to fix it. Secure creditors and the expenses of the process. If you hire an expensive accountancy firm to run administration or liquidation, then you got to pay them. So clearly they're going to pay themselves out of the money that they generate first. Then you got your fixed charge holders. Then you got preferential creditors. These are the wages that you need to pay your employees, money that you owe to the pension funds, and now the revenue. So the revenue is also part of the preferential creditors. So after you generated enough assets, the process has matured from an administration to a liquidation. Now they're selling stuff in order to give money back to the creditors. Once we're in the liquidation phase, then we're going with this list. Second order of priority are the preferential creditors. Then you got the floating charge holders. Who can remind us what are the floating charge holders? It's still a charge that still needs to be registered on the company's book, but it's over a less well-defined set of assets. So it's a pool of assets that meet some description. So somebody doesn't have a claim over a particular thing like a house or a van or a specific, say, IT equipment, but they've got a more broad claim about IT equipment in this place up to the value of £10,000 or things in your warehouse up to the value of £20,000 or whatever. Thing about this is that, of course, it ranks lower, is not as secure and as important as the fixed charge. The company has more freedom. So you can change the nature, not the nature, they still need to be the same class, but you can change the individual items that are subject to a floating charge without needing to get the consent of the charge holder. So it's less obstructive to your daily business experience. And perhaps that's why it ranks a little bit lower. Now, the floating charge will specify a particular event upon which people can come and collect their money. They can come and kind of take off whatever assets they need to satisfy their debt. This is called the crystallizing event. What the crystallizing event will be written down when they set up the charge. Most of the time is the appointment of administrators, right? This is what naturally would trigger this whole process. At that point, we say it crystallizes because instead of kind of floating over various asset classes, it becomes and attaches to particular items and somebody's going to come and pick them up. After you've paid these, you've got the unsecured creditors, and as we've discussed in previous presentations about the effects of insolvency, you do not want to be in this list. If you're an unsecured creditor, it means that you're just scraping through the leftovers. And if the business has gone bust, it is unlikely that there's a great deal of leftovers. Or, as I was telling you about the poor body shop, the whole thing has been engineered in a way so as not to leave any leftovers. So being an unsecured creditor is the worst situation for you. In the unlikely event that there's any money remaining, then you can pay interest on any of those debts, and if there's still something remaining at the end, you can return money to the shareholders. Now, this is only going to happen if the company put itself through a winding up process because they decided they just want to dissolve, and there's enough in the asset base to cover everything. In a distress situation where people have run out of money to satisfy their creditors, there is zero chance of any value being left to return to the shareholders unless something kind of extremely funky happens, like they kind of won the lottery on the way out or something. This is a situation like you're queuing at a soup kitchen and they've got a limited amount of soup and an endless line of hungry homeless people or students. Did you know that in Russell Square, the Hare Krishnas will go and give free rice? When I was working there in the Russell Square, I used to hang around, and when the Hare Krishnas came, the students came out to get the free food, and I went in and found a seat at the restaurant. You don't want to eat the free food, it's a bit dodgy, but still nice idea. You guys are interested in free food? Going through the trouble of registering a charge on the company's books in a way that elevates you up the chain is the surest way to ensure that you're going to get some money in case the company goes insolvent. Because if you're a bank that gives somebody a mortgage and then you've got a claim over the property, I'm not saying that the property value will have kept up and that you will gonna make your money necessarily, but at least you're going to recover the majority of your investment. Unless you've made a horrific mistake in what assets you chose to place the fixed charge on, then you should be okay. I mean, everybody loses out a little bit when something goes wrong, but you're not going to lose out big time. If you're wondering why doesn't everybody then have a fixed charge, the answer is that both it's a complex process to set it up, but secondly, most of the good stuff are given out already. Because most businesses have got some initial backers or they've got bank loans. And these initial backers, if they gave a loan, I mean, if they bought shares, that's something else. But if they gave the money in the form of a loan, they will have taken a fixed charge over something valuable that the company has. And if they got a loan from the bank, you can be assured that the bank has a fixed charge over the major assets. What happens if there are multiple charges over the same asset? This could happen. It could be that you give multiple fixed charges over the same asset. Sometimes this is done in violation of contractual provisions because clearly the first person that asks for the loan to be secured with a fixed charge, they will have in the loan terms and conditions that say you're prohibited from giving further charges over the same asset. However, sometimes this happens, but the law says if we're talking about assets of this, if we're talking about charges of the same type, the first one in time takes priority. So if you were doing your due diligence before giving somebody a loan, you wouldn't really accept as security for your investment a fixed charge over an asset that is subject to a fixed charge already. It's not going to be much help. The first person who asks for it is going to get it, and you're going to get nothing. So for charges of the same nature, the first one in time wins. For charges of different levels, then the one that's more elevated wins. So if you have already given a floating charge and then subsequently you give somebody a fixed charge, in this case, the fixed charge holder will win even though they come second in time, so long as they were not aware of any restrictions in issuing further charges. So if you went and negotiated with a bank and you hid the fact that you have given somebody a floating charge already, then the bank is not affected by this limitation. Of course, if you disclosed it, then, it becomes something else. So the reason why not everybody goes after a charge to elevate themselves up the list is that it might not be available because the valuable assets are subject to charges to different people already. Right. Could you do something else? If we're not talking about either a fixed or a floating charge to elevate yourself up the list. Well, one, depending on the situation that you're in and the sort of investment we're talking about, it could be that you set yourself up as a trust and then the trustees have got control of assets while the loan period goes on. This is fairly complicated and goes into areas of the law that we don't want to go into, but that's an option. Another option would be that the title to the property that is being secured is actually transferred to the person giving you the loan. So you move over the valuable asset or whatever it was, the cars, you then change the cars to ownership of that business while you're still repaying the loan, and then they return that to you. It achieves the same effect as the charge without being subject to triggering events and all that stuff. If you don't repay, they simply keep the cars that they've got ownership already. But that is very complex and expensive and clunky, and businesses really don't like to do this. One of the things that businesses like to do is to utilize property-based solutions, or this is property and contractual at the same time, to use negotiated solutions to this issue that achieve the same outcomes without utilizing the charge registration process in company law. So think about it this way. You are a supplier of goods that you regularly send shipments of your goods to some company. You're worried that if the company gets in financial difficulty, they won't be able to pay those invoices. What can you do to ensure that you are not classed as an unsecured creditor if the company runs out of business? What you could do is that you could utilize the provisions in the Sale of Goods Act that say, while property passes with delivery, it's not necessary that this happens. So you can actually split possession from ownership. Did you guys do any of that stuff when you did contract law, or did you do anything about the Sale of Goods Act, possession, title, and all of that stuff in contract to the company and is worried about the company being able to pay for it? What you can do is separate possession from ownership. So you tell the company, I will send you the shipments. Let's say it's printing paper, right? I will deliver 100,000 pages of printing paper every month. And I will invoice you every month for this. The invoice needs to be paid within 30 days. So long as the invoice hasn't been paid, I retain ownership of the printing paper. You are obligated to keep my deliveries separate in your warehouse for any other similar goods, so they remain distinct and identifiable. And also, I have the right, if my invoice is not paid within the 30 days, to come and retrieve my property that is sitting there in your premises. That is called a retention of title clause. So you can stick this clause into your sales contracts, and you can link this to the payment of particular invoices, or if you've got more complex regular shipments, you can say, till all my invoices have been paid, I retain ownership of the whole lot. That way, if the business goes bust, you don't have to worry about being a creditor, because you're not a creditor in that sense. It is still your property. The company never became the owner of these shipments. Therefore, these shipments do not feature in any liquidation process. It remains your property. If you hadn't done this, then you would be an unsecured creditor. They could use this printing paper, sell it to somebody else, realize the money, and then use the proceeds to go down the list, starting by compensating their fixed floating charge holders and then all the rest of it. But if you retained ownership, then this will never become part of that process. It will not be divvied up amongst other people. But you need to be a little bit careful here, because this retention of title clauses only works so long as the goods remain distinct and identifiable. If these guys are getting printing paper and they're all the same brand, okay, and they're all getting Xerox printing paper, and they put it in a warehouse and they stick it into a place where there's a bunch of other crates that look exactly the same, and you cannot identify those by serial number or something, then you're in trouble. Or if they use the printing paper to create kind of origami duckies, right, then probably it's lost because it's been used in a manufacturing process. It's going to be very difficult to unfold the origami duckies and put it back into printing paper that people want to print on. Now, a lot of the case law in this area is testing the extent to which you can actually incorporate goods with others, mix them up, or what does it mean to keep them separate, or if they've been used in a manufacturing process, can they be detached from that manufacturing process and given back to you? And there's even some case law on, can you trace these goods into money when they've been sold and then they represent an amount of money? Now, there's only one case that this has been successful, which is the Romalpa aluminum case, where the goods got sold and then the money was present in a bank account that was distinct, and then the court was able to say that because you retained title of the goods, you can now trace those goods onto that money that is sitting into the bank account there. But in the vast majority of cases, this does not work. So if you sell the goods, if you include them in a manufacturing process, if you mix them up with other stuff and you can no longer identify them, then the retention of title clause does not work. And unfortunately, the printing paper business is now classed as an unsecured creditor. And this is only relevant, of course, to the sale of goods. Because if you deliver the service and the service has been already done, or it's been used by the other party, then you cannot retain ownership of something that you've already delivered, right? So if I was hired to come in here and give you this lecture, I cannot have retention of ownership of the IP. I've already given it to you, right? I mean, there is some complexity there, but the whole point about the retention of title is to utilize the provisions in the Sale of Goods Act in order to retain ownership of physical assets. How can you get some security for the loan that you're giving, and how you place yourself as either outside the list of priority in insolvency, or to put yourself as high as possible within that list? Now, what else could you do? We talked about transfer of title, mortgage, retention of title clauses and trusts. We explained what are fixed and floating charges. There are some types of possessory security that link up to the idea of transfer of title. If you guys ever go to a pawn shop? You know what's a pawn shop? Cash converters, you know what that is? You see them on the high street? Is where the person that stole your bike is going to go sell it to. All right, now, what happens at the pawn shop is that you go and you give your grandmother's jewelry and you say, give me £1,000 for this, and I'll turn up, give you back £1,000 plus your fee, and I get the jewelry back. And if you never go back, then they can keep the jewelry, right? Or if you don't go back within a specified period of time. This is called possessory security, and that expresses itself in pledges and liens and stuff like that. So it can work for a variety of things where you have given physical possession to somebody of the valuable asset, and then the terms and conditions say that in case you default on your loan, then they can keep that asset for themselves. This is a little bit tricky because in most kind of business dealings, you don't have warehouses to actually stock them with people's stuff in order to effectively blackmail them into paying back the loans, right? So this happens in certain types of domains, but is not really a particularly usable form of obtaining security for loans in a commercial sense. What you could do is explore other types of contract-based solutions. For instance, you could get a third party to agree to take care of the loan if your primary creditor does not repay. Did you guys get your parents to sign on as guarantors for a lease agreement if you're renting privately? Did you guys get your parents to sign on as guarantors on any sort of loan or mobile phone contract? How do you guys get those fancy iPhones? You actually pay for them? If the person that's giving you the money is worried about getting repaid, if you can find a third party to promise to make good the repayment, then people are going to feel a lot more comfortable giving you the loan. So if you were renting privately for accommodation, and the students, they will assume you don't have any money, they will probably going to ask your parents to be guarantors. It means that if the primary creditor is not in a position to satisfy the loan, then once their failure is established, then you go to the guarantor and say, hey, you promised that in case these kids didn't pay the rent, you're going to pay for it, so, cough up. In the corporate setting, the way this works is that the company goes to the bank and asks for a loan. The bank says either you don't have enough assets to support this, or the assets you have are already pledged to other people. Therefore, we will only give you the loan if the shareholders guarantee that loan. In a private limited company, we're not talking about thousands of people. It's probably like a one-person company like I have, right? Now, if I went to NatWest and I said, give me a business loan, they would say, what sort of assets you have? I'd say, nothing. I've got a bank account with you guys, it's got £500 in it, and I'm asking for a £5,000 loan. They're going to say, look, man, there's no way, no matter how much we like your business plan, there's no way we're going to give you a loan of £5,000 on the company with only the company being responsible for it. So they were going to say, if you, as a shareholder, agree to guarantee the company's loan, because they know that me, as a person, I've got more than £5,000 in my account, so I can probably sort this out, then they will agree to give the loan, but now it becomes like a three-person deal, the bank, the company, and me. So in this transaction, I'm a third party that offers the guarantee, but in reality, I'm a shareholder that is assuming that obligation. And as we've discussed in the past, this is, of course, a way to get around the limited liability issue, right? Because the whole point of limited liability and separate incorporation is that the shareholders are protected from the debts of the company. So if you get the shareholders to offer a guarantee, then it goes around this violation. But it's a fact of life. If you really need the funding and nobody's going to give you the funding, then and the only way is to get a guarantee, then very often the shareholders are the ones providing the guarantee. What about the indemnity? Does anybody know what is the difference between a guarantee and an indemnity? You're putting a third party in a position to take care of the repayment of the debt. So it makes the third party responsible, so it doesn't exclude anything. Because a guarantee assumes that they go after the person that they gave the loan. If they can repay, then they go after the guarantor. The indemnity is an independent obligation. So if you've agreed to indemnify somebody for the losses, they don't have to ask the person they did the business with. They can ask you for the money directly. So the guarantee is a primary and secondary obligation. So the guarantor has a secondary obligation if the first debtor fails. The indemnity is a primary obligation. So the person that is owed the money, the creditor, can at their choice go after the primary debtor or the person who gave the indemnity. So giving indemnities is a terrible idea because they could straight come after you. Also, it's a terrible idea because indemnities do not require formalities. To offer a guarantee, you need to satisfy the statute of frauds of 1677 that says a guarantee is only valid if expressed in writing. An indemnity is not. So it could be that you stupidly agreed to an indemnity orally and then you're bound to it if the other person can prove it. So indemnities and guarantees serve the same function. You get a third party to be responsible for the repayment, but an indemnity in some ways is worse than a guarantee. Now you will see some of the literature occasionally talking about what they call letters of comfort. It's the sort of message from a business that says, hey, we are the parents of this corporate group. Our subsidiary is applying to your bank for a loan. We're a big, wealthy corporate group. We've got their back. We're chill. We're the shareholders. It's going to be fine. Now, all this sounds really nice, but it is not actually a legally enforceable obligation. So a letter of comfort makes the bank feel better about discussing a loan to somebody, but it does not establish a guarantee or an indemnity or any sort of enforceable obligation. So letters of comfort are common in getting potential creditors to feel better about the deal, but they don't actually create enforceable rights before a court. There might be some variations of this depending on jurisdiction. I think some American states have got different interpretations of those, but the situation in English law is that you cannot enforce a letter of comfort. Right. What is the final thing? So this kind of covers the majority of proprietary and contract-based solutions, but there's another thing that you could try to prevent you falling into a situation where somebody owes you money and they're not going to repay when they've gone bust. Now, this is a transactional way of dealing with a problem. You have debt, but you're owed money by a company. You're worried that the company might not be able to repay you. A very nice transactional solution to this problem would be for you to sell this payment obligation to somebody else. So you can, if this is the sort of thing that you can transact on, you can make it somebody else's problem. Many of the incoming payment obligations, they can participate in what we call the receivables financing. So if you have an incoming stream of money, invoices that the other people are paying within 30 days, it is possible to sell this incoming stream to somebody else. So the person that buys this assumes the risk of non-payment. You get your money early on, you can go to the pub. It's no longer your problem. Now the question is, why would anybody want to buy incoming streams of money and assume the risk of default of the other party? The answer is, they're not buying them at 100% of the value. So if I'm selling my photocopier paper to the company and I've given them the invoice that says you got to pay me £1,000 in 30 days. And I'm worried that they might have gone bust within those 30 days and I may never see this money. I mean, I tried to put the retention of title clauses and so on, but I don't know, maybe they're going to use the paper. You cannot trust them anyway. I can try and sell this invoice to somebody. This somebody will buy this invoice at 70%, 80% of the value. It depends on how risky the counterparty is considered to be. If this is a company that's got like a table record of making payments, then people maybe will not want to buy it or will pay a lot less. Let's say that this is a normal company without any history of defaults. They will buy this invoice at 80% of the value. They're going to give me £800 now when the invoice is worth £1,000. Benefit for me, I don't have to worry about it anymore, right? It takes the risk away. Also, I got £800 now and I don't have to wait 30 days to get it. What these guys do, they can wait the 30 days, they collect the 1,000, they made a £200 profit. It is an elegant way of me not having to worry about potential default, not participating in the creditors' priority list if the company goes insolvent. It's a great deal for these guys because they can handle a potential default and they make a 20% return on this investment within 30 days, which is an incredible investment if you think about it. You won't find many things that give you a 20% return in 30 days. And beyond this, there's an endless, boundless financial system that has been created to perform this function. And you might come across things in the press and so on that call about derivatives and all these big financial instruments and stuff. At its base, this whole system is premised on this idea that people are purchasing income streams at a discount and then they make profit by waiting it out. Securitization is one of the terms that, if we're talking about derivatives and all that stuff, securitization is one of the terms that is linked to this process. So the process of securitization is getting a bunch of income streams, packaging them together in a financial product, and then making it available to the market for people to purchase. Imagine that the person buying all these income streams is not buying from the same person. So there's a company that me, the photocopier business, I sell all my invoices to the same company. But that company that provides this financial facilitation buys similar income streams from other people. It could be that all of us are selling photocopier paper. It could be that some of us are selling photocopiers, the other person are selling toilet paper, the other people are selling printers, right? The important thing is that all these are invoices for these types of transactions. The people that bought them, they could package them together using this process of securitization in a financial product. And then they say, here's a financial product that contains 10,000 invoices that are going to be paid within the next 30 days, within the next 6 months, within the next 3 years. This financial product containing all of these things comes with a set of documentation that describes what it is, and then it can be sold in a marketplace. So financial markets are not just equity markets. They don't just deal with shares, but they deal with financial products. These are the key types of financial products that participate in those markets. This then has the fantastic advantage that I, the photocopier company, win because I got rid of the risk of non-payment and I got my money early. The financial facilitator who bought all of these income streams and packaged them as a financial product win because they sold it to other people and they got their money early and they made a profit. The people that bought these financial products can either resell them for an appropriate price, or they can hold them to maturity and then they collect the money from all these people that were meant to pay those invoices. And these financial products that are then circulating in marketplaces, they've got fluctuating prices. It's exactly in the same way that shares have got fluctuating prices. It depends on what people think about the contents of this particular product, but it also has to do with overall economic conditions and, confidence in the financial markets and all the rest of it. Normally, if people are feeling confident about something that is very, very likely to repay 100%, then the price of this tends to be quite high, but the return that it gives you in terms of interest that you will pay or something like this tends to be quite low. If something is super safe and super secure, you don't need to incentivize people to get it. If there is some concern about overall economic stability or the product itself, and there's some concern that the product might default, the price drops and the interest rate or the reward that it gives increases. Because prices are always moving in the opposite direction of interest rates, because you're trying to incentivize people to buy it. So if I was to buy this box that now you're trying to sell to me because it's beginning to look a little bit risky, if you bought it at, say, 90% of the value, now for me to buy it, I will buy it at 70% of the value because it's riskier. And that gives me a higher yield. Now, before you were making 10% out of this, now I'm going to make 20 or 30% to make it worth my while, because I'm assuming this significant risk of default. Yeah. So these have got fluctuating prices, and they circulate in these marketplaces, and prices go up and down depending on conditions. The fun thing about the process of securitization is that it gives you an endless environment of potential derivative products. Why are they called derivative products? Because one derives from the other. My original invoices from the photocopying paper, they got packaged into this bundle. So this is derivative of my original invoices. The people who packaged it together, perhaps then they combined it with other packages to create a new financial product. This is, again, a derivative product because it comes from these original sets of sources. So the capacity to create derivative products is endless, and it depends on the appetite in the market to purchase these things. And it serves a very useful purpose of people accelerating their income streams. The people who are in a hurry to get their money, or they just don't want to keep this anymore because they think it's unsafe, they got the opportunity through these marketplaces to get their money quicker. The people who can wait, or the people who have a higher appetite for risk, can actually purchase these things and then hope to make money down the line. Interestingly, some people are obligated to invest into these products. The banks have got criteria as to how they invest their money, and these criteria are set by law. So for the banks to invest according to the legal provisions, they actually need to be invested in those markets at various levels of risk. It says that, 10% of your assets needs to be on something that's super safe, 20% can be on something that's medium safe, 5% of the assets needs to be can be in something that's super risky. So you need to have those products in these varied marketplaces so the banks can actually fulfill their own regulatory obligations in investing in diversified portfolio. The same thing happens with pension funds. The same thing happens with any fund manager. If you go work in the city, you're probably going to work with people who are in charge of investing other people's money. The way they invest that money needs to have different products with different levels of risk. This is what it means to have a diversified portfolio. You wouldn't be able to achieve this level of diversification if the only thing you could do is to give loans directly to businesses or purchase shares. So these financial markets that operate with these derivative securitized products are essential in allowing people to have better opportunities for investment. So all things super cool and super normal. Where it gets a little bit problematic is when the constant state of repackaging leads to a situation where we are not exactly sure what is in those products. This is a little bit like a restaurant reusing leftover meals. Do you know why you should never get the mince dish? You should never get the burger in a roadside cafe? Because the burger is made out of leftover meat from other things that they reground and made into a burger. So if you want to live, stay away from the burger on the road. Now, there's an ultimate level to the remixing before things go bad. So the restaurant buys a whole bunch of steaks and a whole bunch of fish. When the fish is beginning to look a little bit dodgy and you cannot serve whole to the client, then you make a fish pie so they don't actually see what it looks like. Okay? If they don't buy the fish pie, you probably run out of road right there. But if it was steak, maybe if the steak doesn't look super fresh to put in the pan, then you can make a dish with it. Then you can crumble the dish and make burgers. But you will reach the end of the road. Now, of course, you might be lucky and eat at the restaurants that they respect the health and safety things, but, just in case, it never hurts to be careful. Plus, you never eat anything with a lemon sauce. Why not, ladies and gentlemen? Because if it's gone off and it's got a lemon sauce, you won't be able to taste it. Because if you're eating something with a tomato sauce, and it tastes tangy, you know that the meat has gone off. If it has a lemon sauce, you won't be able to tell. Again, quick trip to the hospital and a weekend throwing up. You see? From this class, you're getting money-saving advice and survival advice, especially if you're eating in dodgy restaurants. Nando's is fine. There's an ultimate level beyond which the remixing is a problem, either because you're starting to remix assets of poor quality, or because you have difficulty figuring out what are the components of the package that you buy. And the complexity of all these was a key contributor to the financial crisis when you guys were babies. Anybody remember the financial crisis? The problem with the financial crisis is that things got packaged and repackaged and repackaged. Every time they made a package, they sent it to be quality checked. The people who were quality checking it, they were kind of going, oh yeah, this has got some nice stuff, some bad stuff, some very bad stuff. Let's give it a rating. Then they would remix just the bad bits again, and they would take it to be assessed, and then they would go, okay, this has got some good stuff, some bad stuff. But every time they remixed the ingredients, the overall quality of the package was worse and worse and worse. But when they were checking it to quality assess it, they were always giving it the same labels. So it went to a situation that a great deal of the financial packages circulating in these markets were pure garbage, but they were still getting treated and presented and marketed as being diversified enough products that at the core of them, they're safe. So this went on for so long that eventually everybody was heavily invested in stuff that were complete garbage, and these products started defaulting because people wouldn't pay their invoices, people wouldn't pay back their mortgages and all that. And that's how we ended into a problem. However, to finish this off, let's go back to what we were talking about. We know what a business going bust looks like, and we know what the process of insolvency requires. What we don't want is to be left at the end of this list as unsecured creditors. The way to avoid this is either to elevate yourself within the list. Either you obtain a fixed charge or a floating charge, or you're lucky enough to be a preferential creditor. Now, you cannot become a preferential creditor. That's a status thing. Either you are or you aren't. But if you cannot elevate yourself within the list, then you can try and take yourself outside the list. You can do this by contractual mechanisms that make a third party responsible through guarantees or indemnities, or by selling this to somebody else, so it's no longer your problem. Or you can have, if we're talking about the sale of goods, things like retention of title clauses. So the important thing to remember, how to be in the best possible, most secure position if things go wrong. The answer again is either you're on top of the list or you're not in the list. You find yourself stuck as an unsecured creditor, you're in trouble. If you are on the retail level, as we've discussed in previous presentations, maybe somebody else can help you. Maybe if you paid by PayPal or a credit card, or your bank might be motivated to assist you if you didn't get your goods or services. But in the business-to-business setting, there isn't a great deal of external insurance that could help you at reasonable costs if you are an unsecured creditor. So either if you pick your counterparties super carefully, or you're happy to assume the risk of loss if the other people default, or you utilize one of these mechanisms that we said to either take yourself out of the list or place yourself at the top of the list.
Thank you for listening till the end. Let me know in the comments if you found this useful, click that like button and subscribe to the channel for more.